Let us continue with branch accounts AS 18 and AS 19. And now the first is all about branch accounts. So coming to branch, we are going to discuss most of the branch with respect to dependent branches. So please be careful and concentrate. So first of all, the branches are divided into two types: inland branches and foreign branches. And coming to inland branches, again divided into dependent and independent branches. Foreign are again divided into integral and non-integral branches. And coming to this thing, we will elaborately learn in accounting standard number 11. And now we are about to start about dependent branches. And most of our concentration is also extended in dependent branches. Coming to dependent branches, books of accounts of dependent branches are prepared by head office. Books of accounts of dependent branches are prepared by whom, Mama? Head office. So head office is going to prepare the books of accounts of dependent branches. And frankly speaking, head office also sends goods to branch. It can send either at cost price, it can send either at invoice price, or it can send either at wholesale price. And coming to the first two parts, if at all the goods were sent at cost price or invoice price, you can use any of these three methods: debtors method okati, stock and debtors method, and final accounts method. If at all the goods were sent at wholesale price, you have to use something called wholesale price method. And this is actually similar to independent branches, but not independent branches. And now starting with the first and foremost method, that is all about debtors method. My dear children, the debtors method format is so simple: opening assets, opening liabilities, closing assets, closing liabilities, goods sent, goods returned, cash sent, cash remitted. Apart from this, no other things will be there in branch account. Apart from this, no other elements will appear in branch account. Take care. Opening assets, opening liabilities, closing assets, closing liabilities, goods sent, goods returned, cash sent and cash remitted. And my dear children, under debtors method, there is a branch account which is a perfect double entry system. This is having a perfect double entry system, and along with that, you have to prepare some supporting accounts like memorandum cash account and memorandum debtors account. And sometimes you may also need to prepare memorandum petty cash account. Remember, till now the need did not arise, but whenever the need is there, you also may need to prepare memorandum stock account. While preparing memorandum stock account, you need to book everything at cost price or invoice price. Fortunately, till now under debtors method, we did not prepare memorandum stock account till now. If you are supposed to prepare memorandum stock account, then opening stock, purchases, sales, closing stock, everything has to be booked at cost price only. To tell you, even sales also should be booked at cost price. Because this is not an account to find the profit. This is an account to show the stock movements. That's it. Is it clear, everybody? Respond, is it clear? Now, this is all about debtors method. That's it. And some of the special elements that to be taken care. Number one, in one of the questions like Arnold Traders question, there is something called commission to branch manager. After the completion of entire branch account preparation, you'll get either net profit or net loss, which has to be ultimately transferred to HOP&L account. In that problem, you will be given with branch manager's commission, which has to be charged after charging commission. But obviously, you will be having net profit before charging commission. So compute the commission, that is net profit before charging commission into 5 by 105. And you will be getting some commission account. And this commission in branch account should be treated as an outstanding liability. And it has to be booked at branch account debit side to balance carried down, something like outstanding commission. Be careful, that is very, very important. Or you can also simply write like commission. But remember, that's a liability, that is not an expense. The important thing is that branch account will not account for expenses and incomes. It will account only for assets, liabilities, goods and cash. Frankly speaking, this is nothing but opening capital. This is nothing but closing capital. This is nothing but additional capital. These are nothing but drawings. So this is purely similar to your capital comparison method of your accounts from incomplete records. So opening capital, closing capital, drawings, additional capital. After completing, you will be getting either net profit or net loss. Respond everybody, clear. And now in debtors method itself, there is one very special adjustment, preparing debtors account and preparing memorandum cash account. Memorandum cash account and memorandum debtors account, wherein, my dear children, data will not be given clearly. Frankly speaking, what should be there? Opening balance, credit sales, collections, closing balance. This should be your memorandum debtors account. And in memorandum cash account, you should have something like to sales, cash sales. My intention is like to sales done towards cash, to debtors, collection received from debtors. Am I correct or wrong? But in this problem, what happened, how much is the amount collected from debtors? Separately, it's not available. How much is the cash sale? Separately, it's not available. It is combinedly available. Two things were given instead of giving this. Number one, what is cash sales? We don't know. What are credit sales? We don't know. How much is amount received from debtors? We don't know. But given total cash sales plus credit sales, total sales is equal to 1 lakh. And total amount in the form of cash sales and amount received from debtors comes to 80,000. Like this it was given. So is my point clear, everybody? So frankly speaking, it is not possible to find anything individually in this context. Cash sales plus credit sales is equal to 1 lakh. How much is cash sales and how much is credit sales? We don't know. How much cash sales and amount received from debtors is 80,000. How much is cash sales and how much is amount received from debtors? We don't know. Is it clear? So frankly speaking, we cannot do anything in this context. Kontamandu untaru, I don't know why will they do. 1 lakh minus 80 is equal to 20,000. 20,000 is cash sales antaru. See? How is that possible? 1 lakh minus 80 ante, the meaning is that credit sales plus cash sales minus cash sales plus amount received from debtors. And if you are doing credit sales plus cash sales minus cash sales plus amount received from debtors, and that is the difference between credit sales and amount received from debtors. Why for me that one? What can I do with that? Is my point understood? So no need to take the difference in this context. Anyways, in this context, how to crack it, sir? Sir, we don't know what is a cash sale separately. We don't know how much is the amount received from debtors separately. But we know that these two things combinedly. So put that figure here. Cash sales and amount received from debtors. Put that 80,000 here. Respond everybody clear. Now coming to memorandum debtors account. Yes, I don't know what is credit sales. I don't know what is amount received from debtors. But I know what is the total sales. I know what is the total amount received towards cash sales and collection. Prepare a wrong debtors account. Ante add cash sales at both the sides, that is at debit and credit side, and put the amount like 1 lakh and 80,000. You are going to get the final answer correctly. Because if you observe credit sales plus cash sales minus collection minus cash sale will get automatically cancelled, and ultimately in memorandum debtors account no cash sale is booked now. Understood? So my dear children, frankly speaking, dash is not available in the question. Cash sales, credit sales, amount received from debtors. At least if one figure is available, you will get all the remaining three. But since we are not available with any figure, just put the combined account in, combined amounts in debtors account. Answer. Prepare wrong debtors account to get the correct answer. Is my statement clear, everybody? You need to prepare a wrong debtors account to get the correct answer. Wrong debtors account under you are adding up dash. You are wrongly adding cash sales at both debit and credit sides of memorandum debtors account, but you are going to get the final answer correctly. Respond everybody, clear. And that is the end of debtors method. And now coming to the next method, that is stock and debtors method. In stock and debtors method, it is a perfect double entry system, and you need to prepare branch stock account, branch stock adjustment account, branch P&L account, branch debtors account, branch cash account, branch expenses account, and finally goods sent to branch account. Now he will be using a word like necessary accounts. He will not tell anything. Prepare necessary accounts under stock and debtors method antaru. In such a case, the necessary accounts are these three: branch stock account, branch stock adjustment account, and branch P&L account. These three are called as necessary accounts. Is it clear, everybody? But these must be supported by these accounts, because sometimes you may get balancing figures. How much is cash sales? You don't know. To find cash sales, you need to you need to prepare branch cash account. Is it clear, everybody? And how much is credit sales? You may don't know. So sometimes to find credit sales, you may need to branch debtors account. And always you need to prepare branch expenses account, because ultimately branch expenses will be closed and transferred to branch P&L account. And goods sent to branch is totally optional. Only when he asks, you prepare. And coming to goods sent to branch, you have to find a net goods sent to branch, and it will be ultimately transferred either to trading account or to purchases account. Is it clear, everybody? Now moving on to the next thing, how the formats will be. Branch stock account is always prepared at the invoice price if the goods were sent at invoice price. Branch stock adjustment account, you will be having this account only when the goods were sent at invoice price, and you have to remove loadings here. Is it clear, everybody? And if at all the goods were sent at cost price, no need to prepare branch stock adjustment account. Is the point clear? Now coming back to branch account under debtors method, I have told you the format clearly if the goods were sent at cost price. But what if the goods were sent at invoice price? Very simple. All the stock related items like opening stock, closing stock, goods in transit, whatever are there, and also two goods sent to branch by goods return. All these things have to be booked at invoice price. And corresponding loadings you need to remove exactly at the opposite side. And goods sent to branch loading at credit side, goods return loading at debit side. But instead of doing two things, you can simply find loading on net goods sent to branch, and you can remove it at credit side. Respond, everybody, clear? And now going back to our format, here it is branch stock and branch stock adjustment account under stock and debtors method. Branch stock account and branch stock adjustment account. My dear children, if the goods were sent at cost price, dash account is not needed. Branch stock adjustment account. But if the goods were sent at invoice price, prepare branch stock at dash price, amma. Prepare branch stock adjustment account at dash price, amma. Loading. Branch stock adjustment, you need to remove the loadings. Branch stock account, you need to prepare at invoice price. Just if you concentrate, my dear children, branch stock account is purely similar to your trading account. Ante, you will be having opening stock, you will be having purchases. But frankly speaking, do the branch purchase? No, it will get the amount from head office. So it is something like two goods sent to branch. And my dear children, goods sent to branch will be prepared at cost price. And you need to remove the loading in a separate account called branch stock adjustment account. Is it clear? Sir, Cheppandi, is it clear? So if the goods were sent, what is the journal entry, amma? Branch stock account debtor to goods sent to branch account to branch stock adjustment account. This will be at dash price, amma. Invoice price. This will be at cost price. This will be at loading. That's the reason in branch stock account debit side you are putting two goods sent to branch at cost price to branch stock adjustment account with loading, and the total amount is nothing but invoice price. Respond, everybody, clear? And the next one, sales summa by if you're selling it on credit basis, by branch debtors account, credit sales. If you're selling it on cash sales, you're getting cash. So by branch cash account, you need to book cash sales here. Is it clear? Now coming to returns. If it is goods returned to head office, if it is goods returned to head office, exactly opposite. If it is sales returns, exactly opposite. And you will be writing like to branch debtors account for sales returns, and you will be writing by goods sent to branch and by branch stock adjustment account for dash returns, goods returned to head office. Is it clear, everybody? And after the completion of all these things, you just put the closing stock. You just need to put the closing stock, and finally find the profit or loss, which has to be transferred to branch stock adjustment account. Is it clear, everybody? And in how the branch stock adjustment account will be, opening stock, wait, opening stock is the debit side of branch stock account. So loading will be absolutely removed at the credit side by balance brought down, which is nothing but opening stock reserve. And coming to closing stock also, you need to do the same, to balance carried down, which is nothing but closing stock reserve. This is what the prima facie in branch stock adjustment account. And the removal of loading, something like by goods sent to branch. Remove the loading on goods sent to branch. You have to write here by branch stock account, loading on goods sent to branch, and here you have to write to branch stock account, loading on goods returned, because you are writing an entry here, branch stock account debtor, to goods sent to branch, to branch stock adjustment. So in branch stock adjustment account credit side, you have to write like by branch stock account, and you need to credit the same with loading. Respond, everybody, clear? And frankly speaking, your branch stock adjustment account will be appearing like this, and once again you are going to get profit or loss, which has to be transferred to branch P&L account. Respond, everybody, clear? And finally, in branch P&L account, you need to put GP or GL. Am I correct or wrong? That is nothing but amount you have got from branch stock adjustment account. From branch stock adjustment account, whatever the profit or loss is there, you just need to put that amount, and to branch expenses account. If any branch expenses are there, you need to put it at debit side, and finally you are going to get net profit or net loss, which has to be transferred to HOP&L account. Respond, everybody, clear? And my dear children, this is what your stock and debtors method. So frankly speaking, if you want me to prepare simultaneously branch stock account, branch stock adjustment account, take out opening stock, immediately opposite, loading on opening stock, closing stock, immediately opposite, loading on closing stock, to goods sent to branch, to branch stock adjustment, immediately credit side. Getting my point, everybody? And now coming to the closing procedure, I just shown you simultaneously how to prepare. And also credit sale, I think you will be putting by branch debtors account kada. Simultaneously you have to open branch debtors account, and you need to put to branch stock account. Like that, prepare stock and debtors method simultaneously. Open all the accounts and prepare simultaneously. You will get everything correctly. Now, very important, from branch stock account, you will be getting a balancing figure, which is called either surplus or deficit, which has to be transferred to branch stock adjustment account. From branch stock adjustment account, you will be getting either GP or GL, which will be transferred to branch P&L account. And branch expenses account has to be closed and transferred to branch P&L account. And after that, from branch P&L account, you will be getting either net profit or net loss, which ultimately be transferred to HOP&L account. Respond, everybody, clear? My dear children, this is what your stock and debtors method. But in one of the problems, he will be preparing branch stock account directly closed and transferred to branch P&L account, branch stock adjustment account directly closed and transferred to branch P&L account. Two things are absolutely correct. But general tendency is that branch stock to branch stock adjustment to branch P&L. In a single line to tell you, branch stock account plus branch stock adjustment account is nothing but trading account. Is it clear, everybody? Now moving on to the next thing. Sir, generally goods sent to branch will be prepared at dash price cost price. And it will be something like by branch stock account cost price of goods sent to branch. To branch stock account something like cost price of goods returned. But sometimes deliberately he might ask you to prepare goods sent to branch at invoice price. In such a case, how to prepare, sir? Very simple. By branch stock account, find and put the total invoice price on goods sent. To branch stock account, on goods returned, find the total invoice price. Now you will be getting a balancing figure at debit side. From that balancing figure, separate two parts, loading part okati, cost price okati. Cost price will be closed and transferred to purchases or trading account. Loading part, whatever is there, it will be transferred to branch stock adjustment account. If you want, you can also do like this, but generally goods sent to prepared branch will be prepared at cost price. Respond, everybody, clear? And now moving on to the next thing, final accounts method. 99.9% this method will not be tested, but if at all tested, so simple. Final accounts method, you need to just prepare memorandum, trading, P&L account. Along with that, you need to prepare supporting accounts like memorandum, debtors account, memorandum, cash account. Wherever need is there, you need to open these two accounts. Only then you are going to get some balancing figures. And whether or not the goods were sent at invoice price or cost price, always TPL account you can comfortably prepare at cost price. Is my point clear? Under debtors method, stock and debtors method, if the goods were sent at cost price. If the goods were sent at invoice price, first you have to book invoice price and then you need to remove the loading. But whereas coming to final accounts method, you can comfortably every time always prepare at cost price. Clear, everybody? Fine. And now very important, how to treat normal loss and abnormal loss. How to treat normal loss and abnormal loss under debtors method, stock and debtors method, and final accounts method. My dear children, point number 1. If it is normal loss, no need to record in debtors method, no need to record in final accounts method. And you have to record it in stock and debtors method. Sir, normal loss. With normal loss, do stock decreases or not? Do stock decreases or not? So branch stock account credit side at invoice price. Because branch stock is always prepared at. Branch stock account is always prepared at invoice price. When invoice price is there, you always need to prepare at invoice price only. So branch stock account credit side, you need to credit it with invoice price. Is it clear, everybody? Hey, answer me. What is the cost of normal loss? 0. And effect should be nullified. Am I correct or wrong? But since in already branch stock account credit side you have recorded, now you need to debit the same with invoice price in one more account, that is branch stock adjustment account. Is my point clear? And with this, normal loss is credited, normal loss is debited, and the account gets nullified. Respond, everybody, clear? What is the cost of normal loss? 0. But since branch stock account shows every movement of stock, since with normal loss stock is getting decreased, you have to put branch stock account of normal loss in branch stock account credit side. Stock decreased, yes, conveyed, sir. But what is the cost of normal loss? 0. And you have to nullify the effect. Since you have credited, now you need to debit. You need to debit in dash account, branch stock adjustment account. Respond, everybody, clear? With this, I am telling two conclusions. Branch stock account is generally prepared at dash price. But in branch stock account, sales will be booked at selling price. Is it clear? Now, branch stock account is generally used to remove the loadings. But in branch stock adjustment account, normal loss has to be debited with invoice price. These are special points in these accounts. Be careful. Shall I proceed further? Quickly answer me. Normal loss is not accounted in debtors method, final accounts method, but it is accounted in stock and debtors method. Frankly speaking, what is a journal entry, Amma? Branch stock adjustment account debtor to branch stock account. ఇంకా సింపుల్ గా చెప్పాలంటే branch stock account credit side, branch stock adjustment account debit side. Respond everybody clear. Now moving on to the next thing, abnormal loss. My dear children, no need to account abnormal loss even in debtors method also. Reason is so simple. Debtors method will never account for a nominal account. Debtors method is so simple. Opening asset, opening liabilities, closing assets, closing liabilities, goods sent, goods returned, cash sent, cash remitted. No other single element will be appearing in debtors account. No other single element also will be appearing in debtors account. It accounts only for these limited items, and hence no need to account for normal loss, no need to account for abnormal loss. Automatically it will get adjusted in stocks. Respond everybody clear. Whereas coming to final accounts method, yes, whatever you have learnt in your foundation, you have to do that one. And a normal loss you should not account. Coming to abnormal loss, you need to credit trading account with gross loss of stock. Debit P&L account with net loss of stock. And if any outstanding insurance claim is there, you have to book the same in the balance sheet. If you have received the cash, simply debit to cash account. Is the point clear, everybody? Sir, dash loss you are learning now. Abnormal loss. No need to account in dash method. Debtors method, but you need to account in dash method, final accounts method. Tell me, in final accounts method, trading account which side? Credit side with gross and net. Net loss of stock has to be debited to P&L account. Difference is nothing but insurance claim, if any, it will be accounted in balance sheet as if it is an asset. If it is received, simply you will be adding it to cash. Respond everybody clear. Now be careful, how the same shall be recorded in stock and debtors method. Stock is getting decreased, yes or no? So branch stock account credit side with invoice price. And net loss of stock వచ్చేసరికి branch P&L account debit side with net loss of stock. This is like gross loss of stock. Hey, is it clear? My dear children, this is booked at dash price, invoice price. So you have to remove the loading at credit side in branch stock adjustment account. Now loading is removed. Hey, yes or no? Gross loss of stock in branch stock account is at invoice price. Loading is removed in branch stock adjustment account. Now it is accounted at cost price and natte kadamma. So net loss of stock, if any, is there, branch P&L account debit side, and if any insurance claim is there, it has to be booked in the balance sheet by head office. If you have received any insurance claim, that has to be debited to branch cash account. Sir, ardhamainda? To tell you, branch stock account by abnormal loss. How it has to be booked, sir? Say if the total abnormal loss is 100, out of which 80 rupees is cost price and 20 rupees is loading. Then this loading has to be transferred to branch stock adjustment, and cost price whatever is there, it has to be transferred to branch P&L account. Up to this clear, everybody? So now the next one, branch stock adjustment account lo debit side 20, branch P&L account lo debit side 80. Up to this clear? Now very important, say for example, out of this 80, insurance company told that they will give you 70 rupees. Is it clear? So out of this 80, this will become outstanding insurance claim, which will be shown as an asset by the head office. And the remaining 10, whatever is there, this is nothing but net loss of stock, which will be debited to branch P&L account. If you have received this 70, it will be transferred to branch cash account. Respond everybody clear? Quickly answer me, abnormal loss, where shall it be recorded? Branch stock account credit side with invoice price, branch stock adjustment account debit side with loading, branch P&L account with net loss of stock. If any insurance claim is there, treat it as an asset. If no insurance claim is there, simply total cost price will be debited to branch P&L. Respond everybody clear? My dear children, this is all about the treatment for normal loss and abnormal loss. In this connection, you might come across with one more special adjustment, amma, authorized reduction in selling price. Authorized reduction in selling price. Authorized reduction in selling price is also to be treated as normal loss. Authorized reduction in selling price is also to be treated as normal loss. Say for example, authorized reduction in selling price 1000 is given. It has to be posted at similar to normal loss. Ante branch stock account credit side, branch stock adjustment account debit side. Sir, for normal loss, I think you might have understood this one. Is it clear? For normal loss, I think you might have understood this one, because stock movement is reducing branch stock account credit side and branch stock adjustment account debit side in order to remove the loading part. But you should not remove not only loading, you have to remove the normal loss. Ela post cheyali. Branch stock account credit side with invoice price, branch stock adjustment account debit side with loading kaadu, you need to put the entire invoice price in order to nullify the effect. Reason clear? Now authorize the reduction in selling price. Posting is similar to normal loss. Ante branch stock account credit side, branch stock adjustment account debit side. But I am asking you the reason why it has to be done like that. Concentrate. Say for example, we have purchased a good for 100. If everything is good, I have to sell it for 140. Then surplus I am getting is 40. Is my point clear? But authorized reduction in selling price, and deliberately we have reduced to 130 and we are selling it at 130. And what is my sales amma? 130. What is my surplus amma? 30. Is it clear up to here? But ఇప్పుడు బ్రాంచ్ స్టాక్ అడ్జస్ట్మెంట్ బ్రాంచ్ స్టాక్ అకౌంట్స్ ఏమంటాయి అంటే, యూ పుట్ ఇన్ బ్రాంచ్ స్టాక్ అకౌంట్ కాస్ట్ ప్రైస్ 100, సేల్స్ 130. బట్ వాట్ ఇఫ్ దెర్ ఇస్ నో రిడక్షన్ ఇన్ సెల్లింగ్ ప్రైస్? ఇట్ మైట్ హ్యావ్ సోల్డ్ ఫర్ 140 కదా. సో పుట్ ఆథరైజ్ రిడక్షన్ ఆల్సో యాజ్ ఇఫ్ ఇట్ ఇస్ సేల్స్. So that you are going to get, if at all there is no authorized reduction in selling price, the profit would have been 40. But since you have reduced the selling price, debit the same in branch stock adjustment account 10 and transfer this 40 to branch stock adjustment account, and ultimately you are going to get 30. Sir, logic ardhamainda? Authorized reduction in selling price, branch stock account credit side, branch stock adjustment account debit side. What is the reason? Branch stock account has to be credited by assuming as if there is no reduction. But since it is actually reduced, you need to debit the same in branch stock adjustment account. Respond, everybody understood? Hey, pakka everybody clear? And my dear children, this is what your stock and debtors method. Special points with respect to normal loss, abnormal loss, authorized reduction in selling price. Now, in one of the problems, if you have remembered, goods sent to branch is 2 lakhs at cost price. Invoice price of goods received is equal to 2,20,000 antadu. And loading is equal to 20% on cost price. Is it clear? What is the cost price of goods sent, amma? 2 lakhs. So invoice price of goods sent is equal to 2 lakh plus 20%, which comes to 2.4 lakh. Out of 2.4 lakh sent, you have received only 2,20,000. So the difference 20,000 is to be accounted as goods in transit. Clear everybody? So now be careful while preparing branch account under debtors method, branch stock account under stock and debtors method. You have to debit for entire goods sent. Not goods received. Debit for goods sent antunavu kada. So goods sent to branch, total amount you have to record at the debit side. But immediately at the credit side, you have to remove goods in transit at similar to closing stock. Likewise, how closing stock is recorded at the credit side, in the similar way, goods in transit is also to be recorded as if it is similar to closing stock. Then automatically 2,40,000 sent minus 20,000 goods in transit, finally received is 2,20,000. Is my point clear? But you are not going to convey the same. in the account directly. Sir, అర్థమైందా? Not clear? How much are goods sent? 2,40,000 invoice price. How much are received? But you are not going to directly put 2,20,000. That will not be directly available to you to see. Then how is it available, sir? 2,40,000 minus 20. 2,40,000 is goods sent and goods in transit of 20. So if you credit that, debit 2,40,000, credit 20, net effect is nothing but 2,20,000. Respond everybody, clear? Okay, my dear children. All the dependent branches special elements are completed. Now wholesale price method. Coming to wholesale price method, so simple. Simply you have to prepare outlet antadu. Outlet is nothing but branch. You need to prepare branch trading account and branch P&L account normally. You have to prepare normally at wholesale price. Sir, normally who will sell to whom, Amma? Head office send to branch. Branch will sell it to outsiders. Head office will purchase it at cost price and it will send by adding loading, which is nothing but invoice price. And branch will say, add some profit and it will be selling to the outsiders at selling price. Now under wholesale price method, head office will be purchasing it at cost price. By adding wholesale profit, will be giving you wholesale price. And if you add some retail profit, then you will be getting some retail price. So while preparing the branch stock account or outlet stock account or branch trading account under wholesale price method, you need to record everything at wholesale price. And how your stock account will be appearing. Trading account or branch stock account will be like this. 2 opening stock, 2 goods sent to branch, by goods returned, by closing stock and by sales. Be careful. This will be at wholesale price. Wholesale price. Wholesale price. Wholesale price. Sales kada, it will be at selling price. Selling price ante retail price. And whatever the profit you are going to get, that is called as retail profit. Ultimately it is transferred to HOP&L account. Respond everybody, clear? But now what are you supposed to do ante? Frankly speaking, opening stock is a dash price, amma. Closing stock is a dash price, amma. And some sort of loading is there. Am I correct or wrong? That loading is nothing but wholesale profit. So you need to remove this in the name of stock reserve. Remember carefully, under debtors method, loading is removed exactly at the opposite side of branch account only. Ante kada? Under stock and debtors method, loading is removed at the credit side of branch stock adjustment account only. And final accounts method, outright prepared at cost price only. And frankly speaking, loading under these 3 methods are removed in branch set of books, HO set of books. Branch set of books maintained by head office. But under wholesale price method, loading will be removed in head office P&L account. Gurtupettukondi. Loading will be removed in head office P&L account. And it is not removed in branch set of books of accounts. It is removed in head office P&L account. So your stock reserve account will appear like this. By balance brought down, opening stock reserve. To balance carried down, closing stock reserve. And this has to be removed in HOP&L account. This has to be removed in HOP&L account. Respond everybody, clear? No need to remove loading on goods sent. No need to remove loading on goods sent in dash method. Wholesale price method, because goods sent to branch is treated as sales by head office, purchases by branch. Respond everybody, clear? So now conclusion. I hope normal loss and abnormal losses are clear, everybody. Normal loss, you need to account only in dash method. Branch stock account credit side, branch stock adjustment account debit side. Abnormal loss, you won't account in debtors method, but you have to account in these two methods. Whereas coming to final accounts method, it's so simple. Trading credit side gross, P&L account debit side net, find if any outstanding or cash received and put it accordingly. Whereas coming to stock and debtors method, branch stock account credit side with invoice price, branch stock adjustment account debit side with loading, and now check out cost price is available. Check out if any insurance claim or outstanding is there, or if any claim is received, then you need to account it accordingly. And if any outstanding insurance claim is there, treat it as an asset. If any cash is received, branch cash account debit side. Now very important, if at all balancing figure net loss of stock, if any is there, it will be transferred to branch P&L account. Respond everybody, clear? Now coming to loading. Loading will be removed on opening stock, closing stock, goods sent to branch, goods returned. In debtors method, it will be removed on the opposite sides. In stock and debtors method, it will be removed in a special account called branch stock adjustment. In final accounts method, no need to remove loading because you will be preparing every time at cost price. But in wholesale price method, you need to remove loading only on opening stock and closing stock. That too, it will be removed in HOP&L account. On goods sent to branch and goods returned, no loading shall be removed because these are treated as purchases by branch, sales by head office. Respond everybody, clear? My dear children, dependent branches is totally completed. Okay, let us continue with independent branches. Sir, in this chapter, actually, this is a combination of independent and foreign branches, but we are not going to discuss about foreign branches now. We'll discuss that while going with accounting standard number 11. So now, let us start discussing only with respect to independent branches. Coming to independent branches, three different models. Frankly speaking, we did not cover intentionally some models in your classroom discussion. We did not put such kind of models for you people at all because they are actually very advanced, and we are actually providing some supplementary material. In that supplementary material, we have added the problems. If you're so interested to check out the problems, you can check out and you can solve. Downline. Because they are obviously very advanced. Now, sir, damn sure you are going to get a question from branches. 90% you are going to get a question from dependent branches for 6 marks. If this is missed, the remaining 9.99% chances to ask a question from independent branches. Okay, and which type of question can be asked from independent branches? It can be either inter-branch ledger. It can be either inter-branch ledger, or it can be either passing journal entries in branch books, or it can be either preparing ledger accounts in branch books, or it can also be either from a foreign branch. Now, the remaining 0.01% is whatever the topics that we did not cover, as I said, which are very advanced, and you might get a question from those topics. But frankly speaking, Institute till now, right from the past around 12 to 15 attempts, it did not ask question from those advanced concepts. Antaku mundu it had asked one question relating to incomplete information, but now he did not ask any such kind of things. So meeku em anipistundante annal nunchi adagaledu kada, aithe ippudu maaku kachithanga adugutadu ani. No comments. And one more important thing, this question is actually being asked in 6th question, amma. As 6th C. No internal choice is there for 6th C. Because 6A, he is giving internal choice. And 6B and 6C. That is how the questions were framed. Upon a time, em chesevadante, question number 6, he will give 4 subbits, write any 3 anevadu. But now for this new syllabus, even that concept is done away with. If you would like to choose sixth question, then for sub question number 1 there is choice. 2 and 3 no choice at all. అయ్యో అంటే అవ్వదు అయ్యో. ఎనీవేస్ మళ్ళీ అయ్యో ఆగు. సో whatever the question from branches 100% you are going to get a question in 6C. But whether is it from dependent branches or independent branches, it is just depending on your fate. And also if it is independent branches, the questions can be asked from inter-branch ledger. If you have remembered something like the inter-branch ledger will be like this, particulars, and you have to write all the branches like Delhi, Kolkata and Chennai. Sarele, Mumbai, Anakapalli, and you need to check out the transactions among various branches. Say for example, if Kolkata had sent goods to Chennai, you will be writing like sent goods. And who is sending it to whom? Kolkata to Chennai. So Chennai is getting benefit. So 10,000 debit. And Kolkata is losing. So 10,000 credit. So like that you are supposed to continue every transaction. One branch is getting benefit, another branch is getting loss. So the benefiting branch has to be debited, the loss branch has to be credited. And no need to write entry for each and every transaction. After the completion of posting all the transactions, you will be getting the net figures. Say 12,000 debit, 2,000 credit and 10,000 credit. And then you need to write a single set of entry, that is Delhi branch account debtor to Kolkata branch account and to Chennai branch account 12, 2 and 10. Respond everybody, clear? Sir, he might ask you, the question might be something like, he might ask you to prepare inter-branch ledger, or he might ask you to pass a single set of journal entry for various transactions. For various inter-branch transactions, he might ask you to find a single set of journal entry. In that case also, you need to prepare inter-branch ledger account. Respond everybody, clear? This is about inter-branch ledger. And the next one is all about journal entries. Be careful, my dear children. Coming to journal entries, you need to assume that branch is separate and head office is separate, and you are supposed to write the journal entries. Let me tell you some of the journal entries so as that you can get an idea how to write the journal entries. And point number 1, if the goods were sent by head office, what is the entry? Goods sent by head office, what is the entry? Branch account debtor to goods sent to branch account. In branch books, what is the entry? Goods received from head office account debtor to head office account. Clear everybody? If at all goods were returned, you have to pass the reverse entry. And cash sent, cash remitted are very, very easy. Now, sometimes you will be finding a question something like income received by head office allocated to branch. What is the meaning of this one, sir? Income is received by whom, amma? It is allocated to branch ante that income is given to branch అని అర్థం. That cash is given to branch అని కాదు, that income is given to branch. Is it clear? And a conclusion, income belongs to whom? Branch. Cash received by whom? Head office. Please try to understand. Sir, income is received by head office but allocated to branch. And the head office had decided that this income, let me allocate it to branch. Hey branch, take this income. Take this income and take that cash ani kaadu. You can take that income and you can credit in your P&L account and you can increase your branch profit. Is the point understood? Allocated to branch, income allocated to branch ante cash given, income given. Income given, not cash given. Cash is received by whom? Head office. But income is given to whom? Branch. Ante branch is not receiving any cash, but branch is getting income so that it can take that benefit to P&L account credit. credit side so that it can increase its income and it can increase its profit. Respond everybody, clear. Sir, what is a journal entry if at all income is received? Normally, what is the entry if income is received, amma? Cash or bank account debtor to income account. Am I correct or wrong? Now, who is receiving the cash? Who is receiving the cash? Give it to head office. Is it clear? To whom the income is belonging to now? Write this in branch. Automatically, the opposite side will become to branch HO account debtor. It's okay. This is our old technique only. Respond everybody, clear? Likewise, listen carefully everybody. Expense of head office paid by branch. Expense of head office paid by branch. Shall I start now? What is the journal entry? Expense account debtor to cash or bank. Whose expense is that? Who is paying? To branch HO. Respond everybody, clear. So like this you can do any kind of entries, all the four things. Income of head office collected by branch, income of branch collected by head office, expense of branch paid by head office, expense of head office paid by branch. Respond everybody, clear. Now be careful. Coming to debtors. Credit sales. What is the entry? Debtors account debtor to sales account. Am I correct or wrong? This is entry to whom, amma? Branch. So now there is no entry for credit sales in head office. Be careful, huh? Sir, be careful and concentrate and answer. What is it called? Cash received directly by head office from branch debtors. Is it clear? Cash received directly by head office from branch debtors. What is a normal entry when we have received the cash? Cash or bank account debtor to debtors account. Who is receiving? Cash or bank. But to whom it is debtor? To debtor. Automatically to branch HO. Respond everybody, clear. So like this you can also pass the journal entries. Now moving on to the next thing. Sir, now be careful, huh? Branch debtors account maintained by head office. Whose debtors account? Branch debtors account maintained by whom? Head office. Now what is the entry in head office books? What is the entry in branch books for credit sales? Normally what is the entry? Debtors account debtor to sales account. Am I correct or wrong? But debtors is maintained by whom? And head office is also having its own debtors, correct or wrong? So in order not to confuse branch debtors. Is it clear? Automatically the other side is pending kada? Ante. Is it clear? Hey, now be careful, huh? Cash received by branch. Cash received by branch from the debtors. Normally what is the entry? Cash or bank account debtor to debtors account. But debtors account is maintained by? Is it clear? So it is something like two branch debtors ikkada. Automatically the opposite side. Branch head office. So the entry will become branch account debtor to branch debtors account. Cash or bank account debtor to head office account. Is my point clear? Hey, take care, huh? This time cash directly received by head office from branch debtor. Is the point clear? Who is receiving? It is getting cash to branch debtor. Frankly speaking, no entry in branch books. Respond everybody, clear. You can use the same technique even for fixed assets also. Sometimes branch fixed assets will be maintained by head office. Even at that time also you can follow these techniques in order to write the answers. Respond everybody, clear. Now one important case for common both for dependent and independent branches. Common for dependent and independent branches. Be careful, already I have discussed in independent branches. Expense of branch paid by head office. Expense of whom, amma? Branch. Paid by whom, amma? head office. Be careful to crack this. Just assume two-step approach. What is the two-step approach? Cash sent to branch, branch paid expenses. Anukovachuga. Who is paying the expenses? Head office. Whose expenses are being paid? Branch expenses are directly paid by head office. And indirectly, head office is sending cash to branch. Branch is paying the expenses. Respond everybody clear? Now be careful. In debtors method. Frankly speaking, cash sent to branch ante it will be posted in branch account debit side. Ante kada. To cash sent and rastam kadamma. And next, memorandum cash account debit side. Branch paid the expenses. Where do it appears? Memorandum cash account credit side. Because branch is paying the expense ante kada. In memorandum cash account by expenses you will write. Frankly speaking, memorandum cash account debit side, memorandum cash account credit side, it automatically gets cancelled and the net effect is ultimately at branch account debit side. Respond everybody clear. So expense of branch directly paid by head office will appear in dash account dash side under debtors method. Branch account debit side. Respond, is this point clear? Now under stock and debtors method, cash sent to branch, you will be writing an entry like branch cash account debtor to cash account. Frankly to tell you, entry marchipote postings. Cash sent to branch. Branch is getting some cash. Am I correct or wrong? So branch cash account debit side. And branch is paying the expenses kada. So branch expenses account debit side, branch cash account credit side. Again, frankly speaking, cancel. Simply you can record only at one side, that is branch expenses account debit side. Respond everybody clear. Whereas under final accounts method, it is so simple. Whoever pay, it is an expense. If it is an expense, it is appearing in branch P&L account debit side. Is it clear? Now take care, If it is independent branches, how to write? You have to write in HO books. You also need to write in branch books. What is a transaction ante? Expense of branch paid by head office. Expense of branch. Paid by whom? To cash or bank. Automatically opposite side. Branch to head office. Okay, am I correct or wrong? But let us crack the same concept in two-step approach. What is the two-step approach, Amma? Cash sent to branch. Cash sent to branch. What is the first entry you will write? Branch account debtor to cash account. And branch is receiving cash. What is the entry? Cash account debtor to head office account. And then branch paid expenses. What is the entry? Expenses account debtor to cash or bank account. If branch is paying expense, here nothing is done kada. Check out, Cash, cancel. And ultimately the entry is expense account debtor to head office account, branch account debtor to cash account. Respond everybody understood? And instead of writing it as a two-step approach, you can write direct entries. Debtors method low, branch account debit side. Stock and debtors method low, branch expenses account debit side. Final accounts method low, P&L account debit side. Independent branches low, directly expense account debtor to head office. Respond everybody clear. With this technique, you can do even with incomes, expenses, etc. and etc. Respond everybody clear. And my dear children, that's the end of journal entries part. Now in another question, you are having ledger account. Even in that, he will ask you to prepare some ledger accounts. Ante. All the necessary ledger accounts have to be opened. That is common and old fashioned only. But only new thing that you have to remember is all about, be careful, branch account in head office books should exactly equal to head office account in branch books. You have to remember this rule every time. And whenever branch is credited, head office will be debited. Whenever branch is debited, head office will be credited. You have to remember this rule. And generally these two things will always equal. But they may not equal in two situations. Number one, whenever intimation is received late. Intimation received late. And already head office received the amount, but it did not tell to the branch. Is it clear? If at all intimations were received late, then automatically the account balances will differ. So now you have to pass the journal entries and make the balances equal. And in the second situation, in transit items, whether goods in transit or lost in transit, anything. So now in transit items has to be recorded only in either of the books. If you are passing in head office books, goods in transit or cash in transit or lost in transit account debtor to branch account, then no entry in branch books. Or you can pass in branch books, then goods in transit or cash in transit or lost in transit to head office account, and then no entry in head office books. Respond everybody, clear? And my dear children, you can pass either in HO books or in branch books. In the other books, there will be no entry. Now, in examination, in whose books you have to pass, sir? You have to pass in whose books? Sir, question clear? If there is in transit items, it's your policy. If you want, you can pass in HO books, or if you want, you can pass in branch books. Now, in examination, which books you have to pass? You have to pass in the recipient books. You have to pass in the recipient books. Sir, for your kind information, branch sent cash, not yet received by head office. Now pass the entry in whose books? Head office books, because head office is the recipient. Head office sent goods, but branch not yet received. Pass entry in whose books? Branch books, because in this context, branch is the recipient. Respond everybody, clear? So in the examination, it is prudent to pass in whose books? Recipient books. And my dear children, this is the end of independent branches, and I hope this concept is absolutely revised promptly for you. Anipinchaleda ki yes sir chepparu. So 1 second. Is the concepts absolute, are the concepts clear for you? Is the revision promptly done for branches for you? Fine. Last and final. Sir, how to identify whether is it debtors method or stock and debtors method or final accounts method? If at all in the question he is asking you to prepare branch account, then this is debtors method, because branch account is prepared only in debtors method. Whenever he is asking you to prepare branch stock account, branch stock adjustment account and branch P&L account, then that is stock and debtors method. And also necessary accounts under stock and debtors method, and only these three things will come. Whenever he is using the word memorandum, that is final accounts method. And whenever in the question is asking you to prepare branch stock account or branch P&L account or branch trading account, it is connected to wholesale data and retail data. Then that will become wholesale price method. Respond everybody, clear? Fine, my dear children, that is the end point for branches. Fine, my dear children. Let us start with accounting standard number 19. What is accounting standard number 19, Amma? Leases. Amma, there are two parties to leases, Amma. Number one is lessor, number two is lessee. Unlike accounting standard number 7, wherein that standard is applicable only for contractor but not to contractee, but in AS 19 this standard is applicable for two parties, that is lessor and lessee. Is it clear, everybody? And there are two types of leases, Amma. Number one is cancelable lease, number two is non-cancelable lease. Accounting standard number 19 is applicable only for non-cancelable leases. AS 19 is not applicable for cancelable leases. And non-cancelable leases as per AS 19 are divided into two types, Amma. Operating lease okati, finance lease okati. So AS 19 is applicable only for dash leases, non-cancelable leases. It is applicable for both the parties, that is lessor and lessee. Continuous from the past one day. So there are two parties like lessor and lessee. AS 19 is applicable for both the parties, lessor and lessee, whether it is finance lease or operating lease. Now moving on to the next thing. Sir, there are 4 conditions with respect to a non-cancelable lease when it can be cancelled. Is my statement clear? Sir, cancelable lease ante lease which can be cancelled. Non-cancelable lease ante lease which cannot be cancelled. But even a non-cancelable lease is also cancelled in the following 4 situations. But this concept is not that important. You read it and you just try to solve. But what is far more important ante finance lease and operating lease. So I'm straight away concentrating on finance lease and operating lease. My dear children, possession is transferred in both the leases. Ownership is not transferred in both the leases. Possession is transferred in both the leases. Ownership is not transferred in both the leases. Very, very important. Risk and rewards. Risk and rewards are generally directly connected to ownership. But under leases, risk and rewards is directly connected to possession. If risk and rewards are also transferred along with the possession, we will call it as finance lease. If risk and rewards are not transferred with possession, we will call it as operating lease. Now, when can we tell risk and rewards are transferred, sir? So frankly speaking, AS 19 had given you 8 conditions in the set of 5 plus 3. 5 deterministic conditions, 3 suggestive conditions. What do you mean by deterministic conditions? AS 19 told 5 conditions. In the 5 conditions, if any of the condition is satisfied, whatever you write in the agreement, we just don't care. It is treated as finance lease as per AS 19. Then what do you mean by suggestive conditions, sir? If any of the following 3 conditions are satisfied, we are suggesting it is to be a finance lease. But if you are classifying it as a different lease, that is your choice. Is the point clear? Ante, in dash conditions, you don't care about the agreement. Deterministic conditions. In dash conditions, you need to consider the agreement. Suggestive conditions. For examination, only deterministic conditions are important. Suggestive are not at all important, and outright I'm not dealing with it. And coming to deterministic conditions. How many deterministic conditions are there? 5 deterministic conditions are there. Number 1. At the end of lease, ownership is transferred to lessee. At the end of lease, ownership is transferred to lessee. My dear children, say for example, the life of the asset is 30 years and you have given 20 years towards lease. Use your common sense and tell me, for 20 years, who is using the asset? Lessee. After 20 years, ownership is also transferred to lessee. And for the remaining 10 years, who is using the asset? Lessee. And a lessee is using the entire asset for all the 30 years. So with whom the risk and reward should be? And hence that is a deterministic condition. Hell with the things. Whatever you write there in the agreement, we don't care. Since for the entire period lessee is using the asset, this will be treated as finance lease. And since the asset is used by lessee for all the 30 years, risk and reward should be borne by lessee. That is prudent to consider. Is my logic clear, everybody? And condition number 2, be careful. You have to decide at the inception of the lease. What is the inception of the lease? Let us discuss later. Gurtunda, this word we have discussed in case. Yesterday we discussed actually. Case 17 kadu. 17 tarvata. 24. In AS 24 you are having something called initial disclosure event. Initial disclosure event is nothing but date of binding sale agreement or date of formulation, approval or announcement, whichever is earlier. Date of binding sale agreement anna, inception of lease anna, 2 things were similar. Anyways, let's come back. Finance lease condition number 2. So decided at the inception of the contract, at the inception of lease that lessee will be provided an option to purchase. Who is provided an option to purchase? Sir, in condition number 1, ownership is outright transferred. But in condition number 2, option to purchase is given. What is given, Amma? Option to purchase. Very, very important. If lessee exercises the option, that is finance lease. If lessee did not exercise the option, that is operating lease. If lessee exercise the option, that is dash lease, Amma? Finance lease. If lessee did not exercise the option, that is called as operating lease. Up to this clear, everybody? But there is one more very important point to discuss. Sir, you need to classify the lease at the inception of lease only. Inception ante starting ankondi. At the starting of lease itself, you have to classify the lease. But here what are you telling? If lessee subscribes, if lessee did not subscribe, at the end of lease. Is my point clear? You need to classify the lease at the inception of the lease. But here condition is like, if lessee exercises his option to purchase, then it is finance lease. Otherwise, it is operating lease. And you are coming to know what is the type of lease at the end of lease. But you need to classify at the inception of the lease for accounting purpose. So, to make this condition stronger, option to purchase at a price less than fair value of the asset. Is it clear? So, sir, if at all you are offering at a price less than fair value, does the chances of option to exercise will increase or not? Say for example, fair value at the end of lease is 1 lakh, but you are offering only at 30,000. Does the chances of exercising will increase or not? Obviously, it will increase. So, condition ఏమంటే at the inception of the lease, you have to provide an option to lessee to purchase the asset. And lessor should have reasonable certainty that lessee is going to exercise his option to purchase. Reasonable certainty ante maximum chances. Hey, did you remember virtual certainty? Where did we cover? Is 9. Is 29. Yesterday in the last session is 29. Yes. Future obligation. You should not create provision for future obligation. Provided if future obligation is virtually certain, you have to create a provision. Is it clear? Now you are having a term called reasonable certainty. What is reasonable certainty? Maximum chances. So who should have that maximum chances? Lessor should expect that maximum chances should be there for lessee to purchase an asset. Then it is dash lease amma. Finance lease. Then it is dash lease amma. Condition number 2, at the inception of the lease, lessor should have reasonable certainty that lessee is going to exercise his option to purchase the asset at the end of lease term at a price lesser than the fair value at the end of lease term. Respond everybody clear. Sir, if at all lessor is having reasonable certainty and maximum chances that lessee is going to purchase the asset, come back to the example. Asset life period 30 years. You have provided to lease for after 20 years, who is having option to purchase? Lessee. Now, if 1 lakh asset, if you are offering for 30,000, will he exercise the option or not? Ante more chances for lessee to use the asset for entire 30 years. Yes or no? And who has to bear the risk and rewards? Lessee has to bear the risk and rewards. Is condition number 2 clear, everybody? Condition number 3. Present value of MLP is almost equals to fair value of leased asset. What is condition number 3? Present value of MLP is almost equal to the fair value of leased asset. Likewise, say for example, MLP includes lease rents. Who has to pay lease rent? Lessee. Year 1, year 2, year 3, year 4, year 5. Like that, lessee is paying lease rent over the years. Bring everything to the present value, that is year 0. Then automatically, whatever the present value, if it is equal to the fair value of leased asset, we also will be calling it as finance lease. Is it clear? In this context, you have to check the coverage to a minimum % of 90. And this is very, very important conditions for all the problems. So understood? How much minimum coverage? 90% coverage is needed. So, if at all this condition is satisfied, this is a finance lease. You may be asking me, sir, how this will be a finance lease? Sir, who is purchasing the asset? Lessor. Say lessor is purchasing the asset by paying 10 lakhs. And lessor had given this asset to lease to lessee. and over the period of 5 years, lessor is collecting some amount. If every amount is brought to the present value, it is something like 9,95,000. Is it clear? And indirectly, who is purchasing annattu? Indirectly, who is purchasing annattu? Lessee. So risk and reward should be borne only by lessee. And hence, this is the finance lease. So logic clear? Frankly speaking, who is purchasing? Lessor. But all the amount is collected just within a span of 5 years. So indirectly, lessee is purchasing, and hence this is a finance lease, because risk and rewards must be borne by lessee. And condition number 4, asset is of customized in nature and which could be used by lessee without major modifications. Use your common sense, amma. Lessor is not having any interest to manufacture the asset. Lessor is manufacturing only for lessee. But lessee is telling, sorry sir, I cannot purchase the asset, I am not having enough money. But I can take your asset on lease. Ante lessor is manufacturing the asset only for the purpose of lessee. Is my point clear? And hence, my dear children, conclusion. Who is manufacturing the asset? For whom is he manufacturing? So who has to use the asset? It cannot be used by anybody else, because it is customized in nature, and hence risk and reward should be borne only by. And the last and final condition, major economic life should be covered under lease term. Major economic life should be covered under lease term. Say for example, the total economic life of the asset is 30 years and you have provided it lease for 28 years. Is the major period covered or not? And for majority period, who is using the asset? So who has to bear the risk and rewards? Let's see. And hence it is a dash lease, amma, finance lease. In this point, the coverage should be a minimum of 75%. How much percent, amma? Sir, coverage 90%, coverage 75% were not given as per accounting standard number 19. These were inflected from Ind AS and we are discussing. Respond everybody clear. If any of these 5 conditions are satisfied, it is dash lease, amma. My dear children, the classification of lease should be done at the inception of the lease, and whatever classified at the inception of the lease, that is final. And you can't change it once again. Is it clear? So reclassification of lease permitted or not permitted? Reclassification of lease is not permitted. Even if it is a renewal lease, it is not permitted. But if old lease agreement is totally cancelled and if new lease agreement is entered, then you can classify it as a different lease. Sir, reclassification of lease permitted or not permitted? Not permitted. For renewal lease agreement, permitted or not permitted? Not permitted. But if you cancel the old lease agreement and if you have entered into the new lease agreement, can you classify it once again or not? Yes, that's your choice. Now, coming to 2 important definitions. Number 1, inception of lease. What do you mean by inception of lease? Date of signing the agreement or date of fixation of terms and conditions, whichever is earlier. Who has to sign the agreement? Lessor and lessee. They both, whatever the date that they have signed the agreement or date of fixation of terms and conditions, whichever is earlier can be considered as inception of lease. Shall I proceed further? Now, if any of the 5 conditions are satisfied, we will be calling it as finance lease. If all the 5 conditions are not satisfied, we will be calling it as operating lease. And now you are supposed to know what do you mean by MLP. MLP includes, MLP excludes. MLP includes lease rent, additional amount, bargain amount, GRV. MLP excludes repairs and maintenance, taxes, UGRV and contingent rent. Is it clear everybody? All these things, be careful. MLP includes lease rent, additional amount, bargain amount, GRV. MRP excludes repairs and maintenance, taxes, UGRV and contingent rent. First of all, what do you mean by lease rent? Over the period of time, how much ever lessee needs to pay to lessor, that is called as lease rent. What do you mean by additional amount? They are entering into the agreement. Every month you have to pay 1 lakh. In addition to that, after the completion of every year, you have to pay me additional 1 lakh. So additional amount is nothing but over and above lease rent. If you have written in that agreement, then we will be calling it as additional amount. But in our problems, no additional amount is there. Bargain amount. What do you mean by bargain amount? Did you remember condition number 2? At the inception of the lease, who should have option to purchase? And who should have reasonable certainty? At a price less than the fair value of leases. At a price antunavu kada, that price is nothing but bargain amount. And let us discuss about GRV. Now coming to exclusions. So if at all lessor is providing repairs and maintenance and lessee is paying amount to lessor towards repairs and maintenance. Who is paying? Lessee. To whom? Towards usage of asset or repairs and maintenance. And hence that is not included in MLP. In the same way, if any taxes were reimbursed, that is not included in MLP. And UGRV, let us discuss. Now be careful, contingent rent. Concentrate here and answer. Say for example, your asset is capable of producing 1 lakh units, but the permission is given to you only to produce 70,000 units. If at all in any point of time, if you are producing more than 70,000 units, then you are supposed to pay an additional rent of ₹10 per unit. Is it clear, everybody? What is this additional rent of 10 rupees? Is it additional amount or contingent rent? Question clear? Additional amount or contingent rent? Contingent rent. Because only if you produce, then we will pay. Rent which is depending on happening or non-happening of one or more uncertain events, we will call it as contingent rent. Rent which is depending on happening or non-happening of one or more uncertain events, we will be calling it as contingent rent. Additional amount and no contingency should be there. For sure you have to pay. Is it clear? Now in our material there is one more very good question, good point. Something like lease rent agreed is equal to, amount to be paid by lessee is equal to ₹1 lakh per annum plus 10% on sales amount. What is MLP? If sales for year 1 is equal to 50 lakhs, what is MLP? MLP is equal to 1 lakh. 1 lakh? MLP is equal to 1 lakh. Adenti sir, 10% of sales amount. Okay, but sales is uncertain. Only if sales happen, you will pay me. If sales or not happen, you don't pay me kada. So sale is contingent rent. Sale is contingent rent kadu. Amount collected on percentage of sales is contingent rent, and that is not to be included in MLP. Sir, is my point clear? Ante here 10% on sales ante your collection is depending on sales. That is an event. So that is a contingent rent, and hence MLP includes only 1 lakh. Respond everybody, clear? Now the next concept is all about residual value. Be careful, concentrate and answer. Sir, say for example the life of the asset is 30 years and you have given it for lease term up to 20 years. Residual value is the value accrued to the asset after 30 years or 20 years. Question adiganu. After 30 years or 20 years? After 30 years is correct as per AS 10. After 20 years is correct as per AS 19. So residual value as per AS 19 is value accrued to the asset after lease term. And the total residual value will be divided into two parts, GRV and UGRV. UGRV is the context for which lessee is not giving any guarantee. Guaranteed residual value ante, be careful, the guarantee can be given either by lessee or on behalf of lessee. This is GRV from lessee's point of view. If the guarantee is given by lessee or on behalf of lessee or any other independent third party, this is called as GRV from lessor's point of view. Is it clear? Now UGRV ante total residual value minus GRV is UGRV, which is not at all connected to lessee. This is connected only to lessor. Respond everybody, clear? Now the biggest point, accounting treatment. So now you have understood what is finance lease and what is operating lease. Now we have to start and continue with the accounting treatment. Sir, for the next 10 minutes or 5 minutes, be careful because we are going to deal with finance lease accounting treatment. Who is transferring asset to whom? What is a journal entry? Lessee account debtor to asset account. An entry in lessee books will become asset account debtor to lessor account. Shall I continue further? This has to be recorded at GIL, gross investment in lease. Antena? This has to be recorded with nil amma, which is net investment in lease. Mottam anta poinda. Sorry, listen. Sir, lessor has to recognize this entry in his books of accounts with net investment in lease. Net investment in lease is equal to gross investment in lease minus unearned finance income, where unearned finance income is equals to gross investment in lease minus present value of gross investment in lease. And gross investment in lease is equal to MLP plus UGRV. Respond everybody, clear? Sir, quickly answer me. Lessor needs to recognize a dash price amma. Net investment in lease. Net investment in lease is equal to gross investment in lease minus unearned finance income. Unearned finance income is equal to gross investment in lease minus present value of gross investment in lease. And gross investment in lease is equal to MLP plus UGRV. Shall I proceed further? And lessee needs to recognize the same at present value of MLP or fair value of leased asset, whichever is lower. Lessee needs to recognize it at present value of MLP or fair value of leased asset, whichever is lower. Shall I proceed further? Now, sir, for this purpose, you need to draft one table called recognition table. How the table will be, which is so simple, amma. Take the year and put the amounts and find the present value factor, which is nothing but IRR. I hope you know this one. And how to compute IRR, I am not concentrating. You just follow your FM concepts here. I am concentrating only on accounting part. Sir, if it is lessor, he has to use IRR. If he is lessee, he is having two options. Number one, IRR. Number two, IBR, incremental borrowing rate. But my dear children, that can be totally avoided. Sir, only one rate will be given in the question. Follow that rate for all the parties. Concept emante, lessor has to use IRR. Lessee can use IRR or IBR. But coming to problematic part, only one rate will be given in the question. Follow that rate whether for lessor or lessee. And finally, you will be getting present value in amount. Say for example, year 1 to year 5 is the lease period given, where you are going to collect lease rent, which is 1 lakh per annum. Say present value factor at the rate 10%. This is for 1 to 5 years kadamma. This is for 1 to 5 years kada. So you need to consider cumulative present value factor for 1 to 5 years, which is like 3.79, whatever. Andarki telisindadi. So and hence I have taken 10% and you will be getting some amount. Hey, respond everybody, clear? Be careful. In the 5th year, GRV, say GRV comes to 50,000, which is like 0.621. You will be getting some value. And my dear children, take care, huh? Lease rent plus GRV is nothing but MLP, where your total MLP, Jagratta, not 1 lakh plus 50,000. 1 lakh into 5 years. 5 lakh plus 50,000, which comes to 5.5 lakh. And here you are going to get present value of 5.5 lakh. Hey, is it clear? My dear children, even if you don't know, if you follow this format, it will become very easy for you. Now, one more important thing. After the completion of GRV for MLP, now add year 5 UGRV. Say UGRV comes to 30,000, 0.621, and you will be getting some amount here. And my dear children, MLP plus UGRV is nothing but GIL, gross investment in lease, which is 5,80,000. And you will be getting this one something like present value of gross investment in lease. Shall I continue? Sir, now in lessor books, you have to recognize at what price? Net investment in lease. Net investment in lease is nothing but gross investment in lease minus unearned finance income. Is it clear? Now unearned finance income is equal to gross investment in lease minus present value of gross investment in lease. Say for example, present value of gross investment is 5 lakhs anukondi. Now unearned finance income is equal to 5,80,000 minus 5 lakhs, which is nothing but 80,000, and net investment in lease is nothing but gross investment in lease, that is 5,80,000 minus unearned finance income, that is 80,000, which comes to 5 lakhs. So net investment in lease is nothing but 5 lakhs, which is obviously nothing but present value of gross investment in lease. But in the examination, you can't tell simply net investment in lease is present value of gross investment in lease and hence directly 5 lakh. You should not do like that. You have to show each and every computation clearly as per AS 19 and you have to record it at 5 lakhs. Respond everybody, clear? Now moving on to the lessee, you need to record it at present value of MLP or fair value of leased asset, whichever is lower. Say for example, the present value of MLP comes to 4,70,000. So 4,70,000 or compare it with fair value of leased asset, whichever is lower you need to record. Respond everybody, clear? Now the next one is all about every year how much finance income has to be recognized by lessor and every year how much finance charge has to be recognized by lessee. Is it clear? Every year how much finance income is to be recognized by lessor and how much finance charge has to be recognized by lessee. For this, I hope you know the concept computing present value table. You have to start lessor books with 5 lakhs. And you have to start lessee books with 4,70,000 and every year you have to apply the rate and you have to find the amortization part. Sir, is it clear? And hence you need to separate how much lease rent is paid by lessee. 1 lakh per annum. In our example 1 lakh per annum kada poindi ekkadiko. 1 lakh per annum lessee is paying. Am I correct or wrong? So start lessor books with 5 lakhs, start lessee books with 4.7 lakhs and every year 1 lakh is being paid separate principal plus interest. Even here also separate principal plus interest. Is the point clear? Sir, how much is paid by lessee to lessor? How much is paid by lessee to lessor? 1 lakh. But lessee finance charge is different, lessor finance income is different. Because lessor is starting his amount at 5 lakhs. Lessee will be starting at 4,70,000 and hence automatically internally it will differ. Respond clear? These two things you can do the table. I guess you can do the table. Am I correct or wrong? You will be putting something like 5 lakhs, year beginning, year ending, and principal repayment, interest portion, whatever you have done in FM, the same thing will be here also. Sir, frankly speaking, in AS 19, I'm not concentrating on FM related point of view. FM related point of view, computation of IRR and amortization table, that is separation of principal plus interest. I'm not concentrating on these two things. Respond everybody, clear? And my dear children, finance lease accounting treatment is over and now we need to start with operating lease. Coming to operating lease, lease rent paid by lessee to lessor may be different as per the agreements. I'm sorry. Lease rent paid by lessee to lessor may be fixed in the agreement. But how much lease rent has to be transferred to P&L account is totally different from amount exchanged between those parties. Let me tell you, say for example, lessor and lessee fixed that in year 1, year 2, year 3, they have decided to pay 10,000, 25,000 and 30,000. Is it clear? So how much lessee is paying in year 1? 10,000. Year 2? Year 3? But how much amount has to be transferred to P&L account will not be depending on this one. How much lease rent amount should be transferred to P&L account is depending on the systematic and rational basis. And the best basis for this one is method of depreciation. If no method is prescribed, you have to follow straight line method. How, sir? 10,000 plus 25,000 plus 30,000. What is the total lease rent? 65,000. So 65,000 divided by 3 years, which comes to 21,667. So now check out the journal entries. Who is paying to whom? Chapali, who is paying to whom? Lessee is paying to lessor. Anyways, listen. It's okay. Coming to the posh language. Fine. Listen. Total lease rent is 65,000, which has to be apportioned for 3 years, where you are getting 21,667. And how much cash is being received by lessor? Ante he is receiving 10,000 towards lease rent. Am I correct or wrong? But take care, my dear children. Your lease rent to be amortized is 21,667. Automatically, the balancing figure 11,667 has to be transferred to a special account called lease equalization account or DLR account, deferred lease rent account. That's of your choice. Respond everybody, clear. And immediately lease rent has to be transferred to P&L account 21,667. Respond everybody, clear. Sir, alternatively you can also write like this, Amma. First book some due entry. You have to receive it from lessee. Lessee account debtor to lease rent. You can book 10,000. Is it clear? After that, receive the amount from lessee. Cash or bank account debtor to lessee account. How much? 10,000. Is it clear? And then you need to close the lease rent. You need to close lease rent 10,000. But how much is to be transferred to P&L account? 21,667. The difference 11,667 has to be transferred to lease equalization account. These 3 entries which are followed in the institute material, but you can comfortably write even like this also. Respond everybody, clear. And my dear children, this is what your operating lease. But take care. I have told you basing on straight line method, but you may also follow production units method, which is there in our problems. Something like the total lease rent is 10,000 plus 25,000 plus 30,000, which becomes 65,000. Now you need to amortize 65,000 for all the lease term in proportion to production units. Respond everybody, clear? Now that is the end of operating lease. 2 important points, 2 important problematic points that I am going to tell you is all about. This is a very important model from accounting standard number 19, where if you have remembered in one of the self-practice problems or institute material problems, you are having 16,99,999.5. Gurtuleda. You will be having a question wherein in that question 16,99,999.5 will be there in the question, where I told you clearly, please don't round it off to 17 lakhs and you have to solve it as it is by taking the same amount only, because you can never modify the question. Anyways, what is this question, sir? Sir, in this type of questions lease rent will be missing. In every question he will be giving lease rent. If I was not wrong, for holding materials he had 1 anukunta. Lease rent will be missing in that question. How to find lease rent? Sir, be careful, huh? How to find lease rent if lease rent is missing in finance lease? First of all, you have to check out what is that called? FM concept enamma. Initial cash outlay. You have to find initial cash outlay. Gurtochinda? Like initial investment, which is nothing but fair value of leased asset minus present value of UGRV. And then you are going to get some amount which has to be divided by present value of lease term. Ardhamainda? You have to solve like this, then you are going to get lease rent per annum. Write it somewhere, it might helpful to you while solving the problem. And outright you can follow this one. If at all lease rent is missing, you can do like this. Present value of residual value. Fair value of leased asset minus present value of residual value whole divided by present value of lease term. Then you are going to get lease rent per annum. Is it clear? Further, if you have got lease rent, it is quite common again. Lease rent vacheste normal hai kada. So if you have got lease rent, you can comfortably normally compute everything. Now, one more small point. I have told you present value of residual value, but in all our institute material problems, there is only UGRV. But if GRV is available, you have to deduct both GRV and UGRV. But in all our institute material problems, you are only having UGRV. Respond everybody clear? Okay, this is one of the points where you have to be careful. And let me show you one more different question. You may not identify it actually. Yeah, this question. This is an institute material question. Many times it was tested. In several RTPs and several MTPs that question was tested. And what is the loophole in the question ante? Lessee had given a guarantee for 50,000. But lessor XYZ is estimating that the total residual value is only 35,000. Arthamainda? What is the total residual value? 35,000. What is GRV? 50,000. Ante GRV is more than the residual value. Is my point clear? So this is very typical where GRV is more than the residual value. Sir, then what to do in such case? No need to worry anything, because in this question he is asking only from lessee point of view. If he is asking only from lessee point of view, you need to consider only GRV kada. And hence you may not concentrate on this statement. So be careful. So since the question is asking only from lessee point of view, you need to consider GRV, which is 50,000. So no need to consider the 35,000 figure at all. Respond everybody clear? Okay. Sir, please don't ask me, sir, what if lessor point of view is given? Don't ask me, because even I don't know. Because such kind of thing is hypothetical. How is it practically possible that GRV is more than the total residual value? So in the examination, you will not get such kind of question at all. Sir, what if given? Ani meer adagachu. At that time, consider GRV is equal to 50,000, UGRV is equal to 0. Even though the total residual value is estimated at 35,000, but if he is asking from lessor point of view, consider GRV 50,000 and UGRV as 0, because there is no unguaranteed residual value. Respond everybody clear? Okay, now moving on to the last and final concept. One second. Even in one of the questions given in the institute material, operating lease also, he don't give lease rent. Even for operating lease also, he don't give you the lease rent. But if you have seen that problem, it is very, very clear. Sir, ardhamainda? If at all finance lease, if he is not giving lease rent, then I ask you to note down this one, because this is typical. But coming to operating lease, that is very easy. If you read the question, you will understand that. So now, no, not AS18. Frankly speaking, we are behind with AS18 for sure, because it will take around 10 to 15 minutes to complete one more important point in accounting standard number 19. That is, yes, sale and lease back, which will obviously take around 10 minutes to complete. Downline, your cooperation is highly appreciable. Sir, vintara? Vinamu anukunna tappadu. బయటకు వెళ్ళిపోండి అంట, మీరు ఎలాగో వెళ్ళరు. So let me start with the last and final concept, sale and lease back. My dear children, concentrate. Point number 1, A, B, two parties. A is selling his asset to B. A is selling his asset to B. So A is called as seller and B is called as buyer. And after the sale, again A is taking back the same asset from lease from B. So B is called as lessor and A is called as lessee. So the concept here is all about seller, lessee, buyer, lessor. Sir, frankly speaking, for lease, follow AS 19. For sale and purchase of asset, follow AS 10. Then what is so special in this concept? Only one special point in this concept is all about how to recognize profit or loss on sold asset. For this one, accounting standard number 19 is telling the answer. Now, if at all, the sale and lease back is a finance lease. Sale and lease back is a finance lease. Then automatically you are going to get some profit or loss at the time of selling. Whatever the profit or loss is there, amortize the profit or loss over lease term in proportion to depreciation or any other systematic and rational basis. Respond, is the provision clear? But in the examination, this is not important. Sale and lease back is operating lease is important. Shall I start now? If at all sale and lease back is an operating lease, then how to recognize the profit or loss? My dear children, remember, for sale and lease back is an operating lease, you actually need 3 components. How many components, Amma? 3 components. What are the 3 components? Number 1, selling price. Number 2, book value or WDV. Number 3, fair value. For Mommy. Okay. Listen. Amma. Echi. Listen. For finding profit or loss. For finding. Sir, ఒక్క నిమిషం. Sorry for the deviation. ఎవడైనా పీరియడ్ స్టార్టింగ్లో యాక్టివ్గా ఉంటాడు, పోయేటప్పుడు పడుకుంటారు. ఈరోజు మీరు ఫుల్ రివర్స్, వచ్చిన దగ్గర నుంచి పడుకునే ఉన్నారు. ఎక్సెప్ట్ ఇన్ దిస్ పార్ట్ ఆఫ్టర్ బ్రేక్ ఇది గట్టిగా తినొచ్చినట్టున్నారమ్మా. సరే, deviation over, come back. Fine. To find profit or loss, you need to check the difference between book value and selling price to find profit or loss. And how to recognize profit or loss, you need to check out selling price versus fair value. How to recognize profit or loss. Is the point clear? Hey, what are the 3 components needed, Amma? WDV, selling price, fair value. To find profit or loss, dash and dash. WDV and selling price or book value. To recognize profit or loss, dash and dash. Selling price and fair value. So now listen. If selling price is equal to fair value, if selling price is less than fair value, if selling price is greater than fair value. 3 conditions. But before applying these 3 conditions, you need to apply one more common condition. If book value is greater than fair value, bring down book value to fair value. The difference is nothing but loss, which is charged to P&L account immediately. This is common condition. And for any case, first of all, you have to check out this condition. If book value is greater than fair value, bring down book value to fair value, and the difference is nothing but loss, which is charged to P&L account. And then compare whether if it is selling price, and then find whether is it profit or loss. Now check out, if selling price is equal to fair value, profit or loss has to be immediately recognized. If selling price is less than fair value, check out whether is it profit or loss. If it is profit, immediately recognize. If it is loss, and if lease rent compensates, you need to amortize. If lease rent does not compensate, you need to immediately recognize. Sir, what do you mean by compensation of lease rent? Amma, sale lease rent interconnected individual. Sale and lease back kada. I am selling to you and I am taking the asset back to lease. If I sold at higher price, then I have to pay more lease rentals. Market value 10 lakhs. Market lease rent 1 lakh. But I am selling for 15 lakhs. So I have to pay 1.5 lakh lease rent. Sir, logic clear? If selling price is equal to fair value, no problem. If at all you are selling the asset more than the value, then lease rent will be more. If you are selling the asset at less than the fair value, then lease rent will be less. Hey, logic clear? Since we are selling at less than the fair value, your lease rent also should decrease kada. That is called as compensation of lease rent. If like that lease rent is compensated, it has to be amortized. If lease rent does not compensate, then you have to immediately recognize. Clear? Point number 1. Compensation. What do you mean by compensation? Throw it aside. Avsaram ledu. What is the rule, sir? If selling price is less than fair value, profit aithe immediately recognize, loss rent and loss aithe, if lease rent compensates, amortize. If lease rent does not compensate, immediately recognize. If selling price is greater than fair value, selling price up to fair value, immediately recognize. If selling in excess of fair value, that has to be amortized. Is it clear, everybody? Up to fair value, immediately recognize. In excess of fair value, amortize. Respond, everybody, pakka. Okay. Now, last example. Sir, concentrate. I will tell you in a very simple way how to solve this example. Something like, if you observe, book value is equal to 40 lakhs. And case 1, selling price is equal to 50 lakhs. And also fair value is equal to 50 lakhs. Sir, I told you the common condition. What is common condition? Book value is greater than fair value. What is the book value here? What is the fair value here? Is it greater than or not greater than? So common condition is not applicable. Shall I continue? To find profit or loss, these two things, am I correct or wrong? 40 is sold for 50. Profit or loss? How much is the profit? 10 lakhs profit. Now what to do? You have to check out the condition. Here check the condition. Selling price is equal to fair value. So this has to be immediately recognized. Respond, everybody, clear? Not concentrating on point number B, concentrating on point number C. Concentrate. 45, 38. Okay. Book value is equal to 40. Selling price is equal to 38. Fair value is equal to 45. First of all, apply the common condition. What is the common condition? Book value is greater than fair value. What is the book value? What is the fair value? Not greater than. So don't find. No need to apply common condition. Find the profit or loss. 40 sold for 38. 2 lakhs loss. How to recognize? Check the condition. Selling price is less than fair value. If selling price is less than fair value, profit aithe immediately recognize. But this is loss. So you have to write two things. If lease rent compensates, amortize. If lease rent does not compensate, immediately recognize. I hope even though the time is passed on, you might have felt easiness in solving this concept. Now, next one. 40, 50. Sir, fair value is equal to 40, book value is equal to 50, and selling price is equal to 50, book value 40. Start. Sir, so simple. If you write in this order, profit or loss? Profit. How much is profit? 10 lakhs. Is it clear? Now what is the condition, amma? Selling price is greater than fair value. 50 lakhs is greater than 40 lakhs. Am I correct or wrong? Simple ga chapta. Forget about the rules, etc. etc. Rule enti? Up to fair value, immediately recognize. In excess of fair value? In excess of fair value ante idega? That is like 50 minus 40. 10 lakhs. What is that? Amortize. So entire profit should be amortized. No immediate recognition at all. Is my point clear? And simply selling price in excess of fair value ante difference kada. that has to be amortized. So total 10 lakhs has to be amortized. Respond everybody, clear? Of course, even before solving this one also, you need to check out whether book value is greater than the fair value of not. It's not. And next one, 4650. What is the book value? 40. Selling price? 50. Fair value? 46. Now start everybody. Book value. 1 second. Let me make it clear. Selling price 50 lakhs and fair value 46. Start. Book value 40 lakhs is not greater than 46 lakhs. So even common condition is not applicable. Am I correct or wrong? Start everybody. Profit or loss? How much is profit? 10 lakhs profit. Condition cheppandi. Selling price is greater than fair value. How much is selling price? How much is fair value? In excess, how much is there? This has to be total profit. How much? Out of 10 lakh, how much has to be amortized? Balance, how much is there? Immediately recognized. Respond everybody, clear? And my dear children, the last and final point which is given, book value is again 40 lakhs, selling price fair value. Sir, this method what I told is very easy. Kakapote, you should write in this order. Then it will become easy for you. Sir, malli adi gurtu pettukovala. Em avasaram ledu. Compare between dash and dash. Book value and to find the profit or loss. Yes or no? And next one, a comparison to recognize profit or loss, selling price and fair value. Selling price gurtu pettukondi. It should be at between. Remaining is your choice. నువ్వు ఏది పైన రాసినా కింద రాసినా it doesn't matter కదా. So be careful. Anyways, the last and final one, selling price 39 and fair value 35. Start everybody. This time book value is greater than fair value. 40 lakhs is greater than 35 lakhs. Bring down 40 to 35. 5 lakhs is loss. Immediately recognize. Up to this clear everybody? And 40 minus 5. Now it had become 35. So you need to consider 35. Start everybody. 35 is sold for 39. How much profit? Start the condition. Selling price is greater than fair value. 39 is greater than 35. 4 lakhs. It has to be amortized. Total profit enta? Amortize the entire amount. Immediate recognition is 0. Hey, respond everybody, clear? So conclusion for this case, amma, for last case, conclusion, loss 5 lakhs, immediately recognize. Profit 4 lakhs, amortize. Respond everybody, clear? So finally, net loss entamma? 1 lakh. Ante originally 40 sold for 39. And the loss is 1 lakh. But 1 lakh loss should not be recognized directly. It has to be recognized like this. Respond everybody, clear? And my dear children, that is the end of accounting standard number 19. Cash flow statement, I'm sure you're going to get 7 marks if at all that question was missed. And then you will be getting a question in MCQ. Likewise, similar to buyback. So if buyback is asked, cash flow statement will be in descriptive. If cash flow statement is in MCQs, then buyback will be in descriptive. Most of the times in descriptive, cash flow statement he is going to ask, and that too indirect method. Okay, fine. So let's start with accounting standard number 11. Fine, my dear children, let us start advanced accounting marathon on day 4. Session 5, part 1 before break, wherein in this session let us complete accounting standard number 11, accounting standard number 28 and cash flow statement. And fine, let us start accounting standard number 11. My dear children, what is AS 11? The effect of changes in foreign exchange rates. If you are writing the standard name, please don't change the name of the standard. You have to write the name of the standard as it is itself. For any standard, name of the standard you can't change. I hope it's clear. What is AS 11, my dear children? The effect of changes in foreign exchange rates. Fine. So coming to the first part, that's all about scope. My dear children, accounting standard number 11 is applicable in three parts. Number one is foreign currency transactions, foreign currency operations, and forward exchange contracts. These are the three things for which accounting standard number 11 is applicable. My dear children, AS 11 is applicable for foreign currency transactions, foreign currency operations, forward exchange contracts. And be careful, something like the effect of changes in foreign exchange rates, as I've been telling, something like, say for example, a transaction is done in foreign currency. A transaction is done in foreign currency, but we are in India preparing the books of accounts in rupees, that is like Indian currency. So automatically whatever the transaction that is affected in foreign currency has to be converted to Indian currency or reporting currency. Am I correct or wrong? So this standard is going to deal with the conversion of foreign currency to reporting currency, but not from reporting currency to foreign currency. Is it clear, everybody? My dear children, this standard is dealing with the conversion of dash to dash, but not with dash and dash. Is it clear, everybody? So now moving on to the next thing, very, very important, listen carefully. This standard is not concentrating on which currency the books of accounts have to be prepared. This standard is not concentrating in which currency the books of accounts have to be prepared. The books of accounts have to be prepared in rupees or dollars or in any other foreign currency. No, this standard is not going to concentrate on all such aspects. But we know that since we people are living in, since our business is existed in, you have to generally prepare the books of accounts in rupees. If you're not preparing in rupees, then you're supposed to disclose why as per accounting standard number 11 itself. See, this is the irony. Standard is not telling in which currency you have to prepare the books of accounts. But if you are not preparing in rupees, you are supposed to disclose as per AS 11. You can't do anything because standard said that. Is it clear? Standard is not telling in which currency books of accounts have to be prepared. But if you are not preparing in Indian rupees, then you are supposed to disclose as per AS 11. Is it clear, everybody? And some other things like some portion of borrowing cost, which is some portion of foreign exchange, which is to be treated as per AS 16, follow AS 16. Some portion of foreign exchange which is to be dealt as per AS 3, follow AS 3. Respond, everybody, clear? Some portion of foreign exchanges which is to be dealt as per AS 3 and AS 16, respective standards will deal, but accounting standard number 11 will not deal with the same. Respond, everybody, clear? Sir, now listen very, very, very carefully. This is very important. Say for example, a business concern is preparing its books of accounts in dollars. A business concern is preparing its books of accounts in dollars. Is it clear? Now it would like to convert dollars into rupees. It would like to convert dollars into rupees. Answer for this is accounting standard number 11 applicable or not applicable? Please, is AS 11 applicable or not applicable? Those students who are watching on YouTube, if you know the answer, please do a comment like simply yes or no. My dear children, for this one, is accounting standard number 11 applicable or not applicable? Yes or no? No. Why no? Then sir, you said that accounting standard number 11 will be dealing with the conversion of foreign currency to reporting currency. But now you're telling something like dollar, which is a foreign currency, rupee, which is a reporting currency, and this standard is not applicable. Yes, my dear children, the rule why this is not applicable is all about here reporting currency is dollar, not rupees. But first of all, you must know then what is a reporting currency. So simple. Reporting currency. In which currency your books of accounts are prepared, that is called as reporting currency. In which currency books of accounts are prepared, that is called as dash currency, amma. Reporting currency. My dear children, please be careful. Accounting standard number 11 is applicable for conversion of foreign currency to reporting currency, but this is not applicable for the conversion of reporting currency to foreign currency. Respond everybody, is this part clear? Generally, what is reporting currency? Rupees. Generally, reporting currency is rupees. But there is a business concern which is reporting or preparing its books of accounts by using dollars. Now, what is the reporting currency of this business concern? Dollars. So, conversion of dollars to rupees is not possible in this context because dollars is the reporting currency, rupee is the foreign currency. Sir, then what do you mean by foreign currency, sir? Other than reporting currency, every currency is foreign currency. Other than reporting currency, every currency is foreign currency. Respond everybody, clear. And there may be a situations that even when you would like to convert dollar to rupees, then AS11 is not applicable, provided that dollar is a reporting currency. What do you mean by reporting currency? In which currency books of accounts are prepared, that is called as reporting currency. Foreign currency is the currency other than reporting currency. Respond everybody, clear. So now let me start with an important concept of accounting standard number 11, that is foreign currency transactions. My dear children, what do you mean by foreign currency transactions? Transactions which are denominated, that is occurred or settled in foreign currency, we will call it as foreign currency transaction. What is foreign currency transaction, amma? Please participate. What is foreign currency transactions? Transactions which denominated or settled in foreign currency. All those things are called as foreign currency transactions. Is it clear, everybody? Now, sir, if you are incurring a transaction, automatically you need to, you have done the transaction, so automatically you need to pass the journal entry, which is nothing but record in your books of accounts. So whenever the concept of recording is there, automatically two types of elements will come. Number one, initial recognition and measurement, subsequent recognition and measurement. Hey, tell me in which standards we have completed these concepts? Page 13, page 10. Initial recognition and measurement depending on modes of acquisition, but here nothing like that. Every initial recognition and measurement has to be recorded at spot rate. AS13, AS10, initial recognition and measurement is depending on modes of acquisition. Here such concept is not there. Whatever transaction you do, if it is like denominated in foreign currency or settled in foreign currency, it is called as foreign currency transaction, and AS11 is applicable, and it has to be recorded at spot rate irrespective of modes of acquisition. Whatever mode, I just don't care, it always should be recorded at dash rate, amma. Dash rate, amma, spot rate. Subsequent recognition and measurement, AS13 depends on classification, AS10 is depending on models, cost model, revaluation model. AS13 current investment, long term investment. Now AS11 subsequent and recognition and measurement is also depending on classification. And very important, subsequent recognition and measurement in this context is applicable only for assets and liabilities, but not for expenses and incomes. Subsequent recognition and measurement is applicable only for assets and liabilities, not applicable for expenses and incomes. My dear children, just concentrate. You might purchase goods on you might purchase goods which are denominated in foreign currency for cash. What is a journal entry? You are purchasing goods on cash in foreign currency. What is a journal entry? Purchases account debtor to cash or bank account. Am I correct or wrong? Sir, already you have done purchases and already you have done the payment. So is the concept of subsequent recognition and measurement arises or will not arise? Will not arise because purchase is an expense. Sir, subsequent recognition is a recognition where you will be doing as on the balance sheet dates or as at the end of the year. But something called purchases will be recorded only at the time of transaction and it will be closed and transferred to Chepali. Purchases is closed and transferred to P&L account and subsequently will it recorded or it is not recorded? It's not recorded. So, my dear children, subsequent recognition and measurement is applicable only for dash and dash. In other words, this is applicable only for balance sheet items. Dash items. Initial recognition and measurement is always recorded at dash value, dash rate, spot rate. Whereas coming to subsequent recognition and measurement, it has to be recorded at that is actually depending on classification, and this classification is applicable only for dash items. And all the balance sheet items are divided into two types, monetary items and non-monetary items. What are non-monetary items? Very simple. Non-monetary items are other than monetary items. Hey, what are non-monetary items? Now, sir, what are monetary items, sir? Be careful. Monetary items. Point number 1, money held. Hey, what is point number 1? Money includes both cash and cash equivalents. And next one, be careful everybody. I'll tell it to you in a very simple way. Check out whether if it is asset. Check out if there is receipt. Check out that receipt in cash or kind. Check out whether that cash is determinable in fixed terms or not. If all these 4 conditions are satisfied, it's a monetary item. Again, check out if it is a liability. Check out whether payment will be done. Check out whether payment will be in cash, and check out whether can it be fixed or not. Shall I start giving the examples? So point number 1, inventory. Is inventory an asset or not? From inventory, will you get receipt or not? Will that receipt be in cash or not? Can you tell fixed, like how much will you receive? Sir, inventory. In your books of accounts, you are showing it cost or NRV, whichever is lower. Say 100 or 120, whichever is lower, recorded at 100. Now tell me at what price this inventory will recover. Answer. Amma, if you sell inventory, how much amount will you get, Amma? Hey, exactly will you get 120? If some bargain happened, wouldn't you sell it at less than 100? Less than 120? Sir, cheppandamma. Yes, inventory is an asset, receipt, cash, but it's not fixed. How much will it get? It might fetch 100, it might fetch 120. Sir, conditions changed. 120 is becoming 80. What can you do? So fixed amount you can't receive. Ade take debtor. Is debtor asset or not? Cheppali. From debtor will you get receipt or not? Is that in cash or not? Is it fixed or not? Yes. He has to pay 100. 100 he has to pay. Sir, in future selling price is decreased. Shut up. Already sales done, right? So exactly is supposed to give that amount. Respond everybody clear. So like that you need to check out. Advance received from a customer. So debtor received an advance to you. Asset or liability? Cheppali. Yes, liability. Will you need to pay the liability or not? Yes. Will you pay it in cash? No. You will give goods to him. Advance received from a customer. In future you will sell goods to him. So prima facie this condition is not satisfied. So it is dash item, mama. Non-monetary item. You have taken a loan. Loan. Asset or liability? Will you have to pay or not? Will it be in amount or not? Fixed, can you tell or not? And hence it is a monetary. Sir, how much actually debtor will pay may differ. But we are not concentrating on the actual receipt. How much he has to pay, you have to concentrate. That is my point clear, huh? Okay. So be careful and answer me, okay? Debtors. 10 by 30, 2%. I hope you know the meaning of this one. What do you mean by 10 by 30, Amma? General credit period offered is 30 days. But if he is paying within, then how much discount offered? Is it clear, everybody? Now debtors is having this term, Amma. Now tell me, is debtor monetary or non-monetary? Monetary or non-monetary? Chapali. Okay. Let's crack the same. Debtors. Is it asset or not? Receipt or not? Will it be in cash or not? Is it fixed or not? Yes, it is fixed. If he is paying within 10 days, 2% discount, fixed. If he is not paying within 10 days, no 2% discount, even it is also fixed. That is what I told you. How much is the actual receipt? We don't bother on that. How much he has to pay? If he is paying within 10 days, then with 2% discount. If he is paying after 10 days, then no discount. Respond everybody clear. How much he is actually paying, we don't concentrate. Respond everybody clear. And my dear children, that is the end of monetary and non-monetary items. Prepaid expense. Prepaid expense, monetary or non-monetary? Before telling answer, you need to check out, is it an asset or not? From prepaid expense, will you have receipt or not? Of course, any asset you will be having receipt. But do you have receipt in cash? You will receive services. So under this condition is fail, and hence prepaid expense is dash item. What about outstanding expenses? Check charges called liability or not? Payment or not? In cash or not? Fixed or not? Yes. Dash item. There ends the matter. I hope you have clearly understood how to classify it. Aim ledu, check out these conditions. You will be getting it very clearly. Shall I continue? Hey, be careful, huh? There are some contraventions. I mean, there are some confusions. Confusion number 1, provision. Sir, if provision is reduction in asset, no need to tell that it is a monetary item at all. Because provision for bad debts is created in order to face the future. Provision for bad debt is created for what? To face future bad debts. Ante kada. And from provision for bad debt, do you have any outflow of cash? And hence outright it is not a monetary item. Is it clear? But be careful, huh? Provision for gratuity, yes, you have to pay. Provision for gratuity fund, yes, you have to pay. Provision for repairs and maintenance, yes, you have to pay. Provisions for warranty, yes, you have to pay. Provision for guarantee, yes, you have to pay. Point number 1, all these are assets or liabilities. And do you need to pay or not? Is it in fixed? Is it in rupees or not? Is it fixed or not fixed? Exactly how much you have to pay. Do you know that or you don't know? Answer. And hence these are non-monetary. Hey, how much will we come to know, Amma? Warranty provided 2% on sales. Can you give guarantee that exactly 2% on sales will be your warranty outflow? Answer. And hence monetary or non-monetary? Provision for gratuity. You are thinking you have to pay 1 lakh. But one of the employees retired now. One of the employees left the job. And is not having gratuity offer at all. Now no need to pay that amount kada. So all the provisions are generally exacta estimation. And hence automatically monetary or non-monetary. Is it clear? Now be careful. Provision for tax. Provision for tax. Monetary or non-monetary? Answer. Provision for tax, is it monetary or non-monetary? Monetary, huh? ఒక్క నిమిషం, ఇది వస్తే ఏదైనా చెప్పచ్చు. Provision for tax. Asset or liability? Do you need to pay or not? Is it in cash or not? Fixed or not fixed? Fixed or not fixed? Okay. Your profit fixed or not? Your profit. Oh, profit are not fixed. So you will be preparing P&L account in which profit is there. That is not exact amount. That's doubt. You are telling it's not fixed. I hope you have got my point. Sir, whatever profit you have prepared in P&L account, is it fixed profit? Doubt on that is there. Fixed. You will be taking that as base and you will be doing income tax adjustments and you will be finding what is net total income as per Income Tax Act. On that you need to pay tax. Am I correct or wrong? This tax is technically nothing but current tax. Did you remember or not? And other name for current tax is nothing but provision for tax. Is it clear? And hence obviously it is fixed and it is something like a monetary item. Is my point clear? So now let me tell you some things. Provision, which is in the nature of decrease in asset, like provision for bad debts, provision for depreciation. They are obviously non-monetary items. And all other provisions in the nature of liability, since they are just estimation, it may change in future and hence even this is also non-monetary item. Only provision for tax, or it is also called as current tax, is a monetary item. Respond everybody, clear? Now the biggest point. Okay sir, you are telling subsequent recognition and measurement is depending on classification. What is the classification given? Monetary items and non-monetary items. Initial recognition is recorded at dash rate, amma. Subsequent recognition and measurement, if it is monetary item, you need to record it at closing rate. If it is non-monetary item, check out whether the non-monetary item recorded at historical cost, fair value or realizable value. If it is old cost, old rate, spot rate. If it is recent value, new rate, that is closing rate. Respond everybody, clear? Old value, old rate, new value, new rate. Say for example, fixed assets, PPE. You are following revaluation model. Sir, PPE follow dash model. Point number 1, PPE monetary or non-monetary? Sir, participate quickly. PPE monetary or non-monetary? Non-monetary, because you don't know how much they'll exactly give you. PPE dash items, non-monetary. And you are following dash model. Ante you have to record it at fair value ane kada. So convert it at dash rate amma. Respond everybody, clear? Sir, inventory has to be recorded at dash or dash, whichever is dash. Cost or NRV, whichever is. Inventory dash item, monetary or non-monetary? If inventory is recorded at cost price, use spot rate. If inventory is recorded at fair value, use closing rate. Respond everybody, clear? Initial recognition dash rate amma. Subsequent recognition, sometimes it is spot rate, but majority times it is. And my dear children, if at all there is any difference between initial recognition and subsequent recognition, automatically the difference has to be transferred to either as profit or loss. Respond everybody, clear? Pakka. My dear children, almost FCT is completed, but let me tell you about each and everything. Sir, be careful. Assets and liabilities. Sir, initial recognition, everything has to be recorded at spot rate. Initial recognition, everything has to be recorded at spot rate. But coming to balance sheet items, assets and liabilities, monetary items have to be recorded at closing rate. Non-monetary recorded at historical cost has to be recorded at non-monetary at fair value or NRV has to be recorded at expenses and incomes. Use dash rate. Spot rate. Expense and incomes dash rate amma. exception. If they are in due course of business and occurring regularly, then you can use average rate. And there should be no greater fluctuations. If at all, expense and incomes are occurring due course of business regularly and more fluctuations or no fluctuations. No greater fluctuations. Then use dash rate, average rate. For all the problematic parts, you have to use average rate. For all the problematic part, use dash rate, average rate. Respond everybody, clear. Contingent assets and contingent liabilities, you need to use closing rate. Dash rate, exchange difference obviously should be transferred to P&L account. Respond everybody, clear. And my dear children, that is the end of FCT. Shall I proceed further? So everybody, and moving on to the next thing, that is all about FCO. There are two types of operations. Number one, integral foreign operation. Number two, non-integral foreign operation. Sir, integral foreign operation is dash on head office. Dependent or independent? Dependent on head office. Integral foreign operation is independent. Oh, integral foreign operation is dependent. Non-integral foreign operation is independent. Clear everybody? Sir, now integral foreign operation or non-integral foreign operation, first of all, it is a foreign currency operation. What is the difference between foreign currency transaction and foreign currency operation? Foreign currency transaction ante you are having some transactions with respect to the from the foreign country, ante which can be either denominated or settled. We might have some transactions, but foreign currency operation ante, be careful, you are having an establishment in foreign currency. You are having an establishment in foreign currency. That establishment can be branch. It can be warehouse. It can be your subsidiary company. It can be joint venture company. It can be associate company, or it can be your department, or it can be your consultant office. Anything. You are having an establishment in foreign country. Respond everybody, clear? Hey, if you are having some transactions, then those are called as foreign currency transaction. Please participate. If you are having some transactions, it is called as foreign currency transaction. But if you are having an establishment, that is called as foreign currency operation. Now you need to check out whether that establishment is depending on head office or not depending on head office. If at all it is depending on head office, we will call it as integral foreign operation. If it is not depending on head office, we will call it as non-integral foreign operation. Respond everybody, clear? And now moving on to the next thing. Sir, who is preparing the books of accounts of that establishment which is in foreign country? Sir, there is an establishment in foreign country kada. Who will prepare the books of accounts? Is it by head office or by the branch? Depends on integral or non-integral. If it is integral foreign operation, who will prepare the books of accounts? If it is non-integral foreign operation, who will prepare the books of accounts? Branch. My dear children, two types of branches. Inland branches and foreign branches. Inland branches are again divided into dependent and independent. Foreign are again divided into integral and non-integral. Respond. Dependent branch books of accounts are prepared by. Independent branch books of accounts are prepared by. Whether it is integral or non-integral, since it is foreign branch which is in foreign country, books of accounts are always prepared by the foreign branch itself. We have got the logic here. Whether it is integral foreign branch or non-integral foreign branch, books of accounts is always to be prepared by foreign branch only. Reason is so simple. You are in some other country. You have to follow the law of land in that foreign country. So if at all foreign country is asking you to give the books of accounts, report the books of accounts, foreign government is asking the establishment to pay the tax. Now the establishment is telling, sorry sir, I cannot. Because my books of accounts are prepared by head office. Since I am integral, I am dependent on the head office. Head office has to give me the order. Only then I will pay tax to you. In the meanwhile, there will be no branch. play with the Mottam government. Respond, is my point clear? So my dear children, be careful. If it is foreign currency operation, who has to prepare the books of accounts? Branch, that is FCO, head office. Sir, please participate. Who has to prepare the books of accounts of foreign currency operation? Branch or foreign currency operation, or simply establishment will prepare. Head office will never prepare. Respond everybody, clear? And my dear children, that foreign currency operation, whether integral or non-integral, it will prepare the books of accounts in foreign currency and it will send the trail balance to head office. Did you remember? Now the trail balance is in which currency? Now head office is preparing the books of accounts in which currency? So now head office needs to check out whether is it integral or non-integral, and it has to convert or it has to translate foreign currency trail balance into reporting currency trail balance. Is it clear everybody? Now concentrate carefully for all the problematic parts. For all the problematic, I'm straight away concentrating on problematic part. If at all it is your asset, opening asset aithe, you have to use opening rate. If it is closing asset, respond closing rate. If it is closing liability, closing rate. If it is opening liability, opening rate. Respond everybody, clear? My dear children, who is preparing the books of accounts? Who is preparing the books of accounts? Establishment, branch, foreign currency operation, and it is sending dash to head office, and trail balance is in dash currency, and now you need to convert that foreign currency into reporting currency. Whenever you are converting foreign currency into reporting currency, you have to use some exchange rate kada. So if it is opening asset, dash rate is used, opening rate, opening liability, dash rate, opening rate, closing asset, closing rate, closing liability. Respond up to this everybody, clear? Opening asset, opening liability, opening rates, closing assets, closing liability, closing rates. Now very, very important, my dear children. Be careful, exclusively PPE or fixed asset. If it is integral foreign operation, you have to use spot rate. If it is non-integral foreign operation, you have to use closing rate. Is it clear everybody? In PPE, integral foreign operation dash rate amma, spot rate, non-integral dash rate amma, closing rate. Respond everybody, clear? Reason is very simple, since it is a non-monetary item. Since it is a non-monetary item. Now moving on to the next thing, depreciation amma. Depreciation, whatever the rate that you are using for PPE, you have to use the same rate. Respond everybody, clear? Now expenses and incomes dash rate. Average rate. Expense and incomes dash rate amma, average rate. Be careful, one more important thing. Expense incurred exactly at the end of the year, like interest to be paid at the end of the year, or commission. Hey, did you remember commission managerial commission, which is on net profit, or interest exactly you are computing at the end of the year. Since these are computing at the end of the year, you need to use dash rate summa, closing rate. Respond everybody, clear? And very important, whatever are the transactions that are between head office and branch, whatever are the transactions that are between head office and branch, you should not convert anything amma, you have to use actual amounts. Is it clear? And last but not least, exchange difference. If it is integral foreign operation, exchange difference has to be transferred to P&L account. If it is non-integral foreign operation, exchange difference has to be transferred to FCTR. What is FCTR amma? Foreign currency translation reserve. Respond everybody, clear? Pakka? That's it, my dear children. So please remember only one thing. For foreign operations, who will be preparing the books of accounts? Establishment or foreign operation, and it will send dash to head office, and then trail balance has to be converted by head office from dash to dash, foreign currency to reporting currency. For that, if it is opening asset or opening liabilities, use Opening rate. Closing asset or closing liabilities, closing rate. PPE or fixed asset. Integral aithe spot rate, non-integral aithe closing rate. Even though depreciation is an expense, it has to be used with the rate that is used for PPE. Generally, all the expenses and incomes use dash rate, average rate. But if at all there is an expense or income which is computing at the end of the year exactly, for example, interest or commission, use dash rate, closing rate. Transactions between head office and branch, actual. Exchange difference of IFO should be transferred to, exchange difference of NFO should be transferred to FCTR. What is FCTR, amma? Foreign currency translation reserve. Respond everybody, pakka. And my dear children, that is the end of FCO. Shall I proceed further? In this context, there is a special point where you should not forget inventory. Yes, it's closing only. But in your question, both the cost price data is given and also NRV data is given. Is it clear? My dear children, be careful. One more additional clarification. IFO, NFO. If it is monetary item, IFO has to be recorded at closing rate. NFO has to be recorded at closing rate. If it is non-monetary item, recorded at fair value or NRV. IFO closing rate, NFO closing rate. Be careful. If non-monetary item recorded at historical cost, IFO will be using spot rate, but NFO will be using closing rate. And NFO aithe, whether it is asset or liability, whether it is monetary or non-monetary, everything has to be recorded at closing rate. But of course, opening assets will be used by converting opening rate. Sir, opening asset you can't use closing rate kadara. Hey, respond, is my point clear? Sir, for opening asset always dash rate, opening rate. But closing asset, closing liability low, NFO always you will be using closing rate. But IFO low, if it is non-monetary item recorded at historical cost, you need to use spot rate. Respond everybody, clear? In this connection, in one of the questions which is given in the examination, inventory, he will be giving something like cost price $1,000, NRV $800. And then be careful, he is also giving some rates. Since it is cost price, you obviously need to use something called spot rate. Since it is NRV, you obviously use something called closing rate. If spot rate is 50 and closing rate is 120, for example. Okay, na? Now, there are students who will be confusing for this one. Ela chestarante, some students, inventory is purchased from foreign country. So cost or NRV, whichever is lower. So that comes to $800. So it has to be recorded at $800 multiplied by, since this is a non-monetary item recorded at NRV, they need to use closing rate for conversion, that is 120. $800 into 120, how much? 90. So students will be outright writing it at 96,000. Respond everybody, clear? But that may not be correct. So then what to do, sir? Convert everything into Indian rupees first. Cost price 1000 into 50. You have to use, since it is recorded at historical cost, use spot rate. 1000 into 50, which comes to 50,000. NRV 96,000. Whichever is lower, 50,000. You need to record by using this one. Hey, respond, is it clear? Conclusion. Comparison should never be done by considering foreign currency. Convert everything into Indian currency and you need to compare the same, so that the problem will become very simple. Hey, respond everybody, clear? Even there are students who will be doing this adjustment wrongly, so please be careful. Never compare using foreign currency figures, compare using reporting currency figures. Respond everybody, pakka. My dear children, that is the end of FCO. Of course, still there is a concept of reclassification from IFO to NFO, NFO to IFO. That's not needed for exam and hence I'm not telling. Respond everybody, clear? Hey, now be careful, huh? Many students actually confuse a lot for this one, forward exchange contracts. Be careful. I'll be telling you straight away what is exactly needed for the exam. Forward exchange contracts are of two types. Number one is speculation. Number two is hedging. Hedging is to minimize the risk. Speculation is something like taking the risk. Speculation is done in order to gain some profits. Hedging is something done since there is a need of foreign currency. Is it clear, everybody? Sir, say for example, you are entering into a forward contract. Why are you entering? No reason, sir, just to make profits. Dash. Speculation. You are entering into a forward contract. Why are you entering? Sir, I have to pay after 3 months. After 3 months, I am unsure about the foreign currency. It may increase a lot in future. And hence, to minimize my risk, I am entering into this contract. This is Dashama hedging. Now, another question. I'm asking, why are you entering into forward contract? Sir, after 3 months, my debtor will pay me. In future, I was unsure how the foreign currency reacts. So, in order to minimize my risk, I am entering into a contract. This is dash hedging. I hope you have got enough clarity. So, please be careful. No reason, but even though you are entering into contract is called as, you are either having a receipt or you are either having a payment. Then it is called as hedging. Shall I continue? Speculation rules, very simple. Speculation rules ఏమంటే initial recognition to subsequent recognition to sale date, or initial recognition to sale date if everything happens in one financial year. Is my point clear? If everything happens in one financial year, what is the difference? What is the rule? Initial recognition to sale date. If it is happening in multiple financial years, what is the difference? Please answer. Initial recognition to subsequent recognition to sale date. Clear, everybody? Find the profit or loss and simply transfer the same to P&L account. Respond, everybody. Pakka. Okay. Say, for example, a question is like this. Mr. Rao entered into a forward contract at rupees 58 for $1, and at the end of the year $1 is equal to 59. Is it clear, everybody? And when he is selling in the next financial year, $1 is equal to 57. All these are relating to forward rates only. Is my point clear? Since that is speculation, you should never concentrate on spot rate. Never concentrate on. Sir, if it is speculation, don't concentrate on dash rate. You need to start your gameplay only with dash rates. Forward rates. Respond, everybody. Pakka. Let me show you a question for better understanding. Yes. Exactly. Check out, everybody. Mr. A, be careful. Mr. A bought a forward contract for 3 months on 1st December. Answer me, is there any need here? Amma, please participate. Amma, is there any need here? Now observe in this question. Rov Limited purchased a plant on some date which is payable after 3 months and hence entering into a forward contract. Is the need is there or not? So for Rov Limited, is it hedging or speculation? Hedging. And for Mr. A, is it hedging or speculation? Respond, everybody. Clear. If it is speculation, don't consider dash rate, spot rate. Consider only dash rate, forward rate. Now check out. Yes, Mr. A bought a forward contract for $1 lakh on 1st December at 47.10 when exchange rate was 47.02. And whenever the exchange rate is 47.02, A purchased a forward contract at 47.10. Now answer me in these two things, what is spot rate? 1 or 2? What is spot rate? 1 or 2? Shall I read once again? When the currency is trading at 47.02, Mr. A entered into a forward contract at 47.10. Is it clear? Now tell me what is 47.02? Spot rate, because that is trading at that price. And then entered into a contract at 47.10. Respond everybody, clear? Pakka. Sir, for speculation, I don't need dash rate. Cancel this one. I need only dash rate. That is 47.10. Hold on. Be careful. On 31st December, when he closed his books of accounts, the exchange rate was $1 is equal to 47.15. When he is closing his books of accounts, $1 is equal to 47.15. What is that rate? Closing rate. Hey, what is that rate? Closing rate. Now be careful, Be careful and concentrate. Mr. A entered into a 4-month contract on 1st December. Or something like Mr. A entered into a contract on 1st December, something that is given. Be careful. At the end of the year, when he is closing his books of accounts on 31/12/2019, $1 is trading somewhere at 47 rupees, where forward price for unexpired period. Forward price for unexpired period. If you have seen this kind of statement, then that is forward rate ani artham. Is my point clear? Now answer me. Here $1 is equal to 47.15 when he closed his books of accounts. So this is dash rate, closing rate. Ade if at all given like, when he closes his books of accounts on 31st December, the forward rate for unexpired period is 47.15 annad anuko. Then that is dash rate, forward rate. Is my point clear? And say for example, you have purchased it at 47.10. At the end of the year, say for example, your closing rate is 47.15 and your forward rate for unexpired period is 47.14. And in the next financial year, when you are selling, it is 47.19. Is my point clear? Is this hedging or speculation? Participate, So what is the rule, Initial recognition to subsequent recognition to sale date. Don't consider dash rates, spot rate. And hence 47.02 is not considered. Also closing rate on closing date spot hai kada. For that day, that rate spot hai kada. You don't need this rate also. So 47.10 to 47.14. Increase or decrease? Profit or loss? 0.04 multiplied by $1 lakh. 40,000 is the profit. Close and transfer to P&L account. From 47.14 to 47.19. 0.05 into $1 lakh, which comes to 5,000. 4,000, 5,000, and close and transfer the same to P&L account, which is nothing but profit. Respond everybody, clear? So rule is so simple. Be careful, once again I'm telling. If it is speculation, if it is, don't consider dash rates, spot rates, closing rates. Consider only dash rates. Rule is also very simple. Initial recognition to subsequent recognition to. If everything happens only in one financial year, initial recognition to sale date. Respond everybody, pakka. Now hedging. If it is hedging, what is the rule, sir? If it is hedging, rule is very, very simple, amma. Be careful once again, everybody. Premium or discount between spot rate and forward rate has to be amortized over contract period. Is my point clear, everybody? Dash or dash? So please participate. Dash or dash? Premium or discount between dash and dash, spot rate and forward rate has to be amortized over contract. Premium or discount between spot rate and forward rate. No. Premium or discount between spot rate and forward rate have to be amortized over the contract period. Respond everybody clear. Hey, be careful, huh? Sir, what do you mean by premium? What do you mean by discount? Premium ante? You can't tell premium is profit, discount is loss. Premium ante increase in price. Discount ante decrease in price. What do you mean by premium? What do you mean by discount? Decrease in price. Compare between dash and dash, amma. Spot and forward. Is it clear? Sir, be careful, huh? You need to check out whether is it payment or receipt. Payment premium aithe loss, because premium ante more kada. Payment discount aithe profit. Receipt premium aithe profit. Receipt discount aithe. That is how you need to decide. And you can't tell something like premium is profit and discount is loss. Respond everybody clear. So tell me the hedging rule, amma. Only one rule. What is that rule, amma? Premium or discount between spot and forward rate has to be amortized over the contract period. Shall I continue? Concentrate. This example. Rob Limited purchased a plant and hence entered into a forward contract. Answer me, this is dash. Hedging. Now take care, huh? Something like company entered into a forward contract at 49.15. And exchange rate per dollar on that date is 48.85. Is my point clear? What is forward rate? 49.15. What is spot rate? 48.85. Now compare spot rate and forward rate. 48.85 to 49.15. Premium or discount? Compare dash and dash, amma. Sir, participate. Compare dash and dash. Spot rate and forward. What is spot rate? 48 around. What is forward rate? 49 around. Premium or discount? There ends the matter. And payable after 3 months. Ante payment or receipt. So payment premium aithe profit or loss. There ends the matter. How much is the loss? Check out. $1 lakh into 49.15 minus 48.85. Cheppali. 30,000. And contract is for how many months, amma? 3 months. So amortize 30,000 for 3 months. Which comes to February 10,000, March 10,000. In the next financial year, April 10,000. And the previous financial year you have to write off 20,000. Next financial year you have to write off 10,000. I hope you have got enough clarity. Of course, exactly for solving the problems, and you just need to solve one more problem also. Please even concentrate on assignment, you will get it easily. So tell me, forward exchange contract, you need to check out whether is it speculation or if there is no need, then it is called as, if need and to minimize the risk, then you need to enter into. Clear everybody. Hedging only one rule. What is that rule, amma? Premium or discount between dash and dash has to be amortized over the contract period. Clear everybody. Can't tell premium is profit, discount is loss. Check out whether is it payment or, and then you have to decide. Respond everybody clear. And coming to speculation, my dear children, so simple. Don't consider spot rate. Don't consider closing rate. Consider only forward rates. Forward rates also initial recognition to subsequent recognition to sale date. If everything happens only in one financial year, initial recognition to sale date. Respond everybody pakka. My dear children, what are uncovered concepts of accounting standard number 11? Only two things not covered. Number one, reclassification from IFO to NFO, NFO to IFO, and paragraph number 46A is also not covered. Paragraph number 46A is also not covered. So be careful with these two things. Paragraph number 46A is applicable only for companies, and that is applicable only for LTFCMI. What is LTFCMI? Long term foreign currency, monetary item. And if you are doing a transaction, that should have a monetary item which should be denominated in foreign currency, and it should be for long term period. Long term ante greater than 12 months from the date of transaction, not from the year end. More than 12 months from the date of transaction. Respond everybody, clear? Now very important, if it is LTFCMI, then automatically if it is a company, it is having an option to follow paragraph number 46A. What is this telling, sir? My dear children, exchange difference is generally transferred to dash account. Sir, exchange difference is generally transferred to dash account, P&L account. But if it is LTFCMI, if this LTFCMI is relating to depreciable asset, then exchange difference will be transferred to PPE account instead of P&L account. If LTFCMI is relating to other than depreciable asset, then exchange difference will be transferred to FCMITD account instead of transferring to P&L account. Next important point. Whenever you are transferring exchange difference to PPE account, PPE account, if loss is there, it will be added to PPE. Profit aithe add to PPE kaadu, loss aithe. If it is loss, then you have to add it to PPE. If it is profit, you need to deduct from PPE. Adenti, sir. Sir, if loss, it is debited generally to P&L. If it is loss, it is generally debited to. But instead of debiting to P&L account, loss will be debited to PPE, and hence PPE value will increase. Sir, is PPE value changing because of exchange difference or not? And hence depreciation must be given a prospective effect. Dash effect has to be given a prospective effect. Last and final, whatever amount that is pooled in FCMITD account through exchange difference, that has to be amortized over the contract period. Whatever the amount of FCMITD account is there, that has to be amortized over the contract period. And my dear children, that is also the end of accounting standard number 11. Even covered paragraph number 46A also, but you need to apply the same. Check out the problems, and I did not cover reclassification. And my dear children, that is the end of accounting standard number 11. AS 28. Amma, what is AS 28, Amma? Impairment of losses or assets? Assets kada? Confusing me actually. What is AS 28, Amma? Impairment of assets. Sir, so simple. Listen. Current asset, Amma. First of all, what do you mean by impairment? Impairment is nothing but reduction in the value of asset. Sir, you might ask me, sir, depreciation is also decrease in the value of asset. Then what is the difference between impairment and depreciation? Only one thing, Amma. Depreciation, I will personally call it as healthy reduction. Personally, I will call depreciation as a healthy reduction, because you are using the asset for 1 year and you are telling that asset value has been reduced. You have used it for 1 year, you enjoyed the benefits, and you are telling value of the asset is reduced. But coming to impairment, this is reduction other than depreciation. Frankly speaking, a kind of unhealthy reduction. You will be comparing it with other sources and you are telling that my value of asset is decreased. And simply to tell you, impairment is nothing but other than depreciation. Reduction in the value of asset, but it is unhealthy. And frankly speaking, coming to impairment of assets, even current assets gets impaired. Even PPE also gets impaired. Even intangible assets also gets impaired. Impairment of current asset is actually dealt by accounting standard number 4. Accounting standard number 2. Hey, getting my point, everybody? to tell you, AS2 is dealing something with inventory, cost or NRV, whichever is lower. AS4, debtors impairment. You will create provision for bad debt provided if it is an adjustment event. Current investment or long-term investment, whatever is there, which is dealt by accounting standard number 13. Again here also simple, if at all the impairment is not dealt by any other standard, then this standard is going to take care. Generally this standard is going to deal with the impairment of PPE and impairment of intangible assets. Point number 1, provide impairment only when there are indicators. Provide impairment only when there are indicators. Indicators can be either external indicators or internal indicators. If you read the list, you will get it very, very easily. Now, how to find impairment of loss, sir? Whether it is PPE or whether it is intangible asset, find the cost price minus book value. Minus depreciation, accumulated depreciation. And you will be getting something called net book value. Compare this net book value with recoverable amount. What is recoverable amount, sir? Value in use or net selling price, whichever is higher. Right? Now, concentrate. Sir, what do you mean by value in use? Okay. What do you mean by value in use? Present value of future economic benefits. Then what will be included in future economic benefits? Every year by using the asset, you will get some cash inflows. That will be included in future economic benefits. And also at the end of the economic life of the asset, residual value also might be there. Even residual value is also included in future economic benefits. Respond everybody, clear? In future economic benefits, what all will be included, Amma? Every year cash inflows will be included, and at the end of economic life, residual value also shall be included. And by considering all those future economic benefits, bring everything to the present value, where we will be calling it as value in use. And moving on to the next thing, net selling price. So simple, selling price minus selling expenses is nothing but net selling price. So now recoverable amount is nothing but value in use or NSP, whichever is higher. Sir, what is the conclusion? Now you are having net book value with you. Now you are also having recoverable amount with you. If net book value is greater than recoverable amount, bring down net book value to recoverable amount. This difference is nothing but loss, which is technically impairment of loss, which has to be transferred to P&L account. Is it clear, everybody? Which has to be transferred to P&L account. If at all net book value is less than recoverable amount, no need to touch that at all. There's no impairment of loss there. Respond everybody, clear? Okay. Now coming to the next one, journal entries. My dear children, I'm not going to concentrate on CGU here. Top down test, bottom up test, goodwill, corporate asset, CGU, I'm not going to concentrate. Reason is so simple. You're not having a single problem on CGUs in your institute material. But you're having only one example given. So CGU concept you do with your own. I'm concentrating only on the important aspect of accounting standard number 28. That is these things itself. Now coming to journal entries. My dear children, if if impairment of loss is there, what is the entry? Impairment of loss account debtor to asset account, but generally you will be writing like accumulated impairment of loss account, or you will be creating a provision for impairment of loss account. Respond everybody, clear? And then this impairment of loss, listen very, very carefully, has to be closed and transferred to revaluation surplus if any revaluation surplus is already there. Hey, is my point clear? Did you remember something like subsequent downward of revaluation surplus? Generally, first time downward aithe you need to debit P&L account. Subsequent downward aithe, if RS is there, first of all you have to debit RS account and then balancing figure has to be transferred to P&L. Similar logic is applicable here also. If any revaluation surplus is there, first of all you have to debit revaluation surplus and then balance, if any is there, you have to transfer to P&L account, and of course you will be closing impairment of loss account. Respond everybody, clear? And this gets cancelled. So ultimately the journal entry is something like revaluation surplus if any, P&L account debt or balancing figure to accumulated impairment of loss account. And accumulated impairment of loss shall be shown as if it is a deduction from PPE. Respond everybody, clear? My dear children, this is what the journal entry relating to providing impairment of loss. Also, you may need to reverse the impairment of loss. At the time of reversal of impairment of loss, journal entry will be obviously reversed, where accumulated impairment of loss account debtor to, this is important, if you have debited RS, then you need to credit RS. If you have debited P&L account, then you need to credit P&L account. They respond everybody, clear? And previously whatever you have debited, the same has to be credited and reversed. They respond everybody, clear? And my dear children, this is what the journal entries relating to impairment of loss. Now I have one special problem to cover in impairment of loss. Sir, in this problem, what happened? Check out, huh? Various years were given and cash flows were also given. Residual value at the end of the year are also given. So frankly speaking, all these things are cash inflows where you can comfortably apply present value and you can bring it to the year 0 or whatever at that year, and you can happily find value in use. And also if you observe, net selling price is also directly given. Then what is so special in this problem? The biggest problem with this problem is all about book value is not clearly given. Book value is not clearly given. Okay, sir, let us find book value by providing the depreciation. Life period is not given. Okay, 8 years is given. Okay, how many years completed is not there. And if you observe, PPA purchased on 1/1 something, 2000 something, say for example it is 2000, 1/1/2000 for 40,000 lakhs, useful life is 8 years. Okay, so 40,000 divided by 8 years. Of course, residual value is there. So 40,000 minus 1,000 divided by 8 years, which comes to 4875 per annum is the depreciation. But how many years like that you have to provide? Hey, is my point clear? For how many years like that you have to provide? That is the biggest point anamata. That data is not clearly available. So ఇప్పుడు మీరేం చేయాలంటే you have to work back. How to work back, sir? What is the asset life period, amma? So last year is 2016, which is 8, 7, 6, 5, 4. And frankly speaking, asset is totally used for how many years, amma? 3 years. Hey, respond everybody, clear? Asset is totally used for how many years, amma? 3 years. Because if you observe cash flows relating to PPE on 31/12/2011 is given. Hey, is my point clear? Which is nothing but the 3rd year. Respond. And that is the hardest logic in this question. Question is so simple. Question is so simple. Net book value is there, depreciation is there, value in use you can comfortably compute. But for how many years you have to provide depreciation, that is not clearly available. But given since the asset life is 8 years, you need to work back everything. Respond everybody, clear? So with that you need to compute this problem. And I have one more important thing to tell you. See here, into 3, totally 3 years anukunnam kada. I mean like from 4th year it was given until up to 3 years you need to provide the depreciation. So into 3, that is depreciation. And one more important thing, this one. Concentrate carefully everybody. G Limited acquired a machine for 7 crores with an estimated life of 7 years. and machine is depreciated on SLM basis, no residual value. And 7 crore divided by 7 years, which is nothing but 1 crore per annum is a depreciation. On 1/4/2014 anta. From 2011 1/4 to 2014 1/4 ante 10 11 11 12 12 13 13 14 4 years totally completed. Ante 1 crore per annum into 4 years, where 4 crores is a depreciation. So 7 crores minus 4 crores, 3 crores is the book value. Now be careful, huh? The carrying value of the machine is reassessed to 5.1 crores and the surplus arising is credited to revaluation reserve. What is the book value? What is the revalued figure? So revaluation upward, how much is done? So what is the journal entry for that? Hey, revaluation upward, ra? Asset account debtor to revaluation surplus account. How much is that, amma? 2.1 crore. Revaluation surplus. Now the next one. What would be the revised depreciation? Chuddam. For the year ending 31st March 2016, there is impairment and the machine could fetch only 79 lakhs as recoverable amount. Sir, sir chudandi. Year ending 31st March 2016. Yes, 31st March 2016. Sir, just concentrate carefully. Already how many years completed, amma? 4 years. Still how many years are left out, amma? So 5.1 crore divided by 3 years. Sir, ante kada. What is the revised depreciation after revaluation? 1.7 crore. Because you need to give prospective effect for depreciation. Am I correct or wrong? So like this, how many years completed? Ante 2 years completed. If I was not wrong, because the revaluation is done on 2014 kada. So 14, 15, 15, 16. 2 more years completed. So which comes to 3.4 crores. Check out what happened. Originally 7 crores. 4 crores depreciation. 3 crores balance. 2.1 upward revaluation. 5.1 crores revised value. Minus 3.4 crores depreciation. Which comes to? Now the recoverable value is only 79 lakhs. And which is 0.79 crores. So how much is the impairment of loss? 0.95 crores. That is 95 lakhs is the impairment of loss. Antena? 90. So 91 lakhs is the impairment of loss. Respond everybody, clear? Shall we start writing the journal entry for 91 lakhs? Sir, tell me the entry for 91 lakhs. Impairment of loss account debtor to accumulated impairment of loss account 91 lakhs. And close this impairment of loss. Since you are having revaluation surplus to the extent of 2.1 crore, you have to use that. And to impairment of loss 91 lakhs. Respond everybody, clear? But there is a biggest task in this problem, that is all about this company is having a policy of writing down the revaluation surplus by the increased charge of depreciation resulting from revaluation. What is the meaning of this one, sir? Did you remember while telling AS10 I told you to close revaluation surplus you are having 2 options. Option 1, entire revaluation surplus is transferred only to general reserve at the time of sale. Option 2, every year revaluation surplus will be closed to P&L account in proportion to depreciation. Gurtunda? Even I told you in marathon class also. Now company is having a policy to write off revaluation surplus every year. Ante how to do it, sir? What is revaluation surplus? 2.1 crore divided by how many years left out? 3 years. Ante every year you need to write off 0.7 crores. So 2.1 crore minus 2 years completed. 1.4 crores. So the balance is 0.7 crores. That is 70 lakhs. But how much impairment of loss you need to provide? Now tell me the journal entry. Revaluation surplus account debtor 70 lakhs. P&L account debtor 21 lakhs to accumulated impairment of loss account 91 lakhs. Hey, respond everybody clear. Huh? I've written a direct entry. If you would wish to write, it will be like this. And on top another entry, impairment of loss to accumulated impairment of loss 91 lakhs. Respond everybody pakka. And these are the two special points I actually would like to cover from AS 28. And my dear children, AS 28 is completed. So let me start with the next concept, that is all about cash flow statements. And my dear children, coming to cash flow statements, this is a reconciliation statement where it includes the reconciliation of opening and closing balances of cash and cash equivalents. Cash flow statement is a reconciliation of opening and closing balances of cash and cash equivalents. Everything will be included. Then what includes in cash, sir? Of course, cash and bank will be included in cash. Sir, even bank is also included in cash itself, including foreign currency. And coming to cash equivalents are in the form of investments. Cash equivalents are in the form of investments for a short-term period, which are highly liquidable and with negligible amount of risk. With negligible risk. What do you mean by this one, sir? So concentrate. Point number one, they should be in the form of investments. And it is for short-term period. Short-term ante generally less than or equal to 12 months, but in this context it is less than or equal to 3 months. As per accounting standard number 3, it is less than or equal to 3 months. Highly liquidable, which implies that easily convertible into cash. Everything, whatever cash equivalent is there, it is easily convertible into cash with negligible risk. And even though it is in the form of investment, there is no risk at all for that. Respond everybody clear. So tell me, what's a cash flow statement, my dear children? Investments, they are in the form of investments, period. Short term, until less than or equal to 3 months. And highly liquidable with more amount of risk and negligible risk. Or it is also called as insignificant risk. Respond everybody clear. Generally, all money market securities are cash equivalents only. Money market securities ante commercial papers, 91 days T-bills, treasury bills, certificate of deposits, all money market securities generally which are under the government under or cash equivalents. And be careful, preference shares or debentures having a maturity period less than or equal to 3 months, which are not actively traded, also will be coming under cash equivalents. Because preference shares and debentures, point number one, even if they are actively trading, then in stock market fluctuation of price will be more. So they should not be actively traded, and if at all the maturity period is less than or equal to 3 months, then automatically even those things also will be included in cash equivalents. And problematic language law, all marketable securities are considered as cash equivalents. In dash language, problematic language, he will be giving marketable securities. All marketable securities are considered as cash equivalents. Respond everybody clear. And now coming to the classification of activities, sir, frankly speaking, in cash flow statement, concept is very less. Application problems are actually more. So please be careful. Now, coming to cash flow statement, there are 3 types of activities: operating activities, investing activities, financing activities. There are specific definitions as per cash flow statement, but frankly speaking, definitions are not needed for the examination. Identification of activity is needed for the exam. So let me start how to identify the activity. If it is relating to goods, if it is relating to due course of business, then automatically it is operating activity. If it is relating to purchase and sale, it is called as operating activity. If at all that is relating to investment or fixed assets, and which can be either tangible or intangible, we will be calling it as investment activity. If it is relating to loans and capital, it will be called as financing activities. Respond everybody clear. Now in this context, let me tell you some important things. Important, I'm not concentrating on everything. What is rent received? Rent received dash activity. Investing activity, because you will receive rent only on investment property, that is land and building. Rent paid is dash activity. Operating activity, because that is daily activity connected to business. Commission received, commission paid, operating activity, because that is quite common. Be careful. Interest received, investing activity, because you will receive the interest on investments. Or dividend received is also investment activity, because you will receive it on shares. And the next one, interest paid or dividend paid, financing activity, because you will be paying on capital. Respond everybody clear. Or you will be paying on loans, and hence since they are financing activity, these are also financing activity. Respond everybody clear. And yes, these are some important things. And coming to some other things, be careful. Tax paid, if nothing is mentioned, you will be paying tax on profit. Profit is generally from sale of good, and hence it is operating activity. Be careful. Capital gains tax paid, dash activity, investing activity, because you will be paying capital gains tax only on sale of asset profit. So sale of asset is an investment activity. CG tax is also investing activity. Be careful. TDS on interest received, dash. Of course investing, but it's non-cash. But you should not call it as non-cash. As per accounting standard number 3, that's investing activity only. Then sir, how? Be careful. Say for example, you have to get a total interest of 100, but you are receiving only 90. And another 10 rupees is TDS deducted on interest receivable, that is 10. So if you write this entry, cash or bank account debtor to interest account 90, TDS receivable account debtor to interest account 90, sorry 10. And TDS receivable is cash item or non-cash item? Participate. Frankly speaking, it's a non-cash item, but AS3 is not telling like that, since it is relating to interest income, which is investing activity. This is also investing activity. Respond everybody clear. One more important thing, loss on sale of asset, dash activity. Investing activity, non-cash. Investing activity, non-cash, because loss on sale of investment will not be received in cash kada. Is it clear? 100 rupees asset sold for 90 and 10 loss, dash activity, investing. But cash or non-cash? Non-cash. Be careful. Respond everybody clear. Profit on sale of asset, that's normally investing activity. Is it understood? Some other special items to discuss. Drawings. Correct. Financing activity, because drawings is something which is causing the difference of capital minus drawings, and hence it's a financing activity. Be careful. Grant received. Answer. Listen. Grant received, you can't classify the activity. You need to tell for what purpose you have received the grant. If grant is received for the purpose of employees in the due course of business, since it is a revenue grant, it should be treated as operating activity. If it is relating to purchase of asset, then it is investing activity. Clear everybody? Hey, be careful. Loan taken for working capital purpose. Financing. For whatever purpose you take the loan, that is always a financing. Don't confuse. That's the reason I told you. If you have received the grant, then obviously you need the purpose. And you have to classify the activity as per purpose. But loan taken, irrespective for what purpose you are spending, it is always a financing activity. And also, grant received with no purpose mentioned in the question, that is also to be treated as financing activity. Respond everybody clear? Okay. Next, depreciation. dash activity. Depreciation, non-cash item, no activity should be classified. And amortization, non-cash. Bad debts, non-cash. Sir, understood? All these things you should not classify the activity at all. Be careful. Shall I proceed further? And donations paid. Donations paid, dash activity. Lottery won or lottery tickets purchased. Lottery investment. Lottery is not investment. Lottery ticket is not investment. Hardly 10 rupees. Sir, all this comes under operating activities, which is nothing but residuary items. Those items which cannot be classified as operating, investing, financing should be under operating activities. Respond everybody, clear? And my dear children, these are some of the special items that I told you. And please be careful. One more important thing. Bank overdraft. Bank overdraft is a financing activity if he is asking you to classify as an activity. But while doing the problems, no need to put bank overdraft in financing activity. Sir, be careful, huh? Opening balance of cash and cash equivalents, plus or minus operating activities, plus or minus financing activities, plus or minus investing activities. If at all you have got negative. If at all you have got negative, what is that called as? Bank overdraft. Am I correct or wrong? So please be careful, my dear children. If at all he had given an MCQ question, what is the bank overdraft as per AS3, classify the activity. You have to tell it as a financing activity. But while doing the problems, no need to consider bank overdraft under financing activity at all. Once at all, if you have done the overall problem, if you are getting a negative figure, that itself will be representing a bank overdraft and it will automatically get adjusted. Respond everybody, clear? Now very very important, be careful. And a new adjustment anamata. Say for example, opening cash and cash equivalents $1,000 plus 1 lakh. Closing cash and cash equivalents $1,000 plus 1.5 lakh. Now you have taken opening rate $1 is equal to 80 and $1 is equal to 82. Is my point clear? So frankly speaking, my dear children, opening balance will become 80,000 plus 1 lakh. Respond. Now be careful. Huh? If you have done plus or minus operating activities, plus or minus investing activities, plus or minus financing activities, then you will be getting something like 80,000 plus 1.5 lakhs. Am I correct or wrong? Because this 80,000 is $1,000 kada. Respond, that $1,000 opening is also same, closing is also same. And hence if you have done all these adjustments, you will be getting something like 80,000 plus 1.5 lakh. So this is matching. But the issue is here, opening is 80 and hence 80,000. Closing is 82 and hence it should be 82 kada. Then how to adjust? Is my point clear? Generally, what are you supposed to do ante? What is it called? Opening balance of cash and cash equivalents. You will be writing like 80,000 plus 1 lakh plus or minus net cash flows changes during the year. You will be putting something and then you will be getting something like 80,000 plus 1.5 lakh. Now here add unrealized gain in foreign currency which comes to 2,000 and hence it will become 82,000 plus 1.5 lakh. Respond everybody, clear? You may ask me, my dear children, sir, why you told that much advanced in marathon class? Sir, some points, even though they are advanced, I will be concentrating on marathon because in examination you might get something peculiar. If he would like to block, this is his pick to block. And there may be many other options. This is one of the different points. Even me gurtunattlaithe in the recent examinations, the previous attempt, what is the previous attempt? September. That previous attempt something like May. If I was not wrong, he had included deferred tax asset concept in cash flow statement. DTA concept in cash flow statement he had included. Is my point clear? So please be careful. Okay. Now moving on to the next thing. Direct method, indirect method. Since there are two methods as per AS3, one is direct method and the other is indirect method. Direct method is super easy, amma. Frankly speaking, direct method is super easy, provided when cash book is given. Because if cash book is given, simply classify the activities: investing activities, operating activities, financing activities, opening balance changes, then you will be getting closing balance very easily. Obviously, no doubt at all in that. But when cash book data is not given, when P&L account data is given, when some raw information is given, you need to convert everything into cash and then you have to prepare direct method. మీకు గుర్తున్నట్లయితే in one problem he will be giving summary of cash book directly. He will be giving summary of cash book directly, super easy. But in the next problem he will be giving P&L account and he will be giving relevant balance sheet information. Did you remember? And for your kind information, in P&L account sales is there. In relevant balance sheet information, debtors opening and debtors closing is there. So now you need to find how much is cash sales and include, and how much is credit sales and you should not include. For this purpose you need to draft debtors account, opening, closing, sales. You will be getting a balancing figure collection. This has to be included in operating activities. Like that even you are supposed to do with creditors account also. Hey, respond everybody clear? Whenever you have drafted creditors account, you will be getting amount paid to creditors. Hey, respond everybody pakka. And my dear children, in that context, whenever cash book information is not given, like this if it is given, you have to draft accounts. And one more important thing, expense incurred is there in P&L account. But to consider it in cash book direct method, you have to find expense paid and you have to convert incurred to paid. And frankly speaking, converting of income and expenditure to receipts and payments account. Is my point clear? In one of the problems, that's the reason you will be doing reverse working. Meeku gurtunte expenses incurred. Sir, frankly speaking, expenses paid. For that you need to add current year outstanding minus last year outstanding, add last year prepaid expense and minus current year prepaid expense, and then you are going to get expense incurred. But in that problem this figure is given, you have to find this one and everything will be reverse working. Hey, respond everybody clear? In that problem itself, if you have remembered one more important point, advance tax is given. You will be given with two things, provision for tax is third, advance tax is also given. What is the meaning and how to crack this one, sir? Last year, current year, if I was not wrong, 180, 180, 195 and 190. Hey, is my point clear? No, let me something like 190 and 195. Whatever is that, let's not care about it. Now concentrate carefully everybody. First, what will you pay? Provision for tax or advance tax? Sir, in an year, first what will you pay? Provision for tax or advance tax? Advance tax. Last year, how much advance tax you have paid? How much is actual last year tax? Everything is equal and hence no problem. Now come to current year. Current year, how much you are supposed to pay? But how much you have already paid? Shortage, how much is there? That 5 will be paid in the next year. But current year, how much is tax paid? Current year, how much is tax paid? 190 is the tax paid. Respond everybody clear? Hey, now be careful. I'm just modifying the figures here. 190 or something like 200 అనుకుందాం. Start everybody. Last year, how much I have already paid? But how much I am supposed to pay? So how much still I have to pay? That 20 will be paid in which year? Current year I have to pay 20 last year tax, and also current year advance tax I have paid 190. So total tax paid in current year is 210. Respond everybody, clear? Like this you are supposed to crack. Be careful. And next one. Sir, if at all refund of income tax is there, it is dash activity. Refund of income tax, dash activity. Operating activity, remember. Refund of income tax is an operating activity. Respond everybody, clear? Okay, and of course that's the end of another adjustment. So whenever advance tax is given, that is an adjustment you are supposed to do. Shall I proceed further? Okay, now moving on to the next one. If at all you have observed in one more problem, some other kinds of adjustments you will be getting. He will be telling a point that goods are sold only for cash. And GP is equal to 3,92,500. And GP is something like 20% on sales entered. Is it clear? So from this you will be getting sales. And sales is totally done for cash. Obviously no problem. Cash sales will obviously included in the cash flow statement direct method. Respond everybody, clear? But in that question he will not tell how about purchases. Whether is it cash purchase or credit purchase. The data is not given. So you need to assume that it is cash. And creditors is given in the question. Is my point clear? Be careful. In that question, purchase, cash or creditor, no data is given. But he will be giving creditors information. Ela istadante amount payable to trade payables exceed closing 10,000 by opening. Sir, gurtochinda? He will be giving you the difference between opening and closing in one problem. In that problem, he is not asking whether the purchases is done on cash or credit, no data is given. But in that problem, my dear children, be careful. Opening stock and closing stock difference is given. Sales you will be getting if you have found out. GP is directly given. Even wages is also given. So automatically you will be getting a balancing figure called purchases. Respond everybody, clear? And if you observe in that problem, you are having every data to prepare a trading account. And from trading account, you will be getting purchases as balancing figure. And also in the same problem, you are having every data to prepare creditors account. Like he had given the difference between opening and closing and also amount paid to creditors. Even here also you are getting one purchases as balancing figure. Now in trading account, purchase balancing figure will be representing total purchases. And in creditors account, whatever the purchases that is representing credit purchases. Difference between total purchases and credit purchases is cash purchases. Be careful. So this is the adjustment, one more adjustment which is typical. Be careful. Shall I proceed further? And one more important thing, whenever net profit is given in the question and after tax or before tax, if it is not given, it is always after tax. Because net profit and profit as per P&L account. In P&L account, you will be net profit, getting net profit only after charging provision for tax. Kada. So net profit, if nothing is mentioned, it is always after tax. Respond everybody, clear? And my dear children, frankly speaking, direct method is that's it. And important things in direct method, in operating activities and investing activities, you need to disclose something separately. Coming to operating activities, disclose extraordinary items separately and tax paid separately. Coming to investment activities, you need to disclose extraordinary activities separately. Respond everybody, clear? And coming to operating activities, it is also recommended to disclose exceptional items separately, even though it was not given in the standard. Ante in standard he is not telling you specifically concentrate and disclose exceptional item. Extraordinary is mandatory. And a stock loss by fire and insurance claim received, that's an extraordinary item, disclose separately. Tax paid, you need to disclose separately. But exceptional item, for example, voluntary retirement compensation amount paid, that is an exceptional item. If at all such kind of items are there, recommended to disclose separately, even exceptional, not only extraordinary. Respond everybody, clear? And now coming to indirect method. Coming to indirect method, sir, financing activities and investing activities are super easy because simply you will be adding the inflows and you will be deducting the outflows. The real problem is only with the operating activities. Concentrate on operating activities with respect to indirect method. My dear children, you need to consider net profit before tax. To find net profit before tax, you first of all need to consider net profit after appropriation, which is the difference between opening P&L account and closing P&L account. Then you will be getting net profit after appropriation. If closing is 1 lakh and opening is 60,000, automatically current year profit after appropriation comes to 40,000. Respond everybody, clear? For this 40,000, you need to add 2 appropriations. Very, very important. For cash flow statement, only 2 appropriations. Number 1, transfer to reserves and surplus. Number 2, dividend declared. Hey, what are the 2 appropriations? Sometimes in question, if you observe, you will be having general reserve also. General reserve opening is 1 lakh, closing is 1,20,000. And 20,000 increase during the year. From what it will increase? How general reserve will increase, ma? By transferring profits. And automatically 20,000 profit hai kada. So you need to add back transfer to reserves and surplus. Take net profit after appropriation and identify if any reserves and surplus are increased, then transfer to reserves and surplus is also to be added. Clear? Be careful and answer. Opening capital reserve 0, closing capital reserve 1 lakh, and this 1 lakh capital reserve is booked in the books of accounts from profit on sale of land. What is opening? Closing capital reserve? Profit from sale of land. Now is this 1 lakh added to find profit? Not added. Not added because this 1 lakh is not transferred from P&L account. Is the point clear? You need to add back transfer to reserves and surplus, those items which are transferred from P&L account. And then dividend declared, if it is declared from P&L account, you just need to add it back. And then you are going to get net profit after tax. For that, you just need to add provision for tax, and then you are going to get something called net profit before tax. Respond everybody, clear? Net profit after appropriation, add back all the transfer to reserves and surplus from P&L, add back all the dividend declared, and add back all the provision for tax. Then you are going to get net profit before tax. Respond everybody, clear? Now start with the real adjustments. You need to consider P&L account and you are converting it into cash flows from operating activities. Am I correct or wrong? So net profit before tax is available in dash account. Net profit before tax is available in which account? P&L account. Please participate everybody. Net profit before tax is available in which account? P&L account. Is it clear? But my dear children, your aim is to convert P&L account or net profit to cash flows from operating activities. Point number 1. Net profit is a combination of cash and non-cash items. You need only dash items. You don't need dash items. Eliminate all the non-cash items. Non-cash expenses will be eliminated by adding and non-cash incomes will be eliminated by deducting. Example, depreciation and amortization. Non-cash incomes example, capital grant amortized. Capital grant amortized. Government had given a grant of 1 lakh towards purchase of asset and companies following deferred income approach. Cash or bank account debtor to DGG account, DGG account debtor to P&L account. And in P&L account, DGG portion is non-cash kada. that non-cash income is also to be deducted. Respond everybody, clear? Okay. And next, since all the non-cash items are eliminated, you were left only with cash items. But frankly speaking, this is a combination of operating, investing, financing. You want only dash activities. So eliminate dash and dash activities. So all the investing incomes in P&L has to be eliminated by deducting, and investing expense, only one will be there, loss on sale of asset, that will be eliminated by adding. And all the financing expense, no financing income amma. Financing income emundadu, only finance expense, that is interest paid or dividend paid. Of course, dividend paid is adjusted in appropriation kada. So only you will be having generally interest paid. That's a financing expense which will be eliminated by adding. Now you will be left only with dash items. But the real problem is here only. Sales is an operating item. Purchase is an operating item. Wages is an operating item. Expense is an operating item. But everything is having some portion of cash and some portion of non-cash. Yes or no? And hence you have to do one more adjustment called working capital changes. And working capital changes are nothing but current assets, current liabilities, increase, decrease. Shall I start now? ఒకటే గుర్తుపెట్టుకోండి, current liabilities cash, inverse relation, direct relation, current assets cash, inverse relation. Even remembering is also very easy amma. If it is your balance sheet, if your cash is here and current assets is here, sir, if current asset is increasing, your balance sheet should tally kada. What is the effect on cash? Ante inverse. If current liability is increasing, what is the effect on cash? Increase. Is the point clear? So current liabilities cash, direct relation, current asset cash, inverse relation. So increase in current asset minus, decrease in current asset add, decrease in current liability minus, increase in current liability add. You need to check out opening to closing, and you need to check out current asset, current liability, increase, decrease, and you need to take the decision. Respond everybody, clear? And after the completion, you just need to identify if any extraordinary items, disclose separately, and whatever the tax paid, you just need to disclose separately. Respond everybody, clear? In this context, some special elements that are observed. Point number 1, if it is provision for tax account, generally opening, closing. If no other information is there, opening is paid in the current year, closing is created in the current year. If no other information is there, opening is paid in the current year, closing is created in the current year. So this is called as provision for tax, which has to be added at starting to find net profit before tax. This is tax paid which has to be deducted at last while showing cash flows from operating activities after tax paid. Respond clear? Now one more important account, dividend declared account. Same amma, brought down, carried down. If no other information is there, opening is paid in the current year, which should be deducted under financing activities. Closing is declared in the current year, which has to be added at appropriations, dividend declared. Respond everybody, clear? And one more important thing, if at all given, opening given, closing given, paid is also given, then this will become balancing figure. The opening given, closing given, created given, then this will become balancing figure. Respond everybody, pakka. Now moving on to the next thing. In one question, dividend declared account is very clumsy. Opening, he'll be giving some figure. Closing, nothing will be there. And he will be telling current year some interim dividend is also declared. Is it clear? In such a case, opening is paid in the current year, interim dividend is paid in the current year. If any closing is there, that is declared in the current year. And ఏమవుతుంది, Opening is paid in the current year. Interim dividend declared in current year, paid in current year. Is the point clear? And if any closing is there, you need to assume it also as declared only. Everybody clear? This is another dividend declared account which is typical. CRD 11 and also in self-practice problem it will be typical. Please be careful. And now moving on to the next thing, important. In the question he will be telling that closing stock, opening stock. Their policy is to value stock at cost minus 10%. This is previous policy. But they would like to account now at cost price only. Is it clear? Generally, what will we think? Previous policy is cost minus 10% ante opening stock is wrongly valued. New policy is valuing at cost price ante closing stock is valued at cost price and it is correctly valued. Hey, am I correct or wrong? Generally, what is our perception? Stock, previous policy, cost minus 10%. New policy, valuing it at cost price. Opening stock and closing stock will be there. What will we think, Amma? Opening stock is wrongly valued, closing stock is correctly valued. Am I correct or wrong? But in one question, he is given that opening stock is correctly valued and closing stock as per books antadu. Wrongly valued. He don't use that term at all. As per books antadu. Remember, my dear children, whenever you are coming across as per books, it implies that it is wrongly valued at cost minus 10%. Everybody, opening stock is correctly valued antadu. Ante opening stock is valued at cost price. Closing stock is valued as per books antadu. As per books ante it is correctly valued or wrongly valued? Wrongly valued at cost minus 10%. That is a different point in that problem. Is it clear, everybody? So be careful. So as long as I have remembered, even I have covered every different adjustment relating to cash flow statement also, if I was not wrong. And my dear children, frankly speaking, that is the end of cash flow statement. Clear, everybody? Yeah. One more thing, as I said, DTA adjustment annan kada. DTA adjustment. We actually kept that in one of the concept questions, if I was not wrong. And please be careful if it was not like that, how the same has to be adjusted. How the same has to be adjusted. Sir, in the question, it will be given DTL, some 9,000 is given. Provision for tax, some 10,000 is given. In the adjustment, he is telling that net profit before tax is equal to 16,000 and given something like tax expense is equal to 19,000. Like this, some sort of data is there. Hey, is my point clear? So in this context, how are you supposed to do? Be careful, my dear children. Tax expense is a combination of CT and DT. Of course, while telling AS 22, I will tell it once again. Tax expense is equal to CT plus DTL or CT minus DTA. You remember these two things. Now, here since DTL is there, tax expense is 19,000, which is provision for tax is nothing but CT. So, CT plus DTL. 19,000. Is my point clear? If net profit before tax is available, we are super happy. No doubt at all in that. But if at all net profit after tax is there, for this net profit after tax, you just need to add provision for tax created. Is my point clear? You need to add provision for tax created. That is nothing but 10,000. But how much is tax paid? For that, you just need to draft PFT account. Opening balance, closing balance, and then automatically created is given, and this will become balancing figure. In that problem, మీరు ఏం గుర్తుపెట్టుకోవాలంటే tax expense includes both CT and DT. And since in the balance sheet given DTL, it is CT plus DTL. how much is created ante it is not 19,000, it is only 10,000. Is my point clear? In that question ఏముంటుందంటే TE, tax expense is given, provision for tax may not be separately given, but DTL is given. So how much PFT created ante you need to find out. Respond clear. How much provision for tax created, amma? 10,000. But in examination you'll confuse and you will be adding entire 19,000 thinking that it is provision for tax. Respond everybody pakka. So please be very much careful, my dear children. If at all tax expense is given in the question, always remember that tax expense is nothing but CT plus DTL or CT minus DTA. And CT is nothing but provision for tax. Frankly speaking, for cash flow statement, you need provision for tax only, not DT concept at all. Because provision for tax created has to be added back to find net profit before tax, and tax paid has to be deducted to find cash flows from operating activities after tax paid. Respond everybody clear. And my dear children, this is the end of accounting standard number 3, that is cash flow statement, totally completed. Our target is to complete consolidated financial statements, and the next one is all about company final accounts, or which is preparation of financial statements. So coming to consolidation, the first one, wherein coming to consolidation, 3 standards are guiding it. Number 1 is AS 21, AS 23 and AS 27, of which for the examination most important is like 21. If it is missed, 23, even if it is missed, 27. And actually we are being providing a supplementary material for you. In that supplement are provided. Okay, in that material we have included all the comprehensive questions from various standards, and also included company final accounts with various standard, and also we have framed a question on 21, 23, 27, and also we have provided that. And once or twice we have given in the examination also, and even one more question is also there for you. So it's recommended to go with that supplementary material. And anyways, now coming to AS 21, sir, first of all, damn sure you're going to get a 14 marks question from this. 99% you will be getting a 14 marks question directly. Otherwise it can be also in 10 plus 4 style. Under 10 marks he can ask one full length consolidation question. 4 marks he can ask any sub question like negative minority interest or cost of control computations. Like that he can ask any sub questions also. Now coming to consolidation, majority of the students will be concentrating on CBS, and they will obviously leave CPL account. Even if they prepare very lightweight, just like very lighter. If they give 99% importance to CBS, they'll give 0.9% importance to CPL, and remaining 0.1% importance to negative minority interest, cost of computation, and VR variety limited problems. Those things you will take very light. But remember, even though in the institute material the count relating to CPL account problems are lesser, these two things are equally important and having equal chances of testing in the examination. May attempt students failed in answering CPL account actually. They did not attempt the answer properly. One of the students who got 84 marks, she actually got 28 marks in MCQs and remaining marks in descriptive, where she lost major marks in her consolidated P&L account itself. Point number 1, either you should not choose the question, or if you have chosen the question, you must write it properly. So please be careful, give equal importance even to consolidated P&L account also. If you prepare well, you will be able to write well. If you're not preparing, you can't attempt it. Now coming to consolidated balance sheet, sir, there will be different teachers telling it in different ways and different styles. But at the end of the day, we need the answer you to prepare. Now, even if you are doing in whatever way, the answer should be the same. And presentation here and there, it might change. So step numbers, some teachers will be telling step number 2 differently, 3 differently, but everything will be covered here. So I will be telling in my general style. If at all anything are to be modified, you modify it accordingly, but you concentrate on the concept, not on the steps. Now, coming to CBS, as usual, first of all, you have to understand that accounting standard number 21 is not mandating anybody to prepare consolidated financial statements. Whoever have to prepare consolidated financial statements as per section 129 of Companies Act 2013, then they have to follow accounting standard number 21. It's like reverse applicability, similar to interim financial statements that I told you. AS 25 is not mandating IFR to prepare. For whichever business concern IFR is mandatory, they have to follow AS 25. The similar logic is also applicable here. And always remember that CFS shall be prepared for the group. Consolidated financial statements shall be prepared for the group. As per AS 21, group includes only 2 companies, holding and all its subsidiary companies will be included in the group. But generally in law and in any other subjects, wherever group, you will be thinking and you will be learning something like holding company, subsidiary companies, associate company, but joint venture company. But as per AS 21, group includes only 2 things, holding company and subsidiary company. Combined, you need to prepare consolidated financial statements for holding company and subsidiary company by thinking as if it is a single entity. In another words, simply CBS is equal to, or simply to tell you, CFS is equal to line by line addition of holding company data plus subsidiary company data. Simply line by line addition. But in line by line addition, the only change, the only gameplay is with pre-acquisition profits of subsidiary company. Frankly to tell you, the gameplay will be with profits and reserves of subsidiary company. This is the hardest part. Apart from this, everything is very, very easy. If you have remembered while telling amalgamation, I told you PC is the heart of the problem. Like that, profits of subsidiary company, analysis of profits of subsidiary company is the heart of consolidation. So please be very, very, very careful. In another words, to tell you, CFS is equal to SFS of holding company plus SFS of subsidiary company minus intercompany owings or intercompany transactions or mutual owings. Respond everybody, clear? So you have to start your CBS problems by drafting step number 1, where you are going to get date of acquisition, date of consolidation, percentage of holding interest and percentage of minority interest. In most of the times, date of acquisition will be given, consolidation will be at the end of the year, and holding interest in most of the times he will be giving, otherwise you need to compute that. Number of shares acquired divided by total number of shares of subsidiary company multiplied by 100 will be giving you holding interest, and the balance is nothing but minority interest. But in one problem, if you have remembered, be careful, there is a concept called bonus issue. So say for example, by the end of the year, there are 400 shares. There are 400 shares. And bonus ratio is something like 3:5. What do you mean by 3:5? For every 5 shares, 3 are the bonus given. Clear everybody? And holding company acquired 180 lakh shares. 180 divided by 400. Say for example, this is the data. In subsidiary company, there are 400 shares and holding company acquired 180 shares, and bonus ratio is something like 3:5. And if you observe, holding company number of shares acquired is 180, and in subsidiary company there are 400 shares. So 180 divided by 400 into 100, where it comes to 45%, which is exactly wrong, because holding interest under there should be more than 50%. A holding interest should be more than. In this case, you should not compute like this, because holding company acquired 180 lakh shares at the starting of the year, that is before bonus. And at the end of the year, 400 shares is with bonus. So you obviously need to find that clearly. Shall I start now? Sir, frankly speaking, 180 into 3 by 5. 108. So 180 plus 108, on a whole you will be having 288 lakh shares. So now compute the percentage of holding interest, which is so simple. 288 divided by 400 into 100. 70. So exactly this is what you are holding interest, and remaining 28% will become minority. Respond everybody, clear? But in this context, there's one more point that you need to observe. Sir, company is declaring final dividend. Subsidiary company is declaring final dividend for the last year. Subsidiary company is declaring final dividend for the last year. On how many shares will it give? Will it give on entire 400 shares? No, because in 400 it includes some bonus. But in the last year, no bonus shares kadamma. So you need to find how much are the bonus shares and you need to separate that. Am I correct or wrong? So be careful. Totally 3 bonus shares and 5 original shares. On a whole, it had become 8. So 400 divided by 8 multiplied by 3 is nothing but your bonus. Am I correct or wrong? Where it comes to? 150 is your bonus. So if bonus is not there, 400 minus 150. 250 is your shares. So you will be getting final dividend on how many shares? 250 shares. And holding company acquired 180 shares out of 250, where it is nothing but 180 divided by 250 into 100. Check out. 72% once again. Hey, respond everybody, clear? So be careful, my dear children. There is a problem with respect to bonus issue where you have to be very, very careful. First of all, you have to find before bonus how much, after bonus how much, and bonus how much. If you have find these 3 things, then it is going to become a very simple problem. Respond everybody, clear? So that is the end of your step number 1. And moving on to the next one, that is step number 2. What is step number 2, Amma? Analysis of reserves and surplus of subsidiary company. Some people will be learning this as step number 3. Apart from that, nothing great. Step number 1, date of acquisition and consolidation antaru. Step number 2, holding and minority antaru. Step number 3 will become analysis of reserves and surplus of subsidiary company. Whatever is that, step number is irrespective, concept is same. Shall I proceed further? Everybody please be concentrate. Analysis of dash amma? Of dash company amma? The analysis will be done by which company amma? Remember, you have to take each and every reserves and surplus, including securities premium and capital reserve also if available. Generally, in all our problems, we will be having only general reserve and P&L account. But take care, in the examination, you might have capital reserve. You might have securities premium. You have to take each and every reserve of dash company, subsidiary company, and you need to find first of all what is the closing balance. And separate this closing balance into 2 parts. Number 1 is opening balance. Number 2 is current year balancing figure. Clear everybody? Closing balance will be given in the question. Opening balance will be given in the question. Automatically current year balancing figure, you have to find that. And this is nothing but current year net profit. Respond everybody, clear? My dear children, if closing is 1 lakh and opening is 80,000, what is the current year profit? Cheppali. 20,000 is a current year profit. But sometimes opening is negative 80. Closing is 1 lakh. Then 1 lakh 80,000 is the profit. You might have such kind of situations also. Or say for example, opening is 1 lakh and closing is 1 lakh and opening is 1 lakh 20,000. Which implies that 20,000 is loss. This time it's not profit. Respond everybody, clear? And my dear children, in all our questions, date of acquisition happened during the year. Date of acquisition happened. And hence all the opening balance of subsidiary company profits is before acquisition or after acquisition? Before acquisition, and hence this is nothing but capital profits. And whatever current year balancing figure is there, you need to check out the point of date of acquisition and you need to separate till date of acquisition, after date of acquisition. Until date of acquisition, whatever is there, It is also pre in nature and hence capital profit, whereas after the date of acquisition is post in nature. Respond everybody, clear? And it is nothing but revenue profit, or it can also be called as revenue reserve. Respond everybody, understood? Now one more important adjustment in this context. Say for example this is P&L account. Say for example P&L account and closing 72,000 is given. And say for example opening 62,000 is given. You will be writing current year net profit balancing figure something like 10,000. But you have read in the question, one more statement is that subsidiary company had declared the dividend. Subsidiary company had declared the dividend out of its pre-acquisition profits. From the opening balance of P&L account, subsidiary company declared dividend antadu. The balance of P&L account as on 1/1/2011 is 62,000, of which 10% dividend is declared by the subsidiary company. Hey, respond everybody, clear? From which, how much dividend is declared, amma? 10% dividend is declared by which company, amma? Subsidiary company. This is what the data given. Shall I proceed further? And చాలా మంది స్టూడెంట్స్ విత్ హర్రీనెస్ ఏం చేస్తారంటే out of 62,000 P&L account 10% dividend declared ante they will be applying 10% on 62,000 and they will be treating 6,200 as dividend. But remember, that is wrong. You have to compute dividend always on paid up share capital. Say if the paid up share capital is 3 lakhs and if 10% is the dividend, then 30,000 is the dividend. Out of 62,000, 30,000 is the dividend, which is called, is being declared from opening kadamma and pre-acquisition kadamma. So this is called as pre-acquisition dividend. And 62 minus 30, 32,000, and current year you will be having a balancing figure 72 minus 32, which is nothing but 40,000. Respond everybody, clear? In another problem, same style, but he will be telling bonus. Bonus declared out of the opening balances of general reserve antadu. At that time, from opening balance of general reserve, you need to deduct bonus issue amount and you need to find the net figure. Respond everybody, clear? So like this, frankly speaking, you need to analyze each and every reserve into opening and current year balancing figure by considering closing balance. From opening balance, you may deduct dividend or you might deduct bonus, and then you will be having this one, and this will become balancing figure. This is always pre, which is capital profit, and current year till the date of acquisition it is pre capital. After the date of acquisition post it is revenue. Respond everybody, pakka? And my dear children, this is the end of P&L account and general reserve. Now one more reserve that is awaiting for you is all about revaluation surplus. Now one more reserve that is awaiting for you is all about revaluation surplus. Sir, please be careful. Say for example 1,50,000 is the asset value that is given in subsidiary company and the depreciation percentage is 10% given. So automatically the closing balance will become 1,50,000 minus 10%, which comes to 1,35,000. Now in the adjustments he will be giving something like holding company acquired subsidiary company and revalued the assets on 1/1/2011 at 1,80,000. Holding company acquired subsidiary company on one date, and as on the date of acquisition it had revalued the asset to 1,80,000. Kangarlo, what the students are doing is all about, be careful, they are taking the difference between 135 and 1,80,000 and they are stating that difference as revaluation surplus. But remember, this is wrong. You need to observe the dates properly. My dear children, this is year ending. My dear children, this is year starting, which is date of acquisition, and it is also year starting, which is date of acquisition. So now 1,50,000 had become 1,80,000. So automatically 30,000 is the revaluation surplus. Respond everybody, clear? Sir, understood? So while calculating revaluation surplus, you have to be very, very, very careful. In another problem, the same question is given, but the date of acquisition is exactly at the mid of the year. In such case, opening value is 1,50,000 and you need to provide depreciation for the half year, and then you will be getting something like 142,500, and now it is revalued to 1,80,000, wherein 37,500 will become the revaluation surplus. Respond everybody, clear? So now the biggest point, who can do the revaluation? Holding company can do the revalue with respect to the assets of subsidiary company as on the date of acquisition. Since the revaluation is done by holding company as on the date of acquisition, automatically the element will become capital. If it is upward revaluation, it is capital profit. If it is downward revaluation, it is capital loss. Respond everybody, clear? Hey, upward aithe capital profit, downward aithe it is recommended to compute the same in step number 2 or 3, whatever is it. And so to some people it is step number 3, to some people it is step number 2. In that step itself you compute even that also. Respond everybody, clear? Shall I proceed further? Okay. Now moving on to the next thing. Be careful. In that step itself, it is highly recommended to compute even depreciation also. Whenever assets are getting revalued, even depreciation also will change kadamma. So depreciation on revalued assets. How to compute this, sir? Depreciation on old figure, that is before revaluation, and compare the same with depreciation on new figure, that is after revaluation. So after comparing depreciation before revaluation and depreciation after revaluation, my dear children, find the profit or loss. This will become revenue because you will be providing depreciation after acquisition, and hence depreciation will become revenue, but revaluation will become capital. Participate. Revaluation will become capital, depreciation will become revenue. My dear children, depreciation will become revenue. Everybody clear? Whereas revaluation will become capital. Respond everybody, pakka. Now very important, concentrate. One conclusion, if at all asset is upward revalued, capital, profit, revenue, loss. If at all asset is downward revalued, capital, loss, revenue, profit. I hope you have understood how. Asset 1 lakh to 1.5 lakh, 50,000 upward, it is capital profit. But on the excess amount you need to provide depreciation kadamma. Then automatically depreciation will increase, which is nothing but revenue loss. If at all decrease in the value of asset is there, it's capital loss. Decrease in the value of depreciation will become revenue profit. Respond everybody, clear? Shall I proceed further? My dear children, one more important thing. Say for example 1 lakh is the before revaluation figure, and after revaluation figure it is 1,50,000, and hence you are getting 50,000 capital profit. And say for example depreciation provided is 10%. Option number 1, on 50,000 if you are providing directly, 50,000 into 10%, which comes to 5,000. Revenue loss, because value of asset increased, depreciation also will increase. If depreciation increase, is it profit or loss? And hence revenue loss. Respond everybody, clear? Option 2, original depreciation 1 lakh into 10%, 10,000. Revalued depreciation 1,50,000 into 10%, 15,000. Difference is nothing but 5,000. Again revenue loss. Respond everybody, clear? Now please concentrate carefully. Be very, very careful. Date of acquisition is equal to 1/7/2021. Your financial year is equal to 2021 Jan to December. And the asset as at opening, that is on 1/1/2021 is equal to 1,50,000. Depreciation provided is equal to 10%. And holding company revalued subsidiary company PPE to 1,80,000 as on the date of acquisition. Already I have discussed, did you remember? Now Can I compare directly from 1,80,000 to 1,50,000? Is it correct or wrong? So your opening value is 1,80,000, sorry, 1,50,000. Provide depreciation from January to June, that is up to 1,700, and a 6 months depreciation where you will be getting 7,500, and then you will be getting 1,42,500. It is revalued to 1,80,000. So balancing figure plus this is called as your revaluation surplus. Profit or loss? Capital or revenue? Respond everybody pakka. Now let me start providing the depreciation. Option number 1, directly computing on the difference. Am I correct or wrong? So that is 37,500 into 10% into 6 by 12. Hey, ante kada? Because you have to provide from July, which comes to into 6 by 12, which comes to 1,800. Okay. Now option number 2. Originally, how much is the depreciation in total, amma? 1,50,000 into 10%, which comes to 15,000. For first 6 months, how much is provided? So for the second 6 months, how much will be? So depreciation on old figure is 7,500. Depreciation on new figure ante 1,80,000 into 10% into 6 by 12, which comes to 9,000. What is the difference now? Hey, did you understand? And previously under option 1 or option 2, you have got the same answers. But here you are not getting the same answer. So now what is correct, what is wrong? My dear children, second option is correct, first option is wrong. Is it clear? Why it is wrong? It is some logic. I'm not going to explain that. But 1 second you remember that. Don't apply everything directly on the capital profit or capital loss. If you apply like that, your figures might change. And hence it is highly recommended to compute depreciation on old figure versus depreciation on new figure. Respond everybody pakka. If you would like to know the logic why this 1,875 is wrong, let me explain you in short. Just participate carefully, you'll understand. Sir, your new depreciation is 9,000. Am I correct or wrong? Now be careful. After 6 months, what is the book value? 1,42,500. Now if you provide depreciation on 142,500 into 10% into 6 by 12. 7,125. Now check the difference. 1,875. Hey, is my point clear? Now you tell me the answer. For the second year, for the second half year, that is from July to December, is the depreciation 7,125 or 7,500? Please participate. 7,125 or 7,500? Because already for the year 1,50,000 into 10%, 15,000 is the depreciation, of which first half year 7,500 aite. For second half year it should become 7,500 kada. And hence this is correct, this is wrong. Why 1,875 is wrong ante? If you compute depreciation on 142,500, then you will get a difference of 1,875. But computing depreciation on 142,500 is wrong kadamma. Because second half year, what is the depreciation amount? 7,500 but not 7,125. Respond everybody, clear? Okay, that is the end of depreciation concept. Now, please be careful. First of all, everybody listen carefully. If there is unrealized profit upstream transaction, unrealized profit upstream, ante subsidiary company is selling to holding company. You need to eliminate from which company profits, amma? Subsidiary company profits. Aithe generally some teachers em cheptarante subsidiary company profits will be into holding interest, minority interest. Hey, respond. Subsidiary company profits will be divided into holding interest, minority interest. That will be divided in apportionment of profits. Am I correct or wrong? Sir, respond everybody, clear? So some of the teachers will be telling that you have to deduct upstream transactions from minority interest step to holding interest step. Is my point clear? Holding portion will be deducted at holding interest. Minority portion has to be deducted at minority interest. But nenemantanante all such is nonsense. Simply find what is unrealized loss in the case of upstream transaction and put that in step number 2 or 3, whatever is that itself. Okay, respond, is it clear? So now conclusion, everybody check out. How many things you are going to get here? Analysis of reserves and surplus of subsidiary company. Number 1, you will be getting P&L account. Closing balance, opening, current year. From opening, if any pre-acquisition dividend is there, you need to deduct that. Again, current year, you might need to separate like pre and post depending on the date of acquisition. This is first one. And B, you might also have general reserve, take closing balance, and again you need to separate it into opening and current year. And if at all, from opening, if any bonus issue is given, you need to deduct bonus issue, and from current year again pre and post. One more important observation, whenever opening balance is not given, assume that opening is equal to closing. Whenever opening balance is not separately given, you have to assume that opening is equal to closing, and the total amount will become pre, no post. Respond, everybody clear? Okay, so A, P&L account, B, general reserve. Now C, revaluation surplus. Find whether upward revaluation or downward revaluation. Capital profit or capital loss. And point number D, depreciation on revalued assets. If it is capital profit, it is revenue loss. If it is capital loss, it is revenue profit. But at the time of finding depreciation, you have to compare depreciation of old figure versus depreciation on new figure. Never do it directly. Respond, everybody clear? Huh? So if at all you are having two assets, what to do, sir? Compute the two assets and take the net figure. From one asset 1 lakh capital profit. From another asset 10,000 capital loss. Set off 90,000 capital profit. I hope you are participating. 1 lakh capital profit from one asset, 10,000 capital loss from another asset. Simply set off, you will get 90,000 capital profit. In the similar way, if there are depreciations on more than one asset, compute everything and take the net figure. Respond, everybody clear? And very important point number E, unrealized profit upstream. Because upstream aithe you need to eliminate from subsidiary company profits. Sir, so simple. Upstream ante who is selling to whom? Subsidiary is selling to holding. Who is selling? Subsidiary. Who is making profits? Subsidiary. So eliminate unrealized profit from subsidiary company profits. Since subsidiary company reserves and surplus are there in this step, you have to eliminate in this step only. Respond, everybody clear? And put it as a negative figure, which is nothing but elimination of unrealized profit until it is revenue loss. Everybody understood? My dear children, if holding company is selling to subsidiary company at a price lesser than the cost price, it will become unrealized loss. And unrealized profit is deducted, but unrealized loss has to be added. Because unrealized loss eliminate loss and a profit hai kada. You need to add that. Sir, cheppandi clear? These are the 5 things you are going to get in this step. Number 1, P&L account. Number 2, general reserve. Number 3, revaluation. Number 4, depreciation. Number 5, unrealized profit upstream. And then transfer all these 5 things to the next step. What is the next step, Amma? Apportionment of profits. Likewise, pre and post. In this pre and post, you just need to separate P&L account, pre, post. General reserve, pre, post. Be careful, revaluation surplus. Only in pre you will be having. Hey, respond, ra. Depreciation on revalued surplus. Only in post you will be having. Very important, unrealized profit upstream. You need to deduct here. Here nothing. And then you will be getting the net figures kadamma. These net figures will be ultimately separated and enjoyed between holding interest, minority interest. Respond everybody, clear? And moving on to the next step. And whatever you have got 5 elements in this step, all those things have to be transferred to the next step. And then step number 4, aggregate of minority interest. To some people this will become step number 5, aggregate of minority interest. Very simple. Aggregate of minority interest, share in share capital of dash company, subsidiary company. And then you need to add share in capital profits, share in revenue profits. And then you are going to get the closing balance, which has to be transferred to consolidated balance sheet. Respond everybody, clear? Moving on to the next step, which is cost of control. To some people this will become step number 5. To some people it will become step number 6. Coming to cost of control. My dear children, you have to compare cost of investment versus value of net assets. Cost of investment ante how much ever the cost of investment is there, check out, minus very important pre-acquisition dividend. If not adjusted, you need to find that. Compare this figure versus value of net assets. Value of net assets is nothing but share in share capital of subsidiary company. This is with respect to which interest, amma? Holding interest, because minority is already completed in the previous step. This is relating to holding interest. Share in share capital of subsidiary company with respect to the holding interest. And the next one, share in pre-acquisition profits or capital profits. You'll get one figure. Compare these two figures. If cost of investment is more, it is capital loss which will be transferred to goodwill. If cost of investment is less, it is capital profit which is transferred to capital reserve. Respond everybody, understood? My dear children, this is what the next step is all about. And the next one, if you want, you can do this step here, or you can totally eliminate this step and straight away you can do the same in balance sheet, which is elimination of intercompany owings. If you are having time in the examination, solve here. No sir, we will directly do in the balance sheet. Go to balance sheet and do there. Respond everybody, clear? Sir, take care. All the debtors, creditors, bills receivable, bills payable, loan liability, loan asset, everything, and also stock. You need to deduct intercompany transactions or intercompany owings for all these things. But coming to stock, you need to deduct unrealized profit. Whether it is upstream or downstream, here you need to deduct. While eliminating intercompany owings, you need to deduct unrealized profit, whether is it upstream or downstream. Respond everybody, clear? And moving on to the next thing, amma. Next step, reserves and surplus for consolidated balance sheet. Reserves and surplus for consolidated balance sheet. You take all the reserves and surplus of holding company. Holding company reserves and surplus you need to take. Like all the general reserve, P&L account, whatever are there, just take all the holding company reserves and surplus. Hey, respond clear? And then you need to add post-acquisition profits. And very important, minus pre-acquisition dividend wrongly treated. Pre-acquisition dividend wrongly treated has to be deducted here. And also has to be deducted from cost of investment. Am I correct or wrong? So pre-acquisition dividend wrongly treated has to be deducted. Very important. Unrealized profit downstream. Unrealized profit downstream will be deducted. And finally you will be getting one net figure. And net figure will be transferred to consolidated balance sheet. Respond everybody, clear? On the other hand, to some other people, you might have learned the format like this, CPRPRR. There are people who will be learning the concept like CPRPRR. Everybody learned like that only. Oh, no. Fine. CP is nothing but pre-acquisition. RP and RR is nothing but post-acquisition. RP is nothing but P&L account. RR is nothing but general reserve. Instead of writing post, you will be writing these things. Respond everybody, clear? Of course, since we are not only concentrating on a closer edition, there are several students learning the format in different ways. So trying to cover every aspect. And now how the last step is going to become. In last step, there are some people who will be learning like this: P&L account and general reserve. And then balance of holding company, P&L account, general reserve. Add post acquisition profits, revenue profit, revenue reserve. Clear everybody? And then you will be getting some total. For this total, you can also add capital reserve. Capital reserve from step number 5. And please don't forget some things: minus pre-acquisition dividend wrongly treated has to be adjusted. Unrealized profit downstream has to be adjusted. Respond everybody, clear? Pakka. There ends the matter. Hey, understood everybody? There ends the matter. Be careful. So now moving on to the next thing, and the last and final, that is all about CBS, consolidated balance sheet. Please be careful, my dear children, how the consolidated balance sheet will be. Share capital, always only holding company share capital will be shown. Hey, which company share capital? Reserves and surplus. From step number 7 you can take. For some people it will become step number 8. You can take the same figure directly. And next, very important, where students will forget to write minority interest. After completion of the problem will not tally. Then you will be doing assets minus liabilities. And the difference, oh, minority interest. Jagratta. Oh, minority interest kadu, minority interest. So you have to book minority interest. Please don't forget, after reserves and surplus, but before non-current liabilities, which is from step number 4. To some people, this will become step number 5. Respond everybody, clear? And very important, Amma. The next one, all the non-current liabilities and all the current liabilities and even all the non-current assets and even all the current assets. A single trench, that is line by line addition. Holding company balances plus subsidiary company balances minus intercompany transactions. If you have prepared step number 6, automatically no need to present separately. You can simply represent from step number 6 or step number 7. Hey, respond everybody, clear? Elimination of intercompany owings. If you have done that step, no need to present here separately. Take that amounts directly and put it here. Respond everybody, pakka. Be careful, very important. Investment in subsidiary company, this will get eliminated, and this is not shown in the consolidated balance sheet at all. Respond everybody, clear? And my dear children, frankly to tell you, CBS, consolidated balance sheet, is completed. Now moving on to the next concept, that is consolidated P&L account. Before telling consolidated P&L account, let me tell you one or two important adjustments. Already I told you, unrealized profit elimination. Two things will be there, upstream, downstream. Upstream ante subsidiary is selling to holding company. Downstream ante holding is selling to subsidiary company. And you have to eliminate the same from subsidiary company profits. And here you need to eliminate the same from step number 6 or 7, that is inventory. And downstream aithe, since holding company is selling, you need to eliminate it from holding company profits. And you need to eliminate it also from inventory. Sir, now concentrate. Very simply, I'll tell you how to eliminate unrealized profit. First, to those people who I have taught the classes, there are 3 steps which is reflecting this unrealized profit. Step number 2 okati, step number 6 okati, step number 7 okati. If it is upstream, eliminate 2 and 6. If it is downstream, down things 6 and 7. Now to those who people other you have learnt, your steps are 3, 7, 8. Upstream 3 and 7. Downstream 7 and 8. There ends the matter. Up aithe up, down aithe down. Very simple. No confusion at all. Hey, respond everybody, clear? Be careful, don't forget. And now the next one, Very important adjustment for the examination is all about pre-acquisition dividend wrongly treated as post-acquisition dividend. It's pre-acquisition dividend, but holding company will be wrongly treating it as post-acquisition dividend. Then how to adjust these things? Amma, always remember, pre-acquisition dividend will be reducing the cost of investment. Pre-acquisition dividend is reducing the which is in step number 5. And holding company is treating pre-acquisition dividend as post-acquisition, and a holding company had added to its post-acquisition profits, which is in step number 7. You need to deduct that. And to some other people it is obviously nothing but minus step number 6 and minus step number 8. Respond everybody, clear? Which is nothing but pre-acquisition dividend wrongly treated as post-acquisition dividend. You need to deduct it from cost of investment. You need to deduct it from holding company profits. Respond everybody, understood? And now very important. I hope you have remembered the concept of negative minority interest. Negative minority interest. If any negative minority interest is there, first of all you have to adjust the same to the holding company profits, and then further if any profits are there, first those profits have to be enjoyed by the holding company and balance will be again given to the minority interest. Hope you have remembered. Now these two things can be combined. Appudu emautundi? Compute minority interest. My dear children, in step number 4 to some people and 5 to some people. How to compute minority interest, tell me? Share in share capital, share in capital profits, share in revenue profits, share in revenue reserves. Say for example this is 0. Say for example this is loss. Share in share capital 1 lakh, capital profit 80,000, revenue profit 2 lakhs. No profit, loss 2 lakhs. And then minority interest is representing minus 20,000. Is my point clear? In such a case, generally in CBS, minority interest is shown after reserves and surplus, but before non-current liabilities. If it is positive figure, show there. If it is negative figure, don't show there. Mari em cheyali, sir? This has to be adjusted against the reserves and surplus of holding company. So it has to be transferred to step number 7 or step number 8. To some people it is step number 8 kada. To some people it is step number 7, which is reserves and surplus for consolidated balance sheet. To that step you have to transfer that. Respond everybody, clear? And very important adjustment. In one of the problems you are having preference share capital. Gurtunda? In one of the problems you are having preference share capital in subsidiary company. My dear children, if at all no holding interest is given, total preference share capital, 100% of the preference share capital is belonging to minority interest. If at all there is no holding interest given in the question, then total amount has to be transferred only to minority interest. Then your minority interest will become share in equity share capital, share in preference share capital, share in capital profit, share in revenue profit, share in revenue reserve, and the total will be transferred to minority interest. Respond everybody, clear? That's it, my dear children. And small twist he can put. Preference share capital 1 lakh in subsidiary company. Okay, preference share capital 1 lakh in subsidiary company. Holding interest 40%, minority interest 60%. Is it possible holding interest having 40% in preference share capital? Less than 50% possible? Yes, possible, because this is preference share capital. To have control, you should have more than 50% share in equity share capital. This is quite possible here. Respond everybody, clear? Now in this case what to do, sir? Minority interest, while adding preference share capital, you have to take only 60% here. Is it clear? Then what about holding interest 40%, sir? Did you remember cost of control step? Tell me how to compute cost of control. Cost of investment in equity share capital minus pre-acquisition dividend if it is wrongly treated, and then it has to be compared with net assets, that is share in which capital? Equity share capital and share in capital profits. Compare these two things. If cost of investment is more, then it is goodwill. If cost of investment is less, then it is, am I correct or wrong? You call this as A. And now you have to call B. What is B, sir? Cost of investment in preference share capital versus share in preference share capital. Hey, respond everybody, clear? Automatically same. If cost of investment is for more, goodwill. If cost of investment is less, capital reserve. Respond everybody, pakka. This is one more important and interesting thing that you should identify. Is it clear? Why I am telling this thing? The same, amma. You are having preference share capital in the institute material question, but no holding interest is given. Entire 100% is belonging to minority. But in the main examination, everything copy paste. Only one change. Holding interest is 40% in preference share capital. Then you feel so much bad. You may not get the answer, but frankly speaking, this is the answer. And if you think with common sense, adjustments are very small. If you know the concept, you can do well. Otherwise, you need to worry. Hey, respond everybody, clear? And my dear children, that is the end of CBS, all the different adjustments. And now I'm going to start CPL. Consolidated P&L account, so simple. Sir, likewise how assets of holding company and assets of subsidiary company minus intercompany owings we have done. Liabilities of holding company plus liabilities of subsidiary company minus intercompany owings we have done. For CPL also it is same. Expenses of holding company plus expenses of subsidiary company minus intercompany transactions, and incomes of holding company plus incomes of subsidiary company minus intercompany transactions. And my dear children, you obviously need to follow schedule 3 while preparing the same. No worries about the format, because we are going to discuss in the next half an hour. We are going to start the format relating to preparation of financial statements. So no worries at all. But some things that I would like to address here in this context. Sir, first of all, listen very, very carefully. Add all the revenue, you prepare P&L account by adding all the incomes of holding company plus incomes of subsidiary company minus intercompany transactions, and expenses of holding company plus expenses of subsidiary company minus intercompany transactions. For the time being, if you would like me to tell the format, even schedule 3 P&L account format also gets completed. What is Roman number 1, amma? Revenue from operations. Roman number 2, amma? Other income. Roman number 3, amma? Total income, where revenue from operations plus other income is nothing but your total income. Roman number 4, amma? Expenses. Under expenses, first one, cost of raw materials consumed. The next one, purchases of stock in trade. The next one, changes in inventories of finished goods, stock in trade, work in progress. But you are not going to consider raw material, because raw material is already considered here. And point number D, E, F, G. F, employee benefit expenses, finance cost, depreciation and amortization, other expenses. Simply you can remember like F, employee benefit expenses, finance cost, depreciation and amortization, other expenses. And finally you are going to get profit or loss before, sir, before exceptional items, and then you have to book exceptional items separately. Then before extraordinary items, then you need to book extraordinary items separately. Then before tax, you need to book tax expense separately. Respond everybody, clear? So profit or loss before exceptional items, exceptional items. Profit or loss before extraordinary items, extraordinary items. Profit or loss before tax, tax expense. For the time being, I'm writing only these things. Profit or loss before tax expense or before tax, and then tax expense, and you're going to get profit or loss after tax, which will be straight away carried on to consolidated balance sheet. Frankly speaking, Sir, చాలా జాగ్రత్తగా వినండి. Generally, this profit or loss after tax has to be carried on to balance sheet. In note number 2, reserves and surplus, you have to write P&L account opening balance. For that, you will be adding current year net profit. Very, very important. There you are going to deduct the appropriations. Respond everybody, clear? Appropriations అంటే transfer to general reserve 10% అని, dividend declared అని, like that he is going to tell and you have to do there. Respond everybody, pakka. Now there is one important point that you need to understand, my dear children. Whereas while doing consolidation, he don't ask you to prepare CBS after CPL. Preparation of financial statements అయితే he'll ask you to prepare balance sheet and P&L. So profit or loss after tax is directly transferred to balance sheet and all the appropriations were done in note to reserves and surplus. But in consolidation, he don't ask you to prepare both CBS and CPL simultaneously. He will ask only either of the things. So if he is asking CPL account, don't stop here. Is it clear? Minus appropriations. What is it appropriation, sir? Dividend declared and minus transfer to reserves. But luckily in all our problems of institute, no transfer to reserves, only dividend declared will be there. Respond everybody, clear? Now listen very, very carefully everybody. Holding company data plus subsidiary company data minus intercompany transactions. Holding company plus subsidiary minus intercompany transactions, and even for all these things also holding plus subsidiary minus intercompany transactions you have to do. And finally here you will be left with holding company profits plus subsidiary company profits. Respond everybody, clear? My dear children, you will be left with dash and dash, holding company profits and subsidiary company profits. Very, very important. Now, frankly speaking, did you remember reserves and surplus for CBS? While computing consolidated balance sheet, reserves and surplus for CBS, there which profits are considered, amma? Holding company profits plus dash profits, post acquisition profits of subsidiary company with respect to holding interest. While preparing consolidated P&L account, you have got holding company profits and subsidiary company profits matched, not matched. So you have to do some adjustments in order to make it post acquisition subsidiary holding. Sir, ardhamainda? Point number 1, you need only dash interest. So you have to eliminate minority interest. Profits of minority interest will be eliminated by deducting. Losses of minority interest will be eliminated by adding. Respond everybody, clear? You need, now minority is totally eliminated. Now only dash interest is there. But you want only post acquisition. But here total profits are there, kada? So you need to eliminate pre-holding interest. Profits of pre-holding interest have to be eliminated by deducting. Losses of pre-holding interest have to be eliminated by adding. Hey, respond everybody, clear? That's it, my dear children. And then finally you are going to get a net figure, kada? That figure is representing total consolidated P&L account which could be transferred to reserves and surplus, that is CBS. Hey, respond everybody, clear? Pakka. So you need to do 2 adjustments at the end. What are the 2 adjustments, amma? Eliminate minority interest, eliminate pre-holding interest. One more important thing, if at all pre-acquisition dividend is wrongly treated, even that is also to be eliminated. If at all pre-acquisition dividend is there, that is also to be eliminated. Wrongly ane kaadu, even when pre-acquisition dividend is there, you have to eliminate. Amma, this includes total profits, yes or no? But from this total profits, some profits are declared as dividend, kada? And hence you need to deduct pre-acquisition dividend also. You have to do 3 adjustments. What are the 3 adjustments? Minority interest, eliminate. Pre-holding interest, eliminate. Pre-acquisition dividend eliminate. Respond everybody, clear? So, my dear children, what is the conclusion? And one more important thing that I would like to discuss. There are two types of consolidated P&L account problems in the institute material. Number one, which are given in the board materials, RTPs and MTPs. Number two, a problem exclusively which is given in the examination. And in this problem which is given in the examination, there is something called preference dividend. In the balance sheet, it was given clearly, trail balance. In the trail balance, it was given clearly, preference dividend up to 39/2011 entered. Frankly speaking, did you ever observe till now in your lifetime computing dividend only for half of the year? But in that problem, you will be encountering that one. So, for your kind information, you need to assume this as half of the preference dividend is paid. And still half of the preference dividend is not yet declared and not yet paid. Is it clear? Be careful. This is one more important point. And the problem which is given in the examination and which is having preference dividend in the question, that style is something like compute CPL account. And after that, you need to eliminate three items. Number one, eliminate minority interest. Number two, eliminate pre-holding interest. Number three, eliminate pre-acquisition dividend. Is it clear? Pre-acquisition dividend has to be eliminated by deducting. Minority and pre-holding interest. If profits, eliminate by deducting. If losses, eliminate by adding. Respond everybody, clear? This is what you are supposed to do in examination kind of problem wherein preference dividend is given. And in all other problems, including another problem which is given in another attempt of question paper, preference dividend concept is not there. And also, acquisition is done in different year. CPL is being prepared in different year. Acquisition is in different year. CPL is in different year. At that time, he had stopped simply by preparing P&L account. Sir, ardhamainda? Frankly speaking, what are the adjustments I told you? You need to deduct minority interest, pre-holding interest, pre-acquisition dividend. In this problem, date of acquisition that year, books of accounts are prepared in that year itself. Whereas in another kind of problems where date of acquisition is done previously and financial statements are prepared in the current year. Start answering me. Do you have pre-acquisition dividend in the current year? Cheppali. No need to eliminate. Do you have pre-holding interest in the current year? No need to eliminate. But do you have minority interest or not? Frankly speaking, you have to eliminate only minority interest, but even that is also not done in such kind of problems. So is my point clear? Maybe you may think what I am teaching is clumsy, but it was like that in your materials. What is that? Sir, let me conclude. If you read the question properly, and if date of acquisition and financial statements, if date of acquisition and CPL account is also prepared in the same financial year, after completing CPL account, you need to do three adjustments. Adjustment number one, eliminate minority interest. Adjustment number two, eliminate pre-holding interest. If profits, eliminate by deducting. If losses, eliminate by adding. And last and final, pre-acquisition dividend, if any, eliminate by deducting. Respond everybody, clear? But my dear children, to find how much is a minority interest, to find how much is pre-holding interest, you need to draft subsidiary company P&L account separately. You will be doing one problem of this style. You will be preparing even subsidiary companies P&L account separately. Respond everybody, clear? So, if at all date of acquisition and CPL account were done in the same financial year, you have to do like this. Now, In all other problems, date of acquisition is somewhere done previously and you are preparing CPL account in the current financial year. In such case, simply prepare CPL account and leave it like that. Frankly speaking, no need to eliminate pre-acquisition dividend since it is not there. No need to eliminate pre-holding interest since it is also not there. But frankly speaking, you need to eliminate minority interest. You need to prepare subsidiary company P&L account and you need to eliminate minority interest. But in all such problems, he did not do that one. So I am also telling like no need to do the same. Respond everybody pakka. So please take more care, my dear children. Read the question. Conclude. Date of acquisition CPL account. Same financial year. You have to do many adjustments even by preparing subsidiary company P&L account. If date of acquisition is somewhere done previously and now you are preparing CPL account for the current financial year, no need to do any adjustments. Simply holding company data plus subsidiary company data minus intercompany owings. There ends with your answer. Respond everybody clear, huh? That's it. In this context, one more important head, that is production expenses. Coming to production expenses, it will be added to cost of raw materials consumed, or if you want, you can also treat it as other expenses. That's of your choice. If you want, you can put it under cost of raw materials consumed, or if you want, you can also put it under other expenses. Respond everybody clear, huh? My dear children, that is the end of CPL. Now, some other important models. Point number 1, negative minority interest. I already told you the concept. Sir, not when subsidiary company had got losses, this concept is applicable. If total minority interest is negative, this concept is applicable. Sir, is my point clear? Huh? If subsidiary company is getting losses, total share of minority will decrease. At that time, this concept is not applicable. If total minority interest had become negative, is my point clear? Then this concept is applicable. If total minority interest is negative, then you have to adjust the same against the reserves and surplus of holding company. Further, if any profits are there to subsidiary company, to such extent of negative figure, holding company will enjoy and balance will be given to minority. Respond everybody clear, huh? This is negative minority interest. And now there are some small questions like computing cost of control. Computing cost of control. That's another small question. Be careful. And one more important question. We have provided you in the form of illustration. From that illustration, recently in May, if I was not wrong, a 4 marks question is asked relating to dividend. Dividend. If at all dividend is declared from pre-acquisition profits, how to do it? Dividend is declared from post-acquisition profits, how to do it? Different assumptions, amma. Sir, gurtochinda. Dividend declared by subsidiary company. From which profits, he will not tell you anything. So you have to assume different cases. If dividend is declared from pre-acquisition profits, this is the accounting treatment. If dividend is declared from post-acquisition profits, this is the accounting treatment. If dividend is declared from current year profits, this is the accounting treatment. Like that, you need to assume different cases and you need to solve that. Respond everybody clear. And one more problem where I am not dealing is all about some sort of variety limited problem will be there. Foreign company will be having 51% of the share and local company is having 49% of the share. This 51% is sold to 49% company so that it is becoming wholly owned subsidiary. For that purpose, they need to agree the price. Did you remember? This is another model where I am not covering with respect to AS 21. So please be careful. I hope the revision is absolutely useful for you. So please be careful, my dear children. That is what with respect to consolidation accounting standard number 21. Now still there are 2 more standards, AS 23 and AS 27. Sir, Frankly speaking, till now examiner did not test a proper question from AS 23 and 27. So there are good chances to you to ask the same from AS 23 and AS 27. Sir, mara adagakapote. In next marathon also I'll tell the same thing. So please be careful. There are good chances for sure. And he may not ask it direct. He may not ask it for 14 marks. But he might ask it for 4 marks. I told something like 10 plus 4 aduguta untadu anna kada. So he might ask for 4 marks or 5 marks. He can ask. Anyways, coming to AS 23, you have to follow equity method. Amma. Which method you need to follow? Sir, follow AS 23 equity method in CBS only when AS 21 is there. If AS 21 is not there, 23 is also not there. If AS 21 is not applicable, then AS 23 also not applicable. Then obviously it will be accounted something like investment in associates by using AS 13. Investment in associates has to be included in CBS only when AS 21 is applicable. If AS 21 is applicable, how to do this equity method, sir? Very simple, amma. First of all, you have to find goodwill or capital reserve. How to find goodwill or capital reserve? Find cost of investment, which will be obviously less than or equal to 20% for sure. Since it is associate company, the share will not be more than 20%, which is like less than or equal to 20%. And very, very important, you need to compare the same with value of net assets. You need to compare the same with the value of net assets. What is value of net assets, Amma? Share capital plus profits. Am I correct or wrong? Which profits you need to consider? Capital profits. If any pre-acquisition dividend is there, then you obviously need to deduct the same from cost of investment. And after comparing these two things, automatically you will be getting either goodwill or capital reserve. Up to this clear, huh? And whatever you are doing cost of control in AS 21, that is for step number 5 or 6, whatever, you have to replicate the same even for associate company also. But the biggest point here is all about how this shall be shown in CBS. Just concentrate, how shall it be shown in CBS? Roman number 2, assets. Under that, first one, something like non-current assets. Under that, something like B, non-current investments. Under investments, you should call something like note number 4. So now in note number 4, non-current investments, in that investment in associate company, you need to show. How shall it be shown? Sir, gurtupetkondi, the outer column will be obviously cost of investment. No doubt at all in that. Outer column shall be obviously cost of investment. But that has to be separated between value of net assets and goodwill. Is my point clear? So for value of assets, you need to add goodwill, or if it is capital reserve, deduct, and then you are going to get cost of investment. Up to this clear, everybody? Very important. For this, you just need to add share in revenue profit. If it is revenue loss, that will be obviously deducted. And then you will be getting the total kada. And from that you need to deduct share of dividend declared, if any. And then you are going to get a final figure which is shown in consolidated balance sheet. And take care, Amma, this is post-acquisition dividend. Because pre-acquisition dividend shall be deducted from cost of investment. Respond everybody clear. Hey, tell me the format, Amma. Number 1, value of net assets. For that you need to add goodwill or minus capital reserve. Then you are going to get cost of investment. Add share in revenue profits minus share in revenue losses minus post acquisition dividend, if any, that has to be deducted. You need to deduct post acquisition dividend. Respond everybody clear? Meer adige doubt. Sir, adhen sir, post acquisition dividend has to be added kada. That has to be added for your profits. But this is investment in associate company balance. And what is the logic behind this thing? Ante, if at all share of revenue profits 1 lakh got added, this is inclusive of post acquisition dividend amount. So you need to deduct post acquisition dividend, say 20,000 separately, and hence your final profit is 80. Sir, arthamayinda? One second. Profit before dividend 1 lakh. Dividend declared 20,000. What is your final profit? Answer me, what's your final profit? But while doing investment in associate company, share in revenue profit, you will not add 80,000. You will be adding 1 lakh. And then 20,000 is separately deducted. And then net figure comes to 80,000. Hey, respond everybody clear? Pakka. Share in revenue profit will be added before declaration of dividend or after declaration of dividend? Before declaration of dividend, share in revenue profit has to be added. And after that, you need to deduct dividend declared separately. Respond everybody clear? And my dear children, this is the end of AS 23. Sir, okkasari cheppra AS 23 quickly. AS 23 is applicable only when AS 21 is applicable. In the balance sheet, notes to accounts, what are the things you are supposed to do? What are the things you are supposed to do in notes to accounts? Value of net assets, add goodwill or minus capital reserve, then you are going to get cost of investment. If any pre-acquisition dividend is there, adjust here itself. And then add share in revenue profit. Other, if it is revenue loss, it will be deducted. And the next one, simply you need to deduct post acquisition dividend. Here share in revenue profit is added before dividend, and dividend will be separately deducted, and net figure is finally shown in CBS. Respond everybody clear? And my dear children, if it is further years, if it is year 1, it is like that. If it is further years, ante undadu. Simply, what is the opening balance? You will be putting add share in revenue profits and simply closing balance. Is it clear? Amma, if it is year 1, this entire thing will come. If it is further years, this will change to opening balance and only this part will come. Opening balance, next year profit, next year dividend, if any declared, that will be deducted. And my dear children, that is the end of AS 23. And now moving on to AS 27, I am not going to cover it exhaustively. In AS 27, 3 parts will be there. Jointly, JCO, JCA, JCE, jointly controlled operations, jointly controlled assets, jointly controlled entity. AS 27 is applicable to AS 21 only for JCE. Be careful, AS 23 is applicable only when AS 21 is applicable. But AS 27 alagadamma. In AS 27 you are having 3 parts: JCO, JCA, JCE. This is applicable every time. This is applicable every time. This is applicable only when AS 21 is there. That is the reason AS 23 name. AS 23 name. What is AS 23 name? Accounting for investments in associates in consolidated financial statements. Is my point clear? Whereas coming to AS 27, simply like accounting for interest in joint venture. That's it. It is not specifically concentrating on something called CFS. AS 23 is exclusively relating to CFS. AS 23 is applicable only when AS 21 is applicable. Even when AS 21 is not there, JCO 27 applicable, JCA 27 applicable, but JCE is applicable only when 21 is there. Respond everybody clear? Now, sir, there are good chances of testing JCO question in your examination for 5 marks. There are good chances of testing JCV question for 5 marks. So please concentrate. It's so easy. Just can do it by your own. Now coming to JCE, you need to follow proportionate consolidation method. What is proportionate consolidation method? It's so simple. Proportionate consolidation method is nothing but you need to take the share of holding company plus proportionate share in joint venture. If you are having only 40% share, take only 40%. If you are having only 50% share, take only 50%. If you are having more than 90%, I mean, what is that called? 50% share, take only 50%. Hey, up to this clear, My dear children, very, very important. If at all your JCE, I mean, in your JCE, if you have more than 50% share, then AS 21 is applicable, not 27. In JCE, if you are having more than 50%, then AS 21 is applicable. You have to prepare as if it is your subsidiary company. Respond everybody, pakka. And my dear children, that is the end of AS 27. I mean to tell something like, if at all JCE share is less than or equal to 50%, follow proportionate consolidation method. How to follow proportionate consolidation method? Holding company data plus proportionate share in jointly controlled entity. If it is more than 50%, obviously you need to follow AS 21 principles. Respond everybody, clear? And my dear children, that's the end of AS 27. As I said, I'm not going to concentrate more on 23 and 27 because also the examiner's first pick is 21 itself. But please do remember your consolidated balance sheet and consolidated P&L account are having equal importance. Don't think that CBS is prioritized when compared to CPL. Never do such kind of things. Please don't lose marks in your examination. Just relax for 2 to 3 minutes and we are going to start company final accounts. Sir, actually one more concept that I left is all about uniformity in accounting policies from consolidation, which is very, very easy. Like only the current year data, I mean like if subsidiary company is following another accounting policy and if holding company is following another accounting policy, you can't do line by line addition directly. You have to convert the subsidiary company's accounting policy in line to holding company accounting policy and you have to prepare the revised or restated balance sheet and then you may need to prepare the consolidated balance sheet. So take care. In one of the question, even this uniformity in accounting policies can be merged with CBS. And say for example, he will give some debtors data. Holding company 1 lakh, subsidiary company 2 lakhs. And give subsidiary company, say for example, 1,80,000. And given that subsidiary company had a policy of providing provision to the extent of 10% on the debtors. Whereas holding company is not having any policy of providing provision. So debtors, how can you show directly 1 lakh plus 1.8 lakh? Sir, is my point clear? How much is holding company debtors shown? Please participate. Holding company debtors shown. Subsidiary company debtors shown. 1,80,000. Can you add these two things directly? No, because holding company is not providing provision and subsidiary company is providing a provision. Two different accounting policies and hence you can't add it up. So now what to do, sir? Since holding company is not providing the provision, write off the provision which is already provided by the subsidiary company and bring uniformity in accounting policies. How to do it, sir? Sir, debtors is shown in the balance sheet after deducting the provision. Am I correct or wrong? And how much is the provision provided, amma? 10%. Is it clear? And if 100 is the provision, if 10 is deducted, then automatically 90 is the value. Am I correct or wrong? So 1,80,000 is representing 90 and multiplied by 10. How much is the provision? 20,000 is the provision. If you write off this 20,000, the total gross debtors will become 2 lakhs. So now you need to add how much amma? 1 lakh plus 1.8 lakh, 1 lakh plus 2 lakhs. 1 lakh plus 2 lakhs. వాడు ఏం చేస్తాడంటే he don't frame a separate question on negative and minority interest. He may not frame a separate question on uniformity in accounting policies. He will ask you a normal CBS question and he might merge these 2 points in that same question itself. Antunna. Is my point clear? At that time, first of all, don't get tensed. Just read the question slowly, carefully. You will be obviously able to do it. Respond everybody, pakka. Fine, my dear children. These are the different and typical points relating to consolidation. And one more concept, uniformity in accounting policies. And now let me start with the last and final one, which is company final accounts, otherwise called as preparation of financial statements. Frankly speaking, my dear children, financial statements include balance sheet, P&L account, cash flow statement, SOC and notes to accounts. Am I correct or wrong? And for your kind information, in the institute material, even cash flow statement is also there in this chapter only. In the institute material, since financial statements include cash flow statement, it is there in this chapter only, like unit 2. But since for our better capturing the progress, better capturing the concepts properly, we have separated into company final accounts and cash flow statement. So our concentration now is on all schedule 3. Frankly speaking, my dear children, coming to this chapter, I can't tell anything. Yes, frankly speaking, I cannot tell anything, and even you cannot revise anything. Even for the main examination, waste of time to revise from this chapter. Then what is most important, sir? Time management. Practice is the most important for this chapter. Time management is most important for this chapter. Highly recommended for everybody to practice at least 1 or 2 questions from this chapter properly by keeping the time. And what is most important points of schedule 3 is once again disclosure requirements. Heads classification is too simple. If at all debtors is there, yes, you can tell it will be under trade receivables. Debentures is there, yes, you can tell it will be under long-term borrowings. Some sort of provision for tax is there, yes, you can tell it will be under short-term provisions. If provision for bad debts is there, you can tell that it has to be deducted from debtors under the head trade receivables. So all these things you can tell comfortably. Then what is the most important point? Ante disclosure requirements. This is another important point that you need to be very, very careful. And this chapter is going to become a base to you to prepare consolidated financial statements, to prepare amalgamation, to prepare the questions relating to buyback and even relating to internal reconstruction. And frankly to tell you, out of the 5 or 7 chapters that you are having, 4 chapters are basing on this schedule 3 itself. And shall I start with balance sheet, my dear children? Everybody, balance sheet, Roman number 1, equity and liabilities. I am not going to tell the entire format. I am going to tell only such format which is absolutely needed for your exam. Is it clear? Okay. Coming to equity and liabilities, the first one, shareholders funds. In that the first one, share capital. In that the next one, reserves and you are having 2 more things like money received against share warrants okati, share application money received but pending allotment okati. I'm not concentrating on those 2 things because not at all needed for the exam. So now coming on to the first thing, share capital. My dear children, coming to share capital, you are supposed to show authorized share capital separately, issued, subscribed and paid up capital separately. Issued, subscribed and paid up capital, be careful, if at all calls in arrears are there, that will become issued, subscribed and paid up capital. In that, first of all, you are supposed to write called up capital. From called up capital, you need to deduct calls in arrears. And then you are going to show paid up capital. Very, very important. For this paid up capital, you need to add forfeiture of shares which are not reissued. This is the final figure which will be shown in balance sheet, share capital. And one more important thing, while showing this authorized share capital issued, subscribed, called up, paid up capitals, please separate between equity shares and preference shares. Like 10,000 equity shares of rupees 10 each, comma 6 called up or paid up. 50,000 preference shares of rupees 100 each, fully paid up. So you check out the question and write it correctly. And very important, if at all the shares are issued for non-cash, then you need to disclose it separately. If the shares are issued for bonus, you need to disclose it separately. If at all any shares were bought back, you need to disclose separately. Respond everybody, clear? Sir, coming to non-cash, you might issue 10,000 shares for, you might issue 10,000 shares for purchase of land. That has to be disclosed separately. My dear children, also you have to do the same thing in amalgamation. Amalgamation, 1,30,000 shares of rupees 10 each, comma fully paid up, of which 30,000 shares are issued for non-cash to be limited in pursuant to the scheme of amalgamation. You are supposed to write like that clearly. And also for internal reconstruction, if it is there, you also need to write the same, of which all the shares were issued for consideration other than cash in pursuant to the scheme of reconstruction. Like that you need to disclose separately. And coming to bonus, sir, most of the times bonus issue will be adjusted and he will tell you 3,000 are bonus shares. Then simply of which 3,000 are bonus, 3,000 shares are issued for non-cash consideration, or simply you can write for free of cost in the form of bonus. Sir, 3,000 shares are issued for free of cost in the form of bonus. Is it clear, everybody? Very important. Sometimes an adjustment will be given in the question. Company declared 3,000 shares. Let the company declared 1:3. Company declared bonus in the ratio 1:3, which is not adjusted in the above balance sheet. Company declared bonus in the ratio 1:3 during the year, but not declared in the above balance sheet. Then you have to adjust. Now, very important, in one of the questions, Institute had played its game by changing the word from declared to proposed. Board of Directors proposed bonus ratio in the, bonus issue in the ratio 1:3. Then you have to ignore that, because it is just proposed, not yet declared. But Kangarlo, everybody will be adjusting the same. But this was happened. Bonus is proposed, not yet declared. So be careful. Read the question. Spend some quality time on question paper so that it will be helpful to you. Anyways, shall I proceed further? And if any shares were bought back, let the company disclose the same. Even for buyback chapter also, company had bought back 20,000 equity shares, 5,000 equity shares. Like that, just disclose the same clearly. Respond everybody, pakka. Now, moving on to the next thing, you have to disclose like this for a period of 5 years. He will ask you to prepare the financial statements for the year ending 31/3/2021. He will give you, the company had given bonus for 31/3/2000 something 1800. Is my point clear? 31/3/2021 you are preparing the balance sheet. He will give you in the information, out of these shares 2,000 shares were issued as bonus for the year 2018. Then don't think that no need to disclose that, because you need to disclose for a minimum period of, you have to disclose even that also. Respond everybody, pakka. Hey, respond clear. The next one, very important, reserves and surplus. Frankly speaking, nothing great. Whatever reserves you find, you put it under reserves and surplus. But the gameplay is only with P&L account. P&L account, check out the opening balance, add current year profit minus appropriations. Here you might get transfer to reserves and surplus, and also you might get dividend declared. Is the point clear? In one of the adjustments, it was given that the company had decided to declare the dividend on 2nd April 2011, and the company had decided to transfer 10% of net profits to its general reserve on 2/4/2011. Please don't confuse, amma. If at all the dividend is declared on 2/4/2011, since it is happened after the financial year, moreover it is a non-adjusting event, మీకు గుర్తున్నట్లయితే as per S4. Did you remember? And hence don't show this in the books of accounts at all. But remember, you may need to disclose the same as a contingent liability, or you may need to disclose the same as note. And hence in all the problems, whenever the dividend is declared after 31st March, institute after the completion of balance sheet had given a note. The institute had given a note that the company declared the dividend after 31st March, which is not to be adjusted in the previous year financial statements as per accounting standard number 4, contingencies and events occurring after the balance sheet date. Hey, respond everybody, clear? Now one more important adjustments. Remember, amma, even on 2/4/2011, if you have decided to transfer net profit to reserves and surplus, you need to adjust it in the previous year financial statements. But dividend declared should not be adjusted. Sir, ardhamainda? You need to adjust transfer to reserves and surplus, but you should not adjust dividend declared. So respond everybody, clear? This is P&L account. Apart from that, remaining all are very, very simple, normal, easy. And moving on to the next thing, amma, second one, non-current liabilities. And non-current liabilities, you will be having something called long-term borrowings. Generally here you will be getting debentures and some loans. Loan taken from Nixes Bank, loan taken from Nia Bank, some sort of bank names will be given, and he is playing some gameplay with it. In this context, you have to be very, very careful. Rupees 7,50,000 loan from SFC, State Finance Corporation, includes 37,500 interest accrued but not due entered. Did you remember? In such case, you need to separate interest accrued but not due, because that will be shown under other current liabilities, and balance of loan shall be shown under long-term borrowings. And in another question, out of 10 lakhs loan taken from Nixes Bank, 2 lakhs is going to be paid in the within 12 months from the end of the balance sheet date until. In such a case, you need to separate this 2 lakh and you need to show it under other current liabilities under the head current maturities of long-term debt. And remaining 8 lakhs, whatever is there, it will be shown under long-term borrowings. Respond everybody, clear? Also one more important thing, if any security is created, you are supposed to disclose that the loan is secured. And also you need to tell with what the security is created. I mean, like loan from some so and so bank, secured by way of hypothecating plant and machinery, like that you are supposed to disclose. Respond everybody, clear? And in non-current liabilities, long-term borrowings, deferred tax liabilities, other non-current liabilities, long-term provisions. Frankly speaking, for examination, only long-term borrowings you will be writing in every question. These 3 things are not there. So avoid and start with current liabilities, something like HTOS. Simply to tell you what will be included in current liabilities, short-term borrowings. Yes, sir, be careful. If nothing is mentioned in the question, whether is it current, short-term or long-term, that's your choice. That's your choice. Whatever you want, you can write like that. Generally, from directors, if any are there, you will be assuming it as short-term. And from banks, if anything are there, you will be assuming it as long-term. Also, related parties. Loan from related parties. Then it will become short-term. But on the contrary, you can assume however you want. Nobody are going to question that. But remember, put it under proper head. Either short-term borrowings or long-term borrowings. Trade payables. So simple, creditor. Aging schedule is not needed. Aging schedule gurtunda? Something like the total period 0 to 1 year. 0 to 1 year untundi. 0 to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Even trade receivables aging schedule is also not needed. 0 to 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Is it clear? But if at all in the question he is telling that up to 6 months separately, simply disclose 0 to 6 months. Chalu. Ante No need to write aging schedule 0 to 6, 6 months to 1 year, 1 to 2, like that debtors. Putting some figure here, putting some figure here. Antakkarledu. No need to write the entire aging schedule. Simply write debtors less than or equal to 6 months, more than 6 months. You put the figures. Respond everybody clear. If at all in the question he had given clearly up to 6 months this amount, up to 1 year this much, from 2 to 3 years this much, if at all like this the data is clearly available, then you are supposed to prepare aging schedule for sure. Is it clear? On a being safer side, I have actually provided aging schedule in the notes also. We have even provided aging schedule in the material also. Please be careful. Read that and freeze it in your brain. If at all in the examination is giving some data, you need to prepare aging schedule. Otherwise, that is absolutely not needed. Anyways, let's come back. Other current liabilities. Whatever you are having other current liabilities, you put there. And finally, short-term provisions. Hardly you will be getting provision for tax. Mostly you will be getting only one thing. Okay, respond everybody clear. And just get ready for assets. Well, coming to assets. Sir, be careful. Coming to assets, which is Roman number 2. A. In that, first of all, 1 non-current assets. Under that A, there is no name for that. Please be careful. Under A, again, number 1 is PPE. Number 2 is intangible assets. Hardly these are the things that are available. More than that, nothing is needed for you. And then B, you are having non-current investments. And no deferred tax asset is there. And no other non-current assets are there. Hardly these are the things that are available. And then straight away moving on to the second one, current assets. Coming to current assets, something like short-term, sit, see, so. And the first one, what is the first one? Short-term investments or current investments. Current investments, if any, you can put here. And the next one, trade receivable, inventory, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. Okkati gurtupetkondamma, generally, if the loans term is given, it's a liability. If loans and advances is given, that is an asset. If loans and advance credit is given, that will become liability. Loans debit is given, that will become asset. Is my point clear? And coming to the disclosure requirements, frankly speaking, nothing. Short-term investments, quoted, unquoted, you are supposed to disclose. Yeah, one more thing, sorry. Coming to PPE and intangible assets, you are supposed to show the format clearly, like how the opening had become closing. Opening balance, add all the purchases, minus all the sales, depreciation, impairment of loss, and finally you will be getting closing. Coming to investment, you are supposed to know how much is quoted, unquoted, listed, unlisted, but that is not there in the problems at all. And trade receivables, aging schedule. Be careful, if any provision for bad debts is there, it will have to be deducted only from debtors. It should not be shown under short-term provisions. Remember, akkadaina, no, it's not possible. You have to deduct provision for bad debts only from debtors. And be careful, 2 more things, bills payable and bills receivable. Bills payable will be under trade payables and bills receivable will be under trade receivables. Be careful, the next one, cash and cash equivalents. If any cash equivalents are there, it has to be disclosed separately. You can't tell total cash equivalents. If anything is given, then disclose separately. And one more important thing, cash with unscheduled banks, if any is there, disclose separately. In one of the questions, balance with Omega Bank Limited, which is unscheduled entered. If any unscheduled, then it has to be disclosed separately. And if at all foreign currency is there, then even that is also to be disclosed separately. And finally, other current assets and short-term loans and advances. They are quite common. Now, one more thing, loans and advances is generally short-term, that is asset. Loans is generally long-term, that is liability. If nothing is given, you can simply assume like this and you can write. Loan from related parties short-term money, loan from directors short-term money, loan from banks long-term money. Instead of remembering that many things, if it's loan and relating to liability, simply long-term. If it is loans and advance relating to asset, it is short. Respond everybody clear. Hey, one more important thing, advance tax. will be under short-term loans and advances. Advanced tax, there are people who will be writing it under other current assets. Jagrata. Advanced tax should be under short-term loans and advances. Bank overdraft, don't think that it shall be shown under other current liabilities. It should be shown under short-term borrowings. These are some heads where students generally confuse. Employee stock options outstanding account will be shown under reserves and surplus. Hey, respond everybody clear. And coming to P&L account, I am not discussing once again because I have clearly told you while telling consolidated financial statements, and special element there you need to take about production expenses. Coming to production expenses, it can be either under cost of raw materials consumed or it can be other expenses. Chala important, director salary or director sitting fees should be under other expenses. It should not be taken under employee benefit expenses. Director is not employee as per schedule 3. Director is a managerial person, and whatever you are writing about director expenses, it should be under other expenses. Respond everybody pakka. Sir, and moving on to, yes, be careful. One more small point. You generally don't read the first lines of the question. First lines of the question we don't read, but gameplay by the institute will be done there also. ABC Investment Company Limited antadu, and he will be given in the question something like dividend received antadu. All of a sudden manam em chestamante dividend received is an investing and it is not revenue from operations, other income and rastaru. Hope you might have understood the logic here. Since it is an investment company, dividend received will become operating and it should be under revenue from operations. Sir, never do like that. Please read first line of the questions very, very carefully. Respond everybody pakka. TDS receivable, other current assets. TDS payable, other current liabilities. Now, one more important thing, be careful. Discount on issue of debentures. Discount on issue of debentures. Portion which is written off will be shown under other expenses. Portion which is still balance is shown under other non-current assets or other current assets depending on the period. Respond everybody clear. And my dear children, frankly speaking, this is what your schedule 3, to the most extent what are important, I have covered those things. Of course, I did not cover everything outright. And be careful, in one of the questions you will be having suspense account. Suspense account represents cash received from sale of asset. And he had written something like cash account debtor to suspense account, but you have to write the entry like, the correct entry is like cash account debtor, accumulated depreciation account debtor to asset account to profit or loss. But he is passing simply this entry. So the rectification entry will become suspense account debtor, accumulated depreciation account debtor to asset account to P&L account if profit. Respond everybody pakka. Sorry, some more important things where you should not deviate, remember. Point number 1, profit on sale of asset is an exceptional item. All the exceptional items should be shown separately as per AS5. Kani veedemantadante profit from sale of asset will be shown under other income in all the institute materials. Profit from sale of asset is obviously a dash item, exceptional item, and it should be shown under exceptional item separately. Profit or loss before exceptional item and he has to add there. But all the institute materials have added in under other income. Jagrata. Nowadays, fashion intended CA questions posed by CMA, CMA questions posed by CA. This is fashion. So if you are preparing in CMA material, profit on sale of asset is clearly shown as an exceptional item. If this question is, this point is given in exam, now what is our situation? You write it under other income. After the completion of the question, note. Alternatively, profit on sale of asset is an exceptional item and disclose it separately. Did you remember I told you also to write one more note relating to amalgamation? Amalgamation in the nature of merger. If at all PC is less than share capital, credit it to P&L account, but as per expert advisory committee, it has to be credited it to capital reserve. That is one more point. Respond everybody clear. Now one more important thing. Gurtupettukondi. What is it called? Advance tax is given in the question. Provision for tax is also given in the question. Frankly speaking, these two have to be set off as per accounting standard number 22. In the institute material problems, this is shown under short-term provisions. This is shown under short-term loans and advances. And in one of the RTP problem related to CA Inter, these two things were set off, which was given in your assignment problem, self-practice. In study material followed like this. In RTP followed like this. Now em cheyamantaru sir? Same note. Show it under short-term loans and advance, show it under short-term provisions, and simply note. Respond, is it clear? So please be careful. You show these two things separately and as per AS 22, these two things can be set off. You also show that note separately. Respond everybody pakka. And yes, provision for tax, suspense account. Yeah. As far as I have remembered, covered all the important points, even relating to company final accounts. The last and final part we need to discuss is all about dividend. Sir, there are rules relating to dividend as per company's declaration and payment of dividend rules 2014. What are these rules, sir? My dear children, if at all you are having sufficient profits, then you can comfortably declare the dividend, and these rules are not at all applicable. These rules are applicable only when you would like to declare the dividend from past accumulated profits, including P&L account opening balance. Because P&L account opening balance kuda past accumulated profit hai kada. Now, coming to past accumulated profits, if at all you would like to declare the dividend from these profits, then start with the rules. Rule number 1, your maximum rate of dividend should not exceed average of past 3 years rates of dividend. My dear children, if at all the company did not declare dividend in any of the past 3 years, then this rule is not applicable. That is chala important. You may not take it, but in the question is totally common. What I am just saying, only past 2 years data will be given. Then you should not take 2 years average. Is it clear? If any of the past 3 years, if the company did not declare the dividend, then this rule is not applicable. Respond everybody clear. And the second one, maximum amount of withdrawn is equal to 10% of paid up share capital plus reserves and surplus. Here paid up share capital includes both paid up equity share capital, preference share capital. Reserves and surplus includes all the free reserves, securities premium, and capital reserve realized in cash. Free reserves includes, reserves and surplus includes free reserves, securities premium, capital reserve realized in cash. Revaluation reserve balances are all not considered. Respond, is it clear? This much amount you can withdraw. Sir, frankly speaking, this problem is also easy. Provided if at all new points are added, then you will suffer. So concentrate on the rules rather than the problem. And minimum amount that is to be maintained after withdrawal is equal to 15% of paid up share capital. Is it clear? Yes, sir. Ivanni baane gurtuntai. But in examination, you will get confusion. Is it 10%? Is it 10%? Is it clear? So for that, generally name cheptanante maximum amount you can withdraw is 10% of lesser percentage, more amount, more percentage, lesser amount. That is paid up share capital. Ante. Here, paid up share capital plus free reserves. Respond everybody clear. And one more very, very important thing. Amount so withdrawn has to be first utilized for setting off of current year losses or current year unabsorbed depreciation. Respond everybody clear. Amount so withdrawn has to be first utilized for setting off of current year losses or current year unabsorbed depreciation? Respond everybody, pakka. And my dear children, this is the end of company final accounts. I hope even this is also absolutely revised for you. So let me start with the first standard now, that is all about accounting standard number 22. My dear children, what is AS 22? Accounting for taxes on income. So the name itself is telling that this standard is applicable only for taxes on income, that is income tax. So this is not applicable to any other taxes. Any other taxes implies it can be either GST, customs, wealth tax, property tax. To any other taxes except income tax, this standard is obviously not applicable. This standard most clearly concentrating on something called matching concept. For your kind information, you will be getting some profit as per your statement of profit and loss. But you need to pay income tax as per the profit that is computed as per your tax records. You are getting profit as per statement of P&L account, but you have to pay tax as per the profit that is computed as per tax records. And automatically, in order to have matching concept, you have to compute tax on profit as per accounting records, but you are paying as per tax records. So automatically two violation points are there. Two different points are there where these two things must be streamlined, and here we are going to streamline these things. Shall I start now? Okay, so now, sir, as per accounting standard number 22, what is accounting income? Profit or loss computed as per statement of P&L account is accounting income. And what is taxable income? Profit or loss computed as per tax records, which is nothing but net total income, is nothing but taxable income. Net profit, whatever we tell, that is called as accounting income. And moving on to the next thing, Amma, tax as per accounting records is called as tax expense. Tax as per accounting records is called as TE, tax expense, whereas tax as per taxable income is called as CT, current tax, tax as per taxable records. Difference between TE and CT is nothing but DT, deferred tax. Difference between tax expense and current tax is nothing but deferred tax. In other words, tax expense is also the combination of CT and DT. Deferred tax is the difference between tax expense and current tax. And tax expense is the combination of CT and DT. Please be careful. Now, as usual, everybody will be generally telling these kind of examples. Our net profit as per accounting records is 1 lakh. But whenever you take 1 lakh as base and whenever you do all the PGBP adjustments, like plus or minus all the adjustments, and then you will be left with some, say, 1,20,000. And automatically, in order to maintain your matching concept, your profit is 1 lakh. And say, for example, if tax expenses, tax rate is 30%, you need to compute your tax expense on 1 lakh. That is 1 lakh into 30%, which comes to 30,000. But you need to pay as per which records, Amma? Taxable records. As per taxable records, what's the profit, Amma? 1,20,000 on 30%, which it comes to 36,000. So my question, how much you're supposed to pay, Amma? 36,000. So my dear children, 2, you need to create provision for tax. But from now, as per AS 22 language, it is not called as provision, it is called as current tax. So 2 CT, current tax, which comes to 36,000. But for your kind information, the original tax expense should be 30,000. Excess, how much is there? Immediately credit that 6,000. Immediately credit that 6,000, which is nothing but by DT, deferred tax. So finally, if you observe, 36,000 minus 6,000, net is nothing but 30,000, which is exactly matching to your tax expense. So that is how CT will be combined with DT, and automatically you are going to get tax expense. And if you write entry for this one, what is the entry for this one, Amma? DT account debtor to P&L account. Since DTA debit side, it is nothing but EA. DTA account debtor to P&L account. And let me make it more clear, very simple. How much you are supposed to pay? Hey, no. How much you are supposed to pay? 30,000 you are supposed to pay. You have to follow as per accounts records, kada. How much you are supposed to pay? 30,000. But tax records are forcing you to pay how much? Extra how much paid? That's nothing but a kind of prepaid expense. You have to pay 30, but you are paying 36. So 6,000 is nothing but prepaid expense. Prepaid expense is your asset. Now replace the same. 6,000 is your DTA, deferred tax asset. I hope it's more clear. Okay. Now moving on to the next thing on a reverse note. Say for example, again it is 1 lakh. But as per tax expense, now it comes to, as per tax records, it comes to 90,000. So you're supposed to pay CT, am I correct or wrong? 90,000 into, which comes to, but how much should be the tax expense as per accounting records, Amma? So shortage, how much is there, Amma? So you need to create DT. Frankly speaking, L. So conclusion, TE is equal to CT plus DTL or CT minus DTA. CT minus DTA. Is my point clear, everybody? So in P&L account, dash tax will not appear directly. Tax expense. Tax expense appears in the form of CT and DT. Tax expense appears in the form of CT and DT. Is it clear, everybody? Fine. Minimum introduction is completed. Now moving on to the next thing. Sir, this is absolutely fine whenever you are having each and every data. But what happens in the sense, in the examination you may not have each and every data. You will have only one point. You will have only one adjustment. How to crack with that adjustment, sir? I'll tell you some rules you remember. Rule number 1. Check out, first of all, whether is it timing difference or permanent difference. What do you mean by TD and what do you mean by PD, sir? Sir, the difference which is arising in the current financial year and reverses in the next financial year, we'll call it as TD. Timing difference. Difference arising now and which will never get reversed is called as permanent difference. What do you mean by reversing, sir? Say for example, if the total expense is 10,000. If the total expense is 10,000. In accounting records, 10,000 first year itself you have booked. But as per tax records, you are amortizing it for 5 years. So first year 2,000, 2,000, 2,000, 2,000, 2,000. Like this you are booking for 5 years in tax records. In accounting records, what happened, Amma? 10,000 booked. In tax records, what happened, Amma? 2,000 booked. More expense booked 8,000 in accounts records. From next year, what happened? Less expense 2,000, less expense 2,000, less expense 2,000, less expense 2,000. More 8,000 is getting reversed. Less 2 into 4 years, which is 8,000. This is called as reverse. Reverse is nothing but if first year it is more, further it will be less. If first year it is less, further it will be more. Is my point clear, everybody? If first year it is more, further it will be. If first year it is less, further it will be. And you can also take the example in tax records. First year less. And hence further it is more. Hey, respond, is it clear? Because 8,000, 2,000. Next it's like 0, 0, 0, 0. Kada? So first year it's like less in tax records. And further years it's like more. Hey, respond everybody, pakka. And my dear children, this is what your timing difference and permanent difference. Timing difference. Permanent difference, and there is a difference now which will never get reversed. Best example everybody will be telling, section 48. Disallowance in excess of rupees 10,000 per day per person. Per day per person. For a single person on a single day, if you are paying more than 10,000 expense in cash, then automatically that is disallowed. But is this treated as expense as per accounting records or not? Is this treated as expense as per accounting records or not? Of course, yes, it will be treated as expense as per accounting records for sure and sure. Pakka it will be treated as expense as per accounting records. But this is not an allowable expense as per tax records in this year. Okay, in next year will it be an allowable expense? In later year will it be an allowable expense? Ante forever it is not allowed in tax record. So this is dash difference, permanent difference. I hope the concept is clear, everybody. Difference arising in one period, and if it is getting reversed, we will call it as timing difference. Difference arises in one period and it is not getting reversal in any of the periods, and hence it is like permanent difference. Now you need to create DT only for timing difference, no DT for permanent difference. Create DT for, participate everybody, create DT for timing difference, don't create DT for permanent difference. Is my point clear, everybody? So rule number 1, first of all you need to check out whether there is difference or not. If there is difference, you need to check out whether is it TD or PD. If it is PD, no DT required, so cancel. If it is timing difference, DT is absolutely required. Continue. Next one, check out whether is it originating difference or correspondence difference. Correspondence is also called as reversing difference. Is it difference arised in first year or difference arised in further years and getting reversed? Is my point clear? If it is originating difference, you need to create. If it is corresponding difference, you need to reverse. If it is originating difference, you need to create. If it is corresponding difference, you need to reverse. Just answer me. First year you have seen the difference. In accounting records it is more. First year. Create a reverse. Create a reverse. Create, because that's first year. Next year also more. Create. First year more, next year also more. And the difference is not getting reversed. Is my point clear? In the third year also it is more. In the next year less. Reverse. In the next year less. That is how you have to manage. And say for example, as per accounting records, in the first year less, what to do? Create. First year differences, originating differences, always create. Further less. Further less. Further more. Reverse. I hope it is also clear for you. Okay. So what is rule number 1? You need to identify the timing difference or dash difference, no need to consider. Dash difference you need to consider. Next one. After that you need to check out whether is it originating difference or correspondence difference. Originating difference aithe you need to. Corresponding difference aithe you need to. Respond everybody clear. Okay. Next one. Third one. Sir, I'm telling you a thumb rule. If you want, you can put any kind of thumb rule, but I will generally tell this rule because it is very simple. If expense is more in accounting records, create DT. Yay. What is this thumb rule, amma? If expense is more in accounting records, you need to create DT. Yay. You remember this one, by heart this one, and remember this one. I'm pretty sure you can answer any kind of problems with these rules. Pretty sure you can answer any kind of problems with these rules. What is rule number 3, amma? If expense in accounting records is more, you need to create DT. Yeah. Is it clear? Pakka. Okay. If at all it is first year, if expense is more in accounting records, you need to create DT. Yeah. Okay, shall I proceed further? Just check out. Come to this one. You have actually created DTA to the extent of 6,000. Am I correct or wrong? Why are you creating DTA ante? Tax as per accounting records is 30,000. Tax as per tax records is 36,000. And tax as per accounting records is less. Which implies that income is also less. Which implies that expense is more. So if expense is more in accounting records, you need to create DTA. Respond everybody clear. Not yet over. The next last and final rule, which is rule number 4. Creation of DTA similar to reversal of DTL. I am not telling it is exactly same. Similar. And whatever rules here applicable, the same rules are also here. And creation of DTL is similar to reversal of DTA. If you have remembered these rules, you can answer any kind of problem. Of course, I'll be opening 1 or 2 problems and will be making you to exercise basing on these rules so that you feel the easiness of these rules. So start everybody. What are the 5 rules? Point number 1, you need to identify the difference. Whether is it TD or PD. Don't consider dash difference. Consider dash difference, timing difference. And if it is originating difference, you need to. If it is corresponding difference, you need to reverse. And what is the thumb rule, Amma? If expense is more in accounting records, you need to create. And remember at the last thing, creation of DTA is similar to reversal of DTL, and creation of DTL is similar to reversal of DTA. Is it clear, everybody? Okay. Now, just wait. Check out. Yeah, so just concentrate on the first example, then I'll tell you the example as per the material. Say for example, concentrate everybody. Depreciation as per accounting records is equal to 10 lakhs and depreciation as per tax records is equal to 12 lakhs. Depreciation as per accounting records is 10 lakh, depreciation as per tax records is equal to 12 lakh. Start everybody, first one. Depreciation, expense or income? Expense. In accounting records, less or more? If expense more, I ask you to create. But expense less, you need to create. Is the point clear? Now, the next one. You need to check out whether is it new difference or reversal of difference. You need to check out whether is it new difference or reversal of difference. Shall I start? Sir, since no information is there, we can generally assume that it is new difference. If it is new difference, create a reversal. So create DTL. Respond everybody, pakka. Sure. Next one. Concentrate. Preliminary expenses, 10,000. As per accounting records, how much you need to write off? 10,000. As per tax records, how much you will write off? 2,000 per annum. Am I correct or wrong? Start everybody. Accounting records. Preliminary expense or income? 10,000 to 2,000. Accounting records, more or less. If expense is more, you have to create DTA, which is similar to reversal of DTL. Now, if it is new difference, this is the answer. If it is correspondence difference, this is the answer. Start. Is the information anything available or not available? Moreover, we are assuming that it is in year. And is it arising difference or corresponding difference? And hence creation of DTA is your answer. Respond everybody, pakka. Now concentrate carefully, everybody. Last year interest incurred but paid in current year. Rupees 10,000. How much you need to create in the current year? Like, do you need to create DTA or DTL? This is the question. Shall I start exercising this question? Concentrate carefully. Sir, is this relating to current year or last year? Last year. But he is asking the adjustment in which year? So, now be careful. First of all, you need to identify the section and identify the difference. Last year interest incurred but paid in current year. And this is relating to section 43B. Payment is allowed on actual basis, payment basis, cash basis. Sir, gurtochinda? Of course, AS 22 ravalante kachithanga you need to brush up with tax provisions, especially PGBP. Adi unavoidable. And hence I am reminding the provision also. And you know, the most beautiful thing, except preliminary expense, depreciation, section 43B, section 40A3, donation to private trust, except some these popular provisions, all the remaining provisions, if any he is trying to ask, he will give in the question itself. Provisions also he will give in the question itself, Antunna. So that you will feel very comfortable of solving. And vaadu kuda mimmalni ardham cheskunnadu. Tax provision he will give in the question itself, you don't worry. Anyway, start. Sir, as per section 43b, you are having 6 items if I was not wrong. Bonus, royalty, interest, cess, tax. Did you remember? You need to allow all these things on actual payment basis or cash basis. Now, last year interest incurred but paid in the current year. As per income tax record, in which year it is expense? Last year or current year? But as per accounting records, in which year? Because last year you have incurred the expense. Clear? In current year, what is the accounting expense with respect to interest? 0. But what is tax expense? 10,000. Hey, shall I continue? Now concentrate. Interest expense. Accounting records, more or less? Less. If expense is less as per accounting records, you need to create DT. More aithe DTA anna kada. If it is less, then automatically DTL. Be careful. Creation of DTL is similar to reversal of DT. Now you need to find whether is it creation or reversal. Point number 1. Is it new difference or corresponding difference? Because it is a difference fetched from the last year. Since it is corresponding difference, creation answer or reversal answer? So finally, what is the answer? There ends the matter. I hope you are very comfortable in solving with these rules. I seriously don't know how you have learnt it. If you have learnt in similar lines, then it's fine. Otherwise, these 5 are the simple rules to crack AS22. Pretty sure 5 simple rules to crack AS22. Simple. Now, moving on to the next thing. Listen carefully, everybody. Say, for example, it's income. Income in accounting records is more. What to do now? Expense more aithe, I am asking you to create DT. Yeah. Ade income more aithe, there ends the matter. Is it clear, everybody? Income less aithe, sir, create DTA when expense is more antunam. Expense is more ante income is less ane kada. You need to create DTA. I hope you are very comfortable in this. Pakka? Sorry. Let me tell you one deemed assumption. Deemed assumption. What is that? Sir, depreciation in accounting records, deemed assumption, you will be following SLM method. For the purpose of this standard only. Depreciation in, what is it called? Tax records. You will be following WDV method. Under SLM method, depreciation is uniform every year. Under WDV method, depreciation decreases over the period of time. Ante depreciation decreases over the period of time ante depreciation as per taxable records in the first year anatledu. Be careful. Initial years is higher. And depreciation in accounting records in the initial years is lower. This is deemed assumption. Depreciation as per accounting records in the initial years will be lower. Depreciation in tax records in the initial years will be higher. Is my point clear, everybody? Sir, is my point clear, everybody? Pakka? That's it. Remember this assumption because you may need to play with this assumption while solving the problems. Shall I start telling you the application of these rules? Okay, I already told you, but once again, concentrate. You are having some data like opening balance is given and following transactions during the year were given. Check here. Depreciation as per accounting records, depreciation as per tax records. Point number 1, depreciation ante expense or income? It is expense. Expense as per accounting records, less or more? If expense in accounting records is less, you need to create DTL, which is similar to reversal of DT. Now identify whether is it new originating difference or corresponding difference. Originating or correspondence. Generally evanukuntarante, sir, since opening balance is available, this is obviously corresponding difference. But I told you one deemed assumption. What is the deemed assumption ante? Depreciation as per accounting records during the initial years will be lower. Depreciation as per initial years as per tax records will be higher. Sir, అర్థమైందా? Initial years ante for some years depreciation as per accounting records is lower, tax records higher. So you need to create a reverse. Cheppalama, create. Again lower. Again lower. Again lower. Now more. This is the point relating to depreciation. In the initial years, accounting records depreciation will be lower. Now tell me here, is it creation or reversal? Creation or reversal? Creation of DTL. Take the difference, 20 minus 15, where you will get 5 lakhs multiplied by 15% is your answer. Respond everybody, pakka. Now be careful. Donation to private trust. So donation to private trust. Is it allowed as per Income Tax Act? Answer, no. As per Income Tax Act is not allowed. So is it TDA, PDA? Timing a permanent. And hence automatically no need to consider this for deferred tax. Next one. Items disallowed for tax purposes in 21-22 but allowed in 22-23. Sir, 22-23 ante current year. But these are disallowed in the last year. Since nothing is mentioned, items disallowed means expenses disallowed. మీరు అడగచ్చు సార్ ఐటమ్ అంటే ఇట్ కెన్ బి ఎక్స్పెన్స్ ఆర్ ఇన్కమ్ ఆల్సో కదా సార్. అవునమ్మా, బట్ జనరలీ డిజలోడ్, ఐటమ్స్ డిజలోడ్, ఎక్స్పెన్స్ డిజలోడ్, డీమ్డ్ అజంప్షన్ అగైన్. ఐటమ్స్ డిజలోడ్ అంటే ఇట్ ఇంప్లైస్ దట్ ఎక్స్పెన్స్ డిజలోడ్, దట్స్ ద మీనింగ్. ఏ రెస్పాండ్ ఎవ్రీబడి క్లియర్? Now expense disallowed in the last year as per tax records, but in the current year as per tax records it is allowed anta. So answer me, expense as per accounting records in the current year 0. As per tax records it's 1.05. Now start telling me expense as per accounting records is less. Expense less aithe you need to create DTL, which is similar to reversal of DTA. Now tell me what is applicable here. Creation or reversal? Because this is corresponding difference. So reversal of DTA is the answer. Difference 1.05 multiplied by 15%. I hope you are comfortable in answering. Next, last and final, interest paid to NBFC accounted in the books on accrual basis but paid on 36/2023. But paid on 36/2023. This is also same amma. Interest expense incurred in the last year as per accounting records it's expense, but as per tax it is allowed on actual payment basis, so it is allowed in the current year. So same, whatever is point number D, that is similar to point number C. Is my point clear everybody? Okay, now ఏమైంది wrong? ఇయర్ ఆఫ్ మీ వ్యూ ఏంటో చెప్తే నాకు అర్థమవుతుంది. హూ ఇస్ దట్? వాట్స్ యువర్ ప్రాబ్లం? దీనికోసమా? అది నెక్స్ట్ ఇయర్ వస్తుందా? ఓకే, ఫైన్ ఫైన్. సో ఏమి చెప్పకుండా లోపల లోపల దాచుకుంటే ఎవరికి తెలుస్తుందమ్మా? ఫైన్. యూ హవ్ పేడ్ ఇంట్రెస్ట్ ఆన్ 36/2023 అంటే ఇట్ ఈస్ ఆబ్వియస్లీ 23-24 అండ్ ద కరెంట్ ఇయర్ ఇస్ 22-23. ఈజ్ మై పాయింట్ క్లియర్? బట్ వన్ మోర్ క్యాచ్ ఏంటంటే వీడేమంటాడంటే, ఐ హోప్ యూ హవ్ రిమెంబర్డ్ సెక్షన్ 43B వేర్ యూ హ్యావ్ టు డూ సమ్ actual payment or payment deduction is allowed only on cash basis and the time to take it as expenditure is up to the due date. Tax provision gurtuleda? Fine. Listen. Say for example, the expense is relating to 22-23 but you are paying in the year 23-24. As per accounting record, since you have incurred the expense in the financial year 22-23, you need to consider it as expense for the year 22-23. Is this point clear? Respond, is this point clear? In 23-24, you are paying this as an expense. You are paying. So as per tax records, you are paying in 23-24. But do you need to consider the expense in 23-24 or 22-23? For this, when are you paying is important for me. If you are paying on or before due date of filing of return relating to 22-23, then whatever the expense you have paid, it is taken in the financial year 22-23 only. But if you are paying the expense after the due date, then you need to consider the expense for 23-24 as per tax records. Sir, ardhamainda? Simply like adjusting event and non-adjusting event. If at all, before the date of approval, if a prior period item is identified, it has to be adjusted in the previous year financial statements. If a prior period item is identified after the date of approval, it has to be recorded in the next year financial statements. The same logic. If at all you are paying the expense on or before the due date, you have to consider the same expense in the previous year financial statements. But if you are paying the expense after the due date, you need to consider the same in the next year financial statements. Respond, everybody, clear? So, now frankly speaking, this company had paid the expense on 30/6/2023, which is on or before due date. Because for companies, if I was not wrong, the due date is 30th September. For companies, 31st July is for individuals. But for companies to file the due date of return is 30th September. So on or before 30th September, since this company is paying, it is obviously considered as expense which is allowed in the financial year 22-23. Respond, everybody, clear? Fine. So in 22-23 you have incurred an expense, but you are paying an expense on 30/6/23, that is in the financial year 23-24. The due date of filing of return is 39. Since the expense is paid on or before due date, this is considered as expense in the financial year 22-23 even as per tax records. And accounting records of 22-23. Tax records to 22-23. So automatically there is no timing difference. Respond, everybody, clear? But say for example, if you are paying it somewhere on 1/11, if you are paying on 1/11, then as per tax records it will be allowed in the year 23-24. So as per accounting records for the current year, since the expense is more, you need to create DTA. Respond, everybody, clear? Fine, my dear children, this is what the problem. And I guess this is also okay. And if you observe, depreciation as per accounting records lower, depreciation as per income tax records higher. Depreciation is nothing but expense. As per accounting records lower. Deemed assumption, already we have discussed that during the initial years depreciation will be lower, and hence you need to create DTL. Now the next one, be careful with the terminology. Unamortized preliminary expense. Amortize ante it is appearing in P&L account ani artham. Unamortized ante it is not there in P&L account ani artham. Now unamortized preliminary expense as per tax records. And as per tax records, 30,000 value of preliminary expense is not there in P&L account, which implies that this is there in the P&L account of accounting records. So is the statement clear? Unamortized, not there in P&L account as per tax records. And this 30,000 is there as per accounting records. So preliminary expense as per accounting records is higher, tax records is lower. Since expense is more, you need to create DTA. Since nothing is mentioned, you need to consider it as originating difference. Respond, everybody, clear? And if you have observed this problem, as per financial statements, ante that is as per accounting records. On income tax purpose, some amount is given. As per accounting records, revenue ante income is recognized like this: 11, 16, 21. Revenue, accounting records 11, 16, 21. Tax records, revenue 7, 18, 23. He is asking you to create DT. First of all, check out whether the total is getting matched or not. 11, 16, 21. 40, 7, 18, 23. And automatically, since the total amounts are same but differently booked, this is dash difference. Confirmed with timing difference. Next one. First, if you observe 11, 7. Accounting records, it is more. Is it clear? And the next one. 16, 18. Less. 23, 21. Less. So one thing is confirmed. Here, create. Reverse. Reverse. Since it is revenue and income. Income as per accounting records is more. Create DTL and automatically reversal of DTA. How much amount? Take the difference, 11 minus 7. 4 into tax rate. 2 into tax rate. 2 into tax rate. I hope ACE22 is very comfortable for you. Frankly speaking, with these 5 rules, you can solve any kind of problems. Except the last one, where you are having investment in joint venture. Star Limited, Ma Limited, Z Limited, Sony Limited. That's a typical problem. You have to think that carefully. You try to solve it by your own. And even that can also be applied by these rules. But accounting is very differently set there. Ante. Shall I proceed further? Okay. Now moving on to the very, very important thing. Remember, for DTA and DTL, be careful. Are there any rules? Simply for DTL, no rules are there. It should satisfy the definition of liability. But for DTA, some rules are there. DTA under normal cases, you should have reasonable certainty. DTA under loss case or unabsorbed depreciation case, you should have virtual certainty. What do you mean by reasonable certainty? Where did you learn reasonable certainty? Is 29, no reasonable certainty there. Is 19, perfect. In AS 19, finance lease law, condition number 2, lessor should have reasonable certainty that lessee should exercise the option to purchase the asset at the end of lease term. Hey, did you remember? Reasonable certainty, maximum chances. Virtual certainty, 100% chances. Where you have already learned virtual certainty in AS 29. Creation of provision for future obligation only when there is virtual certainty. Sir, what is reasonable certainty? Please participate. Reasonable certainty, maximum chances. Virtual certainty, 100% chances. So, under normal cases, to create DTA, you should have reasonable certainty that there should be profits in future. There should be profits in future. Under loss or unabsorbed depreciation case, you can create DTA provided only when there is virtual certainty. Only when there is virtual certainty. Hey, respond everybody clear. DTA under normal cases dash certainty, reasonable certainty. Under loss cases dash certainty, virtual certainty. Shall I continue? Hey, be careful, huh? Be careful. Accounting loss, taxable loss, 1 lakh. No timing difference. Tax rate is equal to 10%. Is DT required or not required? This is challenging actually. No timing difference. Accounting loss or taxable loss same. Tax rate 10%. Do you need to create DT or not required? Yes, you need to create DT. And then sir, even though there is no timing difference. Wait. As per income tax records, there is a concept called set off or carry forward of losses. And the current year, if any loss is there, that can be carried forward up to next 8 years, up to next 4 years, and you can set off. So this is nothing but timing difference. And frankly speaking, apparently no timing difference is visible. Kanpiyadu. But whatever loss, you can set off the same loss in future for payment of taxes. Ante kada? Say for example, in future you have got 3 lakhs profit. Will you pay tax on entire 3 lakhs? You'll set off. And you are carrying forward the loss from the previous year, which is nothing but a kind of timing difference. Is my point clear? So please be careful, my dear children. In case of loss, even though there is no timing difference, you need to create DTA, provided there should be virtual certainty that company is going to get profits in future for sure. 100% chances that company should earn profits in the next 4 years, in the next 8 years. Only then you can carry forward and only then you can create DTA. Otherwise you should not. Respond everybody, clear? Let me tell you in this context, concentrate carefully. Year 1, year 2, year 3. Accounting records, taxable records. 1 lakh, 1 lakh. In the next year, profit 50,000. In the next year, profit 60,000. Shall I start now? Sir, everybody check out. In the first year, since loss is there, you need to create DTA provided if there is. Cheppali, provided if there is. And assume that there is virtual certainty if no information is there. So assume that there's virtual certainty. On 1 lakh, you need to create DTA, say 30%, which comes to 30,000. Respond everybody, clear? Ante, how the P&L account is? To net loss brought down 1 lakh and you are creating DTA 1 lakh into 30%, which comes to 30,000, and finally carried down 70,000. Net loss brought down 70,000 after applying tax shield. In other words, it is as per AS 22, it is called as tax savings. In your FM language, it is called as tax shield. As per AS 22 language, it is called as tax savings. Shall I proceed further? In year 2, how will it be? In year 2, we have got profit. By net profit brought down 50,000. Frankly speaking, do you need to pay the tax or not? Frankly speaking, you have to pay tax on 50,000. But since last year loss 1 lakh is carried forward, no need to pay the tax. Respond, ra? And frankly speaking, 2 CT, that is equal to 0. That is equal to 0. But why it had become 0? Since last year loss is carried forward. Respond, ra? Since out of last year 1 lakh loss, 50,000 is carried forward and settled. Out of last year DTA, you need to reverse some portion. 50,000 into 30%. 15,000. Respond logic clear? Respond everybody, pakka. That's it. And frankly speaking, as per your income, as per your accounting records, profit is 50. So tax expense should be 15 kada. And that is nothing but 0 plus 15. On a whole, it comes to 15. Respond, is it clear? And finally, carried down. 35,000 is your net profit for year 2. This is nothing but reversal of DTA. Gurtupetkondi. This is called as creation of DTA. Shall I proceed further? Last and final, year 3. How is it? Be careful. Total net profit this time is 60,000. As per income tax record, still how much loss can be carried forward? 50,000. But how much profit I have got? So you have to pay tax on how much amount? Into 30%, which comes to? Respond everybody, clear? So 2 CT, 3,000. But frankly speaking, how much you are supposed to pay? Ante 60 into 30%, 18,000 you are supposed to pay. But out of 18,000 you are paying only 3,000. What about remaining 15,000? Why are you not paying, sir? Because I am having loss which is settled. I am having loss which is set off. So you need to reverse to DTA. How much amma? 50,000 into 30%, 15,000, and that is how it gets matched. Hey, respond everybody. Is the last case also clear? Pakka. Done with this one. And tax holiday. Sir, I'll tell you the rule, you apply. Rule is very simple. Sir, first of all, remember, for DTA and DTL, you need to apply future tax rates is available, but not the present tax rates. For dash and dash, DTA and DTL, you need to apply future tax rates if available, but you should not apply present tax rates. And what to do, sir? Say, for example, you were given with tax holiday for year 1, year 2, year 3, year 4, year 5. And from year 6, you are coming under normal tax slabs. So year 1, 0, 0, 0, 0, 0. From year 6, you don't know what is the tax rate. Because you are actually at year 1 kada. What is year 6 tax rate? You don't know. But year 1 normal tax rate is 30%. So apply 30% from year 6. Logic understood? Tax holiday is given for how many years? So for 5 years, what is the tax rate, amma? 0. From year 6, what is the tax rate, amma? We don't know exactly, but since present tax rate is 30%, assume the same will continue in future. Shall I continue? Now, rule emante, such a timing difference arising during the holiday period and reversing during the holiday period, no DT is required. Arised in holiday period, reversed in holiday period, no DT is required. Such a timing difference arised in holiday period, but reversed after holiday period, DT is required to the extent of available tax rate. Say, for example, in the first year, timing difference arised 60 lakhs. Second year, timing difference arised 120 lakhs. From the third year, it is getting reversed. Hey, is it clear? How much is getting reversed? 40, 40, 50, and remaining is getting reversed in the next year. Is my point clear? Everybody pakka. Now concentrate. Sir, how much is the TD arised during the holiday period? Total TD arised is 180 lakhs. How much is reversed during the holiday period, amma? 130 lakhs. How much is arised after holiday period, amma? 50 lakhs. Is the point clear? Answer these questions. How much is the TD totally arising during the holiday period? 180 lakhs. How much TD reversed during the holiday period? 130 lakhs. How much reversed after holiday period? Now, very important. How much TD arised and reversed during holiday period? 130 lakhs. So, no DT is required for 130 lakhs. No DT is required for. But while checking 130 lakhs reversal, you need to follow FIFO. At the first year, they should reverse first. And you can't tell. Third year, how much is reversing? I will reverse it from year 2, sir. Chichi, alagudardu. This 40 lakhs has to be reversed from year 1. Balance, how much is there? Year 4, how much is reversed? But minus 20 from here, another 20 from here. And another 50 reversing from second year. Balance, you will be left only with 50 lakhs. So now you need to create DT in year 2. No DT is required in year 1. Is my point clear, everybody? Rule entamma? TD arising during holiday period and reversing during holiday period. No DT is required. Is this clear? But TD arising during holiday period and reversing after holiday period, DT is required. Respond everybody, clear? That's it, remember. Last and final concept, MAT. Minimum alternate tax. Hope you are very comfortable with MAT provision as per Income Tax Act. Sir, under normal provisions, you are supposed to pay 1 lakh tax. Under MAT provisions, you are supposed to pay 1,20,000 tax. Under accounting provisions, you are supposed to pay 80,000 tax. No, 70,000 tax. Shall I start now? Everybody take care. First of all, find tax expense, amma. Tax expense is equal to, how to tell tax expense? CT plus DTL or CT minus DTA. Ivi creations. Is it clear? CT plus new DTL. CT minus new DTA. Hey, up to this clear? Be careful. Let me find everything. What is the total tax expense as per these three things? 1.2 70. తెలియట్లేదా? Tax expense meaning ఏంటమ్మా? Tax as per accounting records. What is tax as per accounting records? Tax expense is 70,000 as of now. Hey, respond everybody clear. That is equal to, already you know CT. What is CT amma? 1 lakh. Hey, is my point clear? So be careful. TE is equal to current tax. 1 lakh is readily available. Now be careful. You need to check out whether is it DTL or DTA. Let me tell it very simply. Sir, accounting tax is less. Hey, tax kadra. Accounting tax is less. Ante accounting income is less. Ante accounting expense is more. So you need to create DTA. So DTA and CT minus DTA slot lo unnam 1 lakh minus. Let us check out how much is DTA. Difference between 1 lakh and 70 kadamma, which comes to 30,000. Up to this clear? Hey, respond everybody. Up to this clear? Ante initially don't touch MAT provision at all and start your gameplay to find what is original TE. After this, tax expense under MAT is equal to CT plus DTL or CT minus DTA plus excess of tax paid as per MAT provisions over normal provisions. Excess of tax paid as per MAT provisions over the normal provisions. Normal provisions tax is, MAT provisions tax is 1.2 lakh. Excess how much is there? Plus 20,000. Hey, respond everybody clear? There ends the matter. That is with respect to TE, tax expense. So conclusion ఏమంటే tax expense is equal to CT plus DTA or CT minus CT plus DTL or CT minus DTA plus excess of tax paid. Respond everybody pakka. So you can apply if needed. Yeah, here you can check out accounting profit 6 lakhs and tax rate 20%. 6 lakh into 20%. Chepali. Accounting tax is equal to 1,20,000. Book profit as per MAT rate 3,50,000 into 7.5%. MAT 26,250. Let me check out under normal provisions. That is 60,000 profit as per income tax into tax rate 20%. 12,000. Shall I continue? Everybody, first of all, let me find TE. TE is equal to CT plus DTL or minus DTA. First of all, CT, DT anta. Afterwards, I'll check out everything. That is equal to, what is CT amma? CT 12,000. Next, sir, tax as per accounting provisions is more. Ante income is more. Ante expense is less. Ante you need to create DTL. So CT plus DTL. So 12,000 plus DTL is the difference between accounts tax and normal tax. That is 1,20,000 minus what? 12,000. Entama? 1,08,000. Respond everybody clear? Now plus excess of tax paid. Normally how much you are supposed to pay? But how much you are paying as per MAT provisions? 26,250. How much excess paid? This is the total tax expense as per MAT provisions. My dear children, this is the end of accounting standard number 22 and I guess you have exhaustively understood it clearly. Completed. So let us continue with accounting standard number 26. Aspects that were covered in AS10 I'm not going to cover here at all. I'm going to cover some other provisions relating to AS26. First of all, what is an intangible asset? My dear children, intangible asset is an identifiable non-monetary asset without physical substance, and of course which should have control generation of future economic benefits and which should be measured reliably. All these are the definition of asset. An intangible asset is also should be used either for the purpose of production of goods, rendering of services, administration purpose, and rentals. First of all, I'm not concentrating on something called identifiable because you already know about self-generated goodwill. And once again, we are going to discuss here. So identifiable, I'm not specifically concentrating, but I'm telling you one concept wherein identifiable could be easily understandable. My dear children, accounting standard number 26 is applicable for two elements. Number one, intangible asset. Number two, expenditure. Yes, even for expenditure also, accounting standard number 26 is applicable. And now coming to intangible assets, two types. Number one, self-generated intangible assets. Number two, other than self-generated intangible assets. Is it clear, everybody? Other than self-generated intangible assets. Or to make it more clear, number one is self-generated intangible assets, and number two, other than self-generated ante something like acquired intangible assets. Ade initial recognition and measurement depending on modes of acquisition annam kada, that is nothing but acquired intangible asset. You can acquire either by cash or credit, or exchange of assets, or even for issue of securities. Or also you can acquire any intangible asset from government grant. Then automatically you need to follow either DGG method or asset reduction method. And very, very important, if at all any intangible asset arising is guided by amalgamation, then accounting standard number 14 is applicable. Consolidation, accounting standard number 21, 27 and 23 are applicable. Only when intangible assets are not dealt by any other standard, then AS 26 is going to deal. And now, I'm not going to deal with acquired intangible assets because the rules are absolutely same, which is par similar to AS 10. Cash or credit aithe purchase price plus direct expenses. Exchange of asset aithe you need to check out for commercial substance, and you need to record it at fair value of asset given up. If it is not there, fair value of asset acquired. Even if it is not there, net book value of asset given up. And if it is issue of securities, fair value of securities issued. If it is not there, face value of securities issued. And not concentrating more, but I have told you the outline. Now coming to self-generated intangible assets, these are two types. Number one, research and development. Number two, other than research and development. What are self-generated intangible assets other than research and development? Something like self-generated goodwill, brand, customer list, import quotas. Customer list, my customers are my intangible assets kada, but that list is an intangible asset which should not be recognized. Masthead, all these things, etc. I hope you know everything. At least brand you know, right? Self-generated goodwill you know, right? Customer list also understood, right? Import quota. Import quota is nothing but you may need to import raw material from so and so country. From which country if you are importing, less taxes will be there. From which country if you are importing, less amount I will be paying. You know, let me tell you one secret. If you are exchanging rupees directly to dollar, or if you are exchanging, let me tell you, if you are exchanging rupees directly to something like, let me tell you an example. A currency notic ravatledhe. No, I want a smaller currency actually. Say Japanese yen. If you are exchanging rupees to Japanese yen, say for example, for 1 rupee, you might get 123 Japanese yen. But whenever you are converting rupees to dollars, and when dollar is converting into yen, you might get more than 123 yen. Say for example, 1 rupee is converted into $0.03. And if $0.03 is converted into yen, you might get 125 yen. Hey, is my point clear? All this is nothing but research which is done by that company for import quotas. From which company if you are importing, we have to pay less taxes. From which company if you are importing, it is cheaper. From which country raw material is qualitatively available. All this research done by that company, and all that research file, whatever is there, that we will generally call it as import quota. That secret I don't tell to anyone. And I'm not going to recognize the same in my books of accounts also. And coming to the next one, masthead, publishing title. Publishing title is nothing but, what is it called? AVM Productions. Publishing titles. Like before a movie is getting released, some sort of My 3 movies, all those are publishing titles. Yes, they have earned that. Yes, they have earned that. Do they recognize the same in their books of accounts? No. And the next one, masthead. Masthead is nothing but on prescription, doctor prescription, at top you will be having one head, right? Doctor name, hospital, phone number, registration number, all together is called as masthead. But that symbol, whatever is there, that might be called as trademark. Even our institute is having one trademark. But on the fees receipt, at top you will be having everything. Like the institute name, registration number, locations, courses offered, ranks, everything. The top part, whatever is there, that is called as masthead. I hope now you have well understood with all these things. Fine. Sir, all these things, conclusion intente, should not be recognized in the books of accounts. Because there is no flow of consideration and there is no control on this. Control of future economic benefits are not there on this one. Future economic benefits in this context is actually controlled by the market. And also, even though you are having control on your self-generated intangible assets, there is no flow of consideration. Measurement is not there and hence you cannot recognize. Is my point clear? What is not there, Amma? Cheppali, what is not there? Flow of consideration is not there, measurement is not there, and hence you cannot recognize self-generated intangible assets other than research and development. Now coming to research and development, make it into 2 parts. Number 1, if at all they are separable and if at all they are inseparable. If at all they are inseparable, treat entire phase as research phase and simply it will be charged to P&L account. If at all it is separable, research phase, development phase. Research phase should be charged to P&L account. Development phase, if it is satisfying intangible asset definition, 6 more conditions, then it will be capitalized. Otherwise, it also will be charged. Is it clear? Development phase, if it had satisfied the definition of intangible asset, 6 more conditions. What are the 6 more conditions relating to this intangible asset, sir? Very simple, Amma. 6 more conditions relating to intangible asset. Point number 1, it should be technically feasible to complete the asset. There should be technical feasibility to complete the intangible asset, and there should be economic resources, technical resources, and all the support resources, financial resources should be there. You should have all the resources, economic resources, economically, technically, you should have some resources, financial resources should be there to complete. Next one, sir, technical possibility is there and also we are having financial resources to complete, and also you should have intention to complete that. Yes, technically it is possible to complete. Technically it is possible to produce COVID vaccine. Yes, some pharmaceutical companies are having enough financial resources. But if they are not having intention to complete, they should not recognize. So technical feasibility should be there and financial resources should be there. Intention to complete should be there. The next 3 conditions, it should generate some future economic benefits, either through sale or through use. And ultimately, it must be measured reliably. 3 more conditions, they should generate some future economic benefits. Next condition, either through sale or through use. And finally, it should be measured reliably. If all these 6 conditions and asset definition, intangible asset definition is satisfied, then development phase will be capitalized. Otherwise, even development phases also shall be charged. Is it clear, everybody? In your problematic part, you may not have all these conditions. You will be having government given permission, which implies that all the 6 conditions are satisfied. Ani ardham. While doing the problematic, you might not have all these 6 conditions in the question. In the question, you will be given with a terminology like government had given permission to complete the project, or project will get completion possibility after these many months, and you need to assume from that point that All the 6 conditions are satisfied, and from that point you have to capitalize. Up to that point it has to be charged. Remember one thing, my dear children, once charged cannot be reversed. Where did you learn this provision? AS 9, no. And AS9 you have learnt once charged can't be reversed, but AS9 is relating to revenue, not relating to expense, so I can't tell that. AS7 concept gurtunda? What's that? Construction contracts and tells. So fine. Cost for securing a contract. Initially you thought of like you cannot secure the contract and charge it to P&L account. Subsequently you thought of like you will be getting the contract, but you cannot reverse. Gurtochinda? Once charged cannot be reversed. Anyways, come to AS26. Sir, only when the conditions are satisfied you have to capitalize, otherwise you should not capitalize. And the main important provision is all about once charged can never be reversed. Respond everybody, clear? When my dear children, that is all about identifiable. Ante, these self-generated intangible assets are unidentifiable. Acquired intangible assets are identifiable. And development phase separately can be identifiable, and hence these things can be capitalized and all the remaining have to be charged. But self-generated intangible asset other than research and development, you are not spending anything. So no charge, no capitalize. Sir, is that point clear? Whatever these self-generated intangible assets are there, frankly speaking, you're not spending anything. So no charge, no capitalize. If you're spending anything, say for example, then simply charge it. If you're spending, charge. If no spending is there, no need to charge, no need to capitalize. And coming to the next one, non-monetary asset, already we have completed in accounting standard number 11. Now coming to the next one, without physical substance. Please concentrate carefully. Intangible asset always needs a support of physical substance. It always needs a support of physical substance. Frankly speaking, painting may be intangible asset, but it needs a support of cardboard. Software may be an intangible asset, but it needs a support of CD. This OneNote, whatever is there, it is also an software, but it needs a support of laptop. I hope comfortably it's clear. So now take care, check out whether is it separable or inseparable. Painting is the best example. It can't be separable. Since it cannot be separable, you need to check out for the predominant element. If predominant element is tangible item, then follow AS10. If predominant element is intangible item, follow AS26. If separable item, absolutely no problem. For tangible item, follow AS10. For intangible item, follow AS26. This is with respect to without physical substance. Now, moving on to the next thing, very, very important. Also, I told accounting standard number 26 is applicable for expenditure. What kind of expenditure is that? My dear children, there are two types of expenditure. Expenditure relating to securities like underwriting commission, discount on issue of debentures, loss on issue of debentures, cost on issue of bonds, etc. And those expenditures which are not relating to securities. First of all, which expenditure you need to consider, sir? All the expenditure which are in deferred revenue nature. Deferred revenue nature you need to consider. Salary will not be dealt by AS26. Take care. All the expenditure which are in the nature of deferred revenue. All the expenditure which are in the nature of deferred revenue and not relating to securities is considered by AS26. Expenditure in the nature of deferred revenue and if they are relating to securities, then obviously AS26 is not applicable. Now, whereas coming to expenditure in the nature of deferred revenue expenditure and for which not relating to securities, example, preliminary expenses, pre-incorporation expenses, inauguration expenses, pre-operating expenses. heavy advertisement expenses, training expenditure, research expenditure, etc. All these expenses have to be written off in the very first year of incurring itself. As per AS 26, yes, AS 26 is applicable, and AS 26 is telling you should not amortize. You have to write off in the very first year of incurring itself. Respond everybody clear? This is what clearly said as per accounting standard number 26. AS 26 is mostly problematic part is relating to research and development okati. Impairment of loss, 1 or 2 questions you are having, and the next is all about depreciation only. Now coming to the next one, depreciation. Of course, depreciation on intangible asset is called as amortization. My dear children, if no specific information is there, if at all there is no specific information, then automatically there is a rebuttable presumption as per accounting standard number 26 that you have to amortize for a period of 10 years. There's a rebuttable presumption that you need to amortize intangible asset for a period of 10 years. And very, very important, my dear children, if no method is mentioned, it is recommended to follow SLM method. If there is any other systematic and rational basis, you can comfortably follow that systematic and rational basis. Example, you can follow production units method, you can follow WDV method. Very, very important, you can follow RGC method also. Revenue generating capacity method. But revenue generating capacity method cannot be followed for tangible items as per AS 10, but as per intangible assets, revenue generating capacity could be comfortably followed. What is revenue generating capacity, sir? Every year, how much are the cash inflows that will be there? Every year, how much will be the sales are there? Basing on that amount, you can amortize. Basing on that amount, you can't depreciate machinery, remember. Is it clear, everybody? So, my dear children, please be careful, amma. Amortization, if nothing is mentioned, how many years you need to amortize, amma? Which method you have to choose, amma? SLM. But you can also choose any other systematic and rational base if data is available. Sir, data is available with respect to units and with respect to revenue generating capacity also. Which method is better option, sir? Question ardhamainda? In one question, units also will be given, sales also will be given. Then what is the best method to choose? No, revenue generating capacity. On the proportion of sales, you need to amortize. Even you are having a question also. A company is producing bottles, production units in bottles, sales given. Then you need to amortize in proportion to sales. That concept question itself. That one. You are having production units given in bottles and also sales will be given. And if at all those two things are there, then it is highly recommended to follow sales. That is RGC method, revenue generating capacity method. Respond everybody clear. One more important thing, as per accounting standard number 14, whatever goodwill that you are having, it has to be amortized only for 5 years. As per AS 26, goodwill has to be amortized for 10 years. As per AS 14, goodwill has to be amortized for 5 years. One more important thing. Sir, can goodwill be set off with capital reserve or not? Can goodwill be set off with capital reserve or not? Yes, provided if these two things are guided as per accounting standard number 14. In AS 14, for one company you will get goodwill, for another company you will get capital reserve. Those two things will get set off. That is permitted only up to the accounting standard number 14. Now, goodwill is purchased as per AS 26 and you are having capital reserve as per AS 14. These two things can't be set off. Sir, ardhamainda? That goodwill as per AS 14 is capital loss. That capital reserve as per AS 14 is capital profit. And hence these two can get set off. But goodwill as per AS 26 is not capital loss, it's an intangible asset. So you can't set off capital reserve with intangible asset as per accounting standard number 26. Respond everybody clear. One more important thing, chala jagrata. If at all you are having license, I told you rebuttable presumption 10 years. Am I correct or wrong? But if you are having any other period, then you can consider that period also, provided that period should be basing on the economic factors and legal factors. Economic factors and legal factors. Legal factors is nothing but, say for example, you are having a license. License you are having for 10 years, sorry, 12 years. Economic factors, even though you are having license for 12 years, the market demands your product only for 8 years. Rebuttable presumption about 10 years. For now, how many years you need to amortize? Chepalamma, 8 years. Rebuttable presumption, consider if no data is there. Now, data is there. Economic factor 8 years, legal factor 12 years. So, you need to consider only for 8 years. My dear children, your product will be having demand up to the next 20 years. But you are having license only for 12 years. So, you need to amortize for how many years? 12 years, whichever is lower. And very, very important, Amma, license may include renewal period also. License may include renewal period also. And like this it will be. License is originally given only for 5 years. Plus another 3 years it can be renewed. Another 3 years it can be renewed. Now, can renew, say for example, for this license you are paying 1 lakh. So now 1 lakh has to be amortized for 5 years or 3 years. The question arthamainda? License is having original period of 5 years and it can be renewed for the next 3 years also. To acquire license you are paying 1 lakh. So now 1 lakh has to be amortized for 5 years or 3 years. Chepalamma, sir, prima facie 5 years. But you may need to consider even 3 years when the following 2 conditions are satisfied. Number 1, renewal is again the same term, virtually certain. Renewal is virtually certain, and renewal you are having an intention to renew for a nominal fees. Renewal is virtually certain and 100% it should be possible, and it should include some nominal fees payment only. In such a case, this entire 1 lakh has to be amortized for 8 years, but not for 5 years. Respond everybody clear. Now, very, very important, Amma. Sir, if it is tangible asset, you might consider any kind of revision, Amma. Ante life may be revised, residual value may be revised, or even rate may be revised, anything may be revised. Even revaluation concept is also there. Anything may be revised. And for that revision, you need to give a prospective effect as per accounting standard number 5. Because revision of these things is called as change in accounting estimate. AS5 linked to AS10 and you are supposed to give prospective effect. But remember, there is no concept of revaluation as per AS26. Yes, life can be revised. Very, very important, residual value. When can residual value be revised, sir? Yes, residual value can also be revised. But increase the residual value, you should not consider. Decrease the residual value, you have to consider. Ante, initially you thought residual value is 10,000 for your intangible asset. But later on you are telling residual value is 12,000. Don't consider. Initially you told 10,000. Later on you are expecting 5,000. Consider. Sir, is it clear? Rule emante, point number 1. Residual value of intangible asset is generally 0. Consider residual value only when either of the 2 conditions are satisfied. Condition number 1. When there is market for our intangible asset at the end of our useful life. At the end of our useful life, if my intangible asset is having market in the market, then you can consider residual value. Is it clear? And next one, condition number 2. When there is a contract to purchase your intangible asset at the end of life. How you can't think, sir, at the end of life period, how intangible asset is having market? At the end of life, why one person is entering into contract? At the end of life ante, not life of intangible asset. Life that is needed for us. The life of intangible asset may be 20, but we will use it only for 8 years. After 8 years, we would like to sell it to the outsiders. Sir, is my point clear? So take care, residual value is generally 0. But if market is there at the end of life of intangible asset, or whenever you are having contract that an outsider is going to purchase it after some number of years, then you can tell that residual value can be some amount. It can be decreased in future, but it can't be increased in future. Respond everybody clear. And my dear children, that is the end of accounting standard number 26. Remember, question no, he'll be giving in a very confused way, something like, initially development conditions were not met and hence charged. But further, since development conditions were met, company would like to reverse the expense also entered. But remember, once charged cannot be reversed. Gurtupettukondi. Now he'll give you a question. A heavy advertisement expenditure spent to the extent of 5 crores. And we are estimating that revenue will generate from this 5 crores for the next 5 years. And company is telling that since we are having future economic benefits, heavy advertisement expenditure is capitalized. Now answer, is it correct or wrong? Wrong. Gurtupettukondi, all the discussion is trash. If it is heavy advertisement expenditure, as per AS 26, it has to be written off in the very first year of incurring itself. Respond everybody clear. Now, in one of the questions, you will be having additional import duty. A company is purchasing software from UK for pound so and so amount. Custom duty you are supposed to pay, additional custom duty you are supposed to pay, entry tax you are supposed to pay, but entry tax is fully recoverable. Since it is fully recoverable, you need to deduct only if it is included. If it is not included, no need to consider kada. Sir, ardhamainda? Refundable taxes and duties. You need to deduct refundable taxes and duties only when it is included. If it is not included, no need to consider at all. Is it clear? And the next one, coming to import duty and additional import duty. Gurtupettukondi, additional import duty is also to be computed on import duty also. And the purchase price plus all other direct expenses plus customs duty plus additional import duty. Is my point clear, everybody? And my dear children, frankly to tell you, this is the end of accounting standard number 26. So fine. Let us continue with the next accounting standard, that is accounting standard number 18. And AS 18 is nothing but related party disclosures, related party transactions, related party disclosures. Likewise, so as per this standard, there is one very important point. The relative may not be a relative at the end of the year, remember. The relative may not be the relative at the end of the year. If at all, such person is considered as relative at any point of time during the year, then he shall be identified as relative at the end of the year. That's very, very important. Be careful. Until by the end of the year, he may not be relative or they may not be relatives. But if at all at any point of time during the year, if they are considered as relatives, then automatically at the end of the year, the person should be identified as if he is relative during that period itself. Like that, it must be very clearly mentioned out. Like that, it should be clearly mentioned out. And moving on to the next thing. As per AS 18, the following, for the following 5 things, accounting standard number 18 is applicable. For the following 5 relations, accounting standard number 18 is applicable. And relation number 1 is something to tell you like entities which are directly or indirectly having control or controlled by or in common control with the reporting entity are considered as relatives. It is very complicated to discuss these lines, but conclusion emante, point number 1, control, you must know. What do you mean by control? Sir, control as per law includes only 2 elements. What is the definition of control as per law? Point number 1, more than 50% of the voting power okati. Controlling the composition of board of directors okati. But as per accounting standard number 18, control is more than 50% of the voting power or controlling the composition of board of directors, and one more thing, substantial interest. Substantial interest ante greater than or equal to 20% of the voting power. Along with that, there should be power to direct. Companies F&O policies, financial and operating policies, and then we can tell that there is control. And you might have a doubt, like even in significant influence also it is more than or equal to 20%, but even in substantial interest also it is more than or equal to 20%. But take care, along with more than or equal to 20%, if they are having power to direct, if they are having power to direct companies financial and operating policies, then we are going to call even that is also as control. As I told you, to discuss this relation in these lines may be complicated, but to break this, entities directly control reporting entities, entities directly controlled by reporting entities, entities directly in common control with reporting entity. Three relations. Entities indirectly control reporting entities, entities indirectly controlled by reporting entities, entities indirectly in common control with reporting entities. And automatically another three relations. On a whole, totally 6 relations were covered. Just with the aspect of control, 6 relations were covered. What do you mean by control, Amma? More than 50% of the voting power, or controlling the composition of board of directors, or substantial interest. What do you mean by substantial interest, Amma? More than or equal to 20% of the voting power plus power to direct companies F&O policies, financial and operating policies. Now, in that 6 relations, only 3 things were covered. For holding company, every subsidiary company is relative. For subsidiary company, every holding company is relative. And also, fellow subsidiaries or relatives. Fellow subsidiaries and subsidiaries which are controlled by the same holding company are also covered as relatives. So to tell you in a single word, holding company, subsidiary company and fellow subsidiary company, all these 3 parties are relatives to each other. Whether the relation might establish either directly or indirectly, remember. So let me tell you one important thing. Say for example, A is having 60% in B, and A is having 70% in C, and C is having 90% in D, and C is having 60% in K. Now, what is the relationship between A and B? A is holding company, B is subsidiary company. Relationship between A and C, holding subsidiary. C, D and K. C is called as holding company, D and K are called as subsidiary companies. So now, I mean D and K to C, subsidiary companies. Now, if you wish me to put everything in group, now relatives to A, is B a relative or not? Because subsidiary, controlling directly. Is C a relative or not? Yes. Why? Subsidiary, controlling directly. D and K, or D and K relatives to A or not? Yes. Why? Yes, indirectly. Even D is controlled by C, but C is controlled by A, and ultimately D is controlled by A. So A is controlling D and K indirectly through C. Is it clear, everybody? Now, starting with D, for D, who are all the relatives? C, yes, holding company, directly. A, yes, holding company, indirectly. B, is B relative or not? Okay. Now, to tell you some. Okay. Now, sir, D is controlled by whom? A. D is controlled by whom? And ultimately controlled by whom? And B is controlled by A. D is also ultimately controlled by A. Since they are in common controls, they are called as fellow subsidiaries. And even B and D are also relatives. Is it clear, everybody? What about D and K? D and K, yes, relatives because they are controlled by C. What about K and B? Cheppali. Yes, because ultimately K is controlled by A and B is also controlled by A. And hence B to D and K, among these 3 people, it is called as fellow subsidiaries. Respond, everybody, clear? What do you mean by fellow subsidiaries, Amma? What do you mean by fellow subsidiaries? Entities which are in common control. Fellow subsidiaries are nothing but entities which are in common control or called as fellow subsidiaries. Respond everybody, clear? Now relationship number 2, it is very simple, amma. Associate to investing party is relative. Investing party to associate is also relative. Next one, joint venture to the venturer is relative and venturer to the joint venture is also relative. Now please be careful. And coming to individual things, first of all, associate and investing party. What is the relationship between associate and investing party? Significant influence. What do you mean by significant influence, sir? Power to influence or power to participate in companies' F&O policies. What is significant influence, Amma? Power to influence or power to participate the F&O policies, financial and operating policies of the enterprise. Generally, you will be having power to influence or participate only when you are having more than or equal to 20%. Now you might ask me a doubt. Sir, even substantial interest is also more than or equal to 20%, kada? Yes, that is more than or equal to 20% and you are having power to direct. But here you are not having power to direct, you are just having power to participate or power to influence. This is the difference, so be very careful. And moving on to the next thing, be careful. A shareholder is telling he is not having greater than or equal to 20%. But he is telling that he is having power to influence or power to participate. Another shareholder is telling he is having greater than or equal to 20%, but he is telling he is not having power to influence or power to participate. Is my point clear? Sir, frankly speaking, power to participation will arise with a minimum of 20%. But here a shareholder is having more than 20%, but telling he is not having power to influence. And another shareholder is telling that he is not having more than 20%, but he is able to influence. Is it clear? These things and these situations should obviously happen only when a proof is provided. Only when a proof is provided, these two situations could be accepted. Otherwise, these situations could not be accepted. Say, for example, a shareholder who is having 16%, he is telling that he is having power to influence. We are asking how. He told that, sir, this is a shareholder who is having just 16% and he is the major shareholder. He is the major shareholder. After this person, the highest shareholder is holding 5%. After this shareholding, the highest share percentage is 5% only. And comfortably this person is able to influence that company. Kada? Is it clear? And hence shareholder who is having 16%, that is less than or equal to 20%, can also influence provided what is required? Proof is required. Now another person is telling he is having 30% holding, but he is telling he is unable to influence. Why? And whenever we have questioned, we have found that another shareholder who is having 60% is able to control that company. Whenever control is there, how influence will work out? Your friend might influence you to come to a movie, but your father can control you to open the books. Is my point clear, everybody? I mean to tell something like whenever control is there, influence will not work out. So even though this person is having 30% shareholding, he is telling that his influence is not able to be worked out because some other person is having control. This proof is required, only then we will believe the same. Respond everybody, clear? Now listen very, very carefully, everybody. A is having 20% in B and B is having 30% in C. Start everybody. Or A and B relatives or not? A is 20% in B and A is called as investing party. B is called as associate company. Party who is investing is called as investing party. Party who is being influenced is called as associate. Now start B and C. Who is B? Investing party. Who is C? Associate. Up to this clear? Now A and C relatives or not? Or A and C relatives or not? No, A and C are not relatives because no concept of indirect influencing. Is my point clear? Sir, just check out here. If A is having 60% in B and B is having 70% in C, or A and C relatives or not? Yes, because A can control C indirectly through B. Respond everybody, clear? But can A influence C indirectly through B? No. Sir, concentrate to my example. ఇప్పుడు A is having 60% in B, B is having 30% in C. Now, can A influence C or not? Indirectly through B. Is my point clear? What is the conclusion, sir? Indirect influence through influence is not possible. Indirect influence through control is possible. Indirect influence through చెప్పాలి indirect influence through influence is possible or not possible? Not possible. But indirect influence through control is absolutely possible. Respond everybody clear. Now be careful. A is having 20% in B and B is having 60% in C. Or A and C relatives or not? Or A and C relatives or not? Obviously no. A can influence A can influence B, B can control C, but A and C can't have any relation. But remember, if it is reverse, then relation is there. Respond, is it clear? Now, one more important thing, if at all A is having B and C limited, wherein he is having 30% and 25%, or B and C relatives or not relatives? Not relatives. There, if you have remembered, if it is controlled 60-70, ipudu, yes, because these two are called as fellow subsidiaries. But with 30 and 25, these two people are not relatives because they are called as co-associates. Co-associates are not relatives, whereas co-subsidiaries or fellow subsidiaries are considered to be relatives. Is my point clear? Pakka? Dash are not relatives? Co-associates. But co-subsidiaries or fellow subsidiaries were considered to be relatives. Now moving on to the next thing. Be careful, amma. Joint venture and venturer. Joint venture and venturer. Joint venture is relative to the venturer. Venturer is relative to the joint venture. Again same, co-venturers are not considered as relatives. If at all A is a joint venture which is started by B, C and K, where they are having 40%, 20% and 40%. Is my point clear? Now answer me, my dear children. B, C, K, are the relatives among themselves or not? No, they are not relatives. Respond everybody clear. Now B, C and K is having a relation called joint control. What is the relation they are having among? Joint control. Joint control is nothing but irrespective of percentage. Irrespective of percentage, they should have power to govern. Govern is nothing but framing and managing. Power to govern. What do you mean by governing? Framing the rules, managing or implementing the rules. Everything comes under governing. So power to govern F&O policies of the enterprise is called as joint control. Hey, is it clear? So take care, my dear children. Three relations: control okati, significant influence okati, joint control okati. Power to govern, power to participate or influence, power to direct. Is my point clear, everybody? Sir, now be careful, very, very important. If at all joint venture A is started by CPT with 80%, 15% and 5%. Now, what is the relationship between C and joint venture A? Is it holding subsidiary relation, venture or joint venture relation? C is having more than 50% in A. Holding subsidiary, venture or joint venture? Sorry, conclusion. As far as accounting standard number 18 is considered, C is the venturer, A is a joint venture, and the relation is something called joint control. But as per AS 27 is considered, whenever a venturer is having more than 50% in the joint venture, it is said to that he is having control and he needs to prepare consolidated financial statements by following AS 21. And one standard is telling in one style, another standard is telling in another style, so be careful. For the context of AS 18 is considered joint control. Everybody is having power to govern and hence they are called as venturer and joint venture. Respond everybody, pakka. Sir, now more very, very important thing. As per your law, associate includes joint venture, but associate cannot be a subsidiary company. Sir, gurtunda. Associate is such a company which is other than subsidiary company, but associate includes joint venture. But as per AS 18, it is very clear, Amma. Associate is neither a subsidiary company nor a joint venture company, because joint venture is having separate rules as per AS 18, associate is having separate rules as per AS 18. And also for the purpose of AS 23 is considered, associate is something which is neither a subsidiary nor a joint venture. Are you sure? Yes, 23 definition, not 18 definition. So take care. Definitions will change as per the respective accounting standards. Just you cross check the definition which is given for associate as per AS 23. But two things I'm clarifying you. Associate as per law includes joint venture, but it should be other than a subsidiary company. But associate as per AS 18 is neither a joint venture nor a subsidiary entity, because every enterprise is having separate rules and regulations as per AS 18. Respond everybody, pakka. Okay. Now, three relations were completed, and moving on to the next relation, be careful. Individual and all their relatives are obviously relatives to the reporting entity. Individuals and all their relatives are relatives to the reporting entity. Sir, gurtupettukondi, reporting entity is not relative to the individual. Reporting entity is not relative to the individual. Reason is so simple. Individual will not prepare books of accounts. For individual, accounting standard number 18 is not applicable, and hence for individual reporting entities not a relative. But take care, my dear children, for reporting entity, individual is a relative. Respond pakka. And now be careful, my dear children, who are relatives to the individuals, and all those people are also relatives to the reporting entity. Now, who includes in the relatives, sir? Individual, his spouse will be included or her spouse will be included. Individual mother, individual father, individual brother, individual sister, individual son, individual daughter. Okay, respond everybody, clear? And my dear children, all these people will be included in so-called relatives of a reporting entity. Respond everybody, clear? Sir, now giving you a question, be careful. This individual and relatives either having control or significant influence on a reporting entity, then the individual and spouse are relatives to the reporting entity. And without having control and influence, they can't do anything in the company, kada. So individual and their relatives either directly or indirectly having control or significant influence are considered to be relatives for the reporting entity. Hey, understood? Who are the relatives to the reporting entity? Individual and relatives having control or significant influence either directly or indirectly. That is considered as, those people are considered as related parties. Shall I proceed further? Hey, everybody concentrate. Everybody. Concentrate. Say for example, Mr. A is having 6%. Mrs. A is having something like 12%. Mr. A's brother-in-law, Mrs. A's brother. Mr. A's brother-in-law and Mrs. A's brother, who is actually holding 8%. Or say for example, holding 7%. Is my point clear, everybody? Now the question is all about, is Mr. A relative to the reporting entity or not? They are holding 6, 12 and 17% in an entity called P Limited. And is Mr. A relative to P Limited or not? Sir, Chappali, yes or no? If at all the same question is asked in the examination, you will be writing no and the answer is wrong. The answer is wrong. Mere alochistunnaro chepta. So simple, you are thinking A is having how much percent? Who are his relatives ante? Mrs. A. She is having how much percent? 12%. Brother-in-law is not a relative to Mr. A, and hence it is not aggregated. So 6 plus 12 comes to 18%, which is less than or equal to, and hence not relative. That's correct. But there is another party here, Mrs. A. Question చూడండి ఎంత తెలివిగా ఫ్రేమ్ చేస్తాడో వాడు. He'll give the same question and he'll ask, is Mr. A relative or not? You will think from Mr. A's point of view and you will be writing, no, he is not relative. But check out the magic. Mrs. A is holding 12%. Her spouse is his relative. aggregate 6%. Her brother is also a relative, aggregate 7%. Ultimately, she is having 25%, which is greater than or equal to 20%, and hence Mrs. A is relative. Mrs. A is directly having 12% and indirectly having 6 and 7%. Altogether, who is influencing the company? Mrs. A is able to influence the company with their relative, with her relative's share. Since Mrs. A is relative to the company, all the relatives of Mrs. A are also relatives. Sir, is the logic clear? Now answer me, is Mr. A's mother relative or not? Mr. A's mother relative or not? No, Mr. A's mother is not relative. మీకు వచ్చే డౌట్ ఏంటంటే సార్ మిస్టర్ ఏ రిలేటివ్ కదా అంటే మిస్టర్ ఏ మదర్ కూడా రిలేటివ్ కదా, అలా అయితే మిస్టర్ ఏ మదర్ రిలేటివ్ కదా, మదర్ కూడా రిలేటివ్ కదా. Is my point clear? You can't put that chain holding like that. You have to consider from whose point of view you are looking, only their point of view. Here from whose point of view you are looking? Mrs. A's point of view. Since from Mrs. A's point of view, Mrs. A is relative, all Mrs. A's relatives are also relatives. Respond, is my point clear? You can't assume like, sir, since Mrs. A is relative, Mr. A is also relative. Since Mr. A is relative, Mr. A's mother is also relative. Since Mr. A's mother is relative, that grandmother is also relative. See? I hope you have understood the point here. Don't go for chain previous or chain forward, nothing such holdings. Simply from whose point of view you are checking, check from only those point of view. Respond everybody, pakka. Okay, now moving on to the next thing, KMP. All the key managerial personnel are also considered as relatives, and all the relatives of key managerial personnel are also considered as relatives. All the key managerial personnel and their relatives are considered as relatives. Who are key managerial personnel? Sir, there is a definition, take care. Key managerial personnel are those people who are having authority and responsibility over PDC, planning, directing and controlling. Sir, every person should have on all these 5 into 2, 10 powers. 2 into 3, 6 powers. Only then that person is considered as KMP. If he is having authority and responsibility over planning and directing, then he is not considered as relative. Then he is not considered as KMP. KMP is a person who should have authority and responsibility over planning, directing, controlling. Amongst all these things, they should have power. Only then that person is called as KMP, and only then that person shall be considered as relative. Respond everybody, pakka. Generally, all executive directors are considered as relatives, like whole-time directors, CEO, CFO, COO, etc. And all non-executive directors are not considered as relatives, provided if non-executive director had satisfied the definition of KMP, then again he shall be considered as relative. Respond everybody, clear? Last and final, be careful, last and final relation, fifth relation, entities in which individual or KMP or their relatives having either control or significant influence are also considered as relatives. Jagrata, entities in which individual, KMP and relatives who are having either control or significant influence, even those entities are also considered as relatives. Concentrate carefully, everybody. A Limited is having 60% in B Limited and 30% in C Limited. Are B and C relatives or not? Are B and C relatives or not? Answer, no, they are not relatives. Because B is a subsidiary, C is an associate. How a subsidiary and associate can be relatives? Is my point clear? 60-70 aithe? Yes, because they are called as fellow subsidiaries. 20-30 aithe? No, because co-associates are not relatives. Now see the magic, huh? Be careful, see the magic. Mr. A is having 60% in A Limited and 30% in K Limited. Now A and K are relatives as per point number 5. Is my point clear? Yes, as per point number 5, these two companies are also relatives. That's the magic. If at all this is A Limited, then these two are not relatives. But if at all individual or KMP or their relatives, then it is considered as relatives. Be careful. And if at all 20%, 30%, yes, they are relatives. Respond everybody clear. Take care. A father is KMP in one company. His son is having a sole proprietorship. Even this sole proprietorship and this company are also relatives. As per point number 5. Because father is KMP in one company and his relatives, son, is running a business and he is having sole control on that business. So sole proprietorship company are also considered as relatives as per point number 5. Respond everybody pakka. So be careful. Point number 5 is contrary to second point totally. Second point, co-associates are not relatives. But if at all they are co-associates which are being influenced by a single person, as per point number 5, they are considered as related parties. Respond everybody pakka. Fine, my dear children, all these are the related parties. And my dear children, there are some deemed not related parties. They are not to be considered as related parties. Who are those people, sir? Two companies having a common director doesn't mean that they are relative parties. Sir. Mr. A is director in A Limited, director in B Limited. Are A and B relatives or not relatives? Necessary not to be relatives. If Mr. A is KMP in both the companies, then yes, these two parties are relatives as per point number 5. But if at all he is KMP in one company and he is a normal director in another company, first of all, this person is not at all relative to B Limited. Then why to check relation between A and B? Is my point clear? So two companies having a common director doesn't mean that the two companies are related parties. Now, you are having a single customer. You are having a single franchisee, single agent, single distributor, single creditor, single lender, etc. Only single persons you are having. They are not to be considered as relatives. Somebody had given you loan, providers of finance. Municipalities providing water facility, or electricity department is providing some electricity to you, which are called as public utilities. Next one, government had given you some grants. Government sponsor bodies or government grants. Getting my point, everybody? Trade associations or merchant associations, all your businessmen had become a group and formed into an association. These people are also not to be considered as relatives. Reason is so simple, amma. Loan given to you by lender, or electricity department providing electricity to you, or government grant, or traders association, or single customer, single franchisee, single agent, these people are not having control or influence on F&O policies of the company, and hence they are not considered as relatives. Respond everybody clear? Okay, so deemed not related parties, two companies having a common director doesn't mean that they are relatives. Single persons are not to be considered as relatives. Providers of finance, public utilities, government sponsored bodies, and traders associations or merchant associations, trade union, and all those things are also not considered as related parties. Respond everybody clear? Now moving on to the next thing, amma. Even though the following are related parties, exempted from disclosures. Even though the following are related parties exempted from disclosures. Who are those? Number 1, if law is asking you, then don't disclose. If you are having contracts not to share confidential information which might cause damage to public interest or nation's interest. Entire country might be under danger if you shared that information. Or public will be under danger if you share that information, and hence you have entered into some contracts not to share that information. Is my point clear? Even such kind of things should not be disclosed. Understood? Tell me what's point number 1. If law is asking you, say for example, a bank is having a key managerial personnel, and that KMP is also having an account in that bank. He is a KMP for that bank. Bank is paying salary to KMP. Is it a related party transaction or not? Hey, bank is paying salary to his KMP, ra. Is it a related party transaction or not? Yes, disclose. Yes, it's a related party transaction and hence you disclose it, sir. Now, that KMP is also having an account in that bank. Who is depositing 1 crore with that bank? Yes, that KMP is having a bank account and KMP is depositing 1 crore into his personal bank account. Frankly speaking, that is also a related party transaction. But no need to disclose because it is personal point. 1 crore balance on I hope you have got my point. Something like Banking Regulation Act had asked not to disclose such kind of information. Say for example, if there is a person who is came to an insurance company and who is having 20 crores policy in that company, such kind of things should never be disclosed. Respond everybody, pakka. So take care, if law is asking you not to disclose, you should not disclose. If you have entered into contracts in order not to disclose some confidential information which might cause damage to nation's interest or public interest, even such kind of things should not be disclosed. And the next disclosure in CFS. Hey, did you remember that you are going to eliminate intercompany transactions? Or intra-group transactions have to be eliminated. Ante, while preparing consolidated financial statements, no need to disclose intra-company transactions because you are preparing CFS by considering all the holding and subsidiary companies as if it is a single entity. And hence in CFS, intra-group transactions no need to disclose. But in SFS, you need to disclose. In CFS only exemption is given, but in SFS, no exemption is given. Clear, everybody? And point transactions between state controlled enterprises. State controlled enterprises are nothing but government companies who are having more than 51% of share. State controlled enterprises are nothing but government companies who are having more than 51% of share. And if at all any transactions happen between state controlled enterprise, like say for example IOCL is a public sector undertaking and ONGC is also a public sector undertaking. Obviously, these two things are controlled by government since they are having more than 51%. So frankly speaking, these two things comes under related parties, but no need to disclose since state controlled enterprises are specifically excluded from disclosures. Respond everybody, clear? My dear children, the last and final part. What are the disclosure requirements as per AS 18? Very, very important. You need to divide the relations into two parts. Control okati, significant influence okati, joint control okati, KMP okati. Control is at one side, significant influence, joint control and KMP is at another side. You need to disclose if no transaction is there only for control. Sir, even if there is no transaction, you need to disclose for control. What is that, sir? Name of the related party and nature of the relationship. Who is a related party and what is its nature? You are supposed to disclose these two things if there is no transaction. If transaction is there, you are supposed to disclose many things. What is the name of the related party, nature of relationship, nature of the transaction, volume of the transaction, as on the balance sheet date, as at the end of the year. And also you are supposed to disclose provisions created and provisions written off also. Disclose all these things whenever there is a transaction. Name of the related party, nature of the relationship, nature of the transaction, volume of the transaction, and how much, measurement. As on the balance sheet date, how much is left over outstanding. As on the date of transaction, how much is the total value. Volume of the transaction as on the date of transaction, as at the end of the year also. And provisions created, provisions written off. Disclose all these things when transaction is there. So check cheskondi. If transaction is there, అది control aina, significant influence aina, joint control aina, KMP aina. You need to disclose all these things. If no transaction is there, no need to disclose for all other relations other than control. Even if transaction is not there, you are supposed to disclose only for control what is the name of the related party and what is the nature of relationship. Respond everybody, pakka. And my dear children, this is the end of is 18. I have left one small part, grouping and clubbing relating to disclosures, but apart from that, entire is 18 I have covered. And let us continue with the next chapter, that is internal reconstruction, which is almost certain. As I already said you, from company final accounts or internal reconstruction, he is going to ask a question. If from company final accounts he asks 14 marks question, from internal reconstruction you might get a 4 marks question. If from internal reconstruction he asks 14 marks question, from company final accounts you will be getting 4 marks question. But in one attempt, 14 marks and 4 marks, these two things were asked only from company final accounts itself. In most of the cases, this will be the style, either 14 plus 4 or 4 plus 14. So now, coming to the chapter of internal reconstruction, most easiest chapter in accounts, that is internal reconstruction only. And hence I'm not going to concentrate each and everything clearly, but I'll tell you the overall concept. So number one, coming to share capital. Sir, if at all any consolidation of shares or share split is there, the entries are so simple. Equity share capital old account debtor to equity share capital new account. Even the same is applicable for consolidation, share split, equity shares, preference shares also. And only one important thing that you need to take care is all about equity share capital account debtor, say 100 rupees, to some portion was cancelled, and for the remaining portion, if new equity shares are issued, then automatically that portion, whatever is there, has to be transferred to capital reduction account. Cancelled portion has to be transferred to capital reduction account. Be careful. Now, coming to share capital, that's it. And coming to reserves and surplus, be careful. Point number one, there will be only P&L loss given in the question. Generally, there will be only P&L loss given in the question. But in one of the problem, you might have securities premium. So now our question of fact is all about, can the securities premium be utilized for the purpose of scheme or not? Gurtupetkondi, scheme of reconstruction has to be approved by the High Court or NCLT as the case may be. Whatever the scheme of reconstruction that is formulated by the company has to be approved either by the High Court or NCLT. In that scheme of reconstruction, if they have included this point that securities premium can be utilized for the scheme, and if that scheme is approved by the High Court, then you can utilize securities premium for the purpose of scheme. Ante intaki, what I am trying to tell you is that if at all it is given in the adjustments, you can use. If it is not given in the adjustments, you cannot use. And మీరు ఇలా నేర్చుకోవచ్చు. Sir, if in adjustment securities premium is utilized for the scheme అని ఉంది, since as per section 52 of Companies Act 2013, security premium should not be utilized for the scheme kada sir, and hence point wrong kada, and hence I did not utilize that. Appada tappu. I hope the point is clear, because scheme of reconstruction is approved by the High Court or NCLT, and hence it will obviously be utilized at that moment, provided if it is approved scheme, provided if the point is given in the approved scheme. So conclusion, while doing the problematic, if in that problem securities premium can be utilized for the scheme ani unte, then you can comfortably utilize, otherwise don't touch that. Is my point clear? And the next one, free reserves, like not there but if at all available, general reserve gani, P&L account is obviously it is having loss kada, reserve fund gani, if at all any reserves are available, generally you will not have, but if at all you are having, including capital reserve also unte, then be careful my dear children, utilize these things only when to write off P&L account if you are not having sufficient balance. Even though it is given in the scheme or not, you just don't care. Say for example, after preparing capital reduction account, you were left with 10 lakhs. But P&L loss, you are having 12 lakhs. 2 lakh shortage is there. What to do, sir? Check out in the question if you are having any general reserve, reserve fund, capital reserve, then you can utilize such kind of elements. And then you can write off. If at all these are not there, then obviously out of P&L account write off 10 lakhs and remaining 2 lakhs will continue in P&L account as loss. Is my point clear? So you can utilize specific reserve like DRR, CRR, securities premium, all the specific reserves can be utilized only when there was an adjustment given in the question. But if at all no adjustment is given also, you can utilize all the free reserves and capital reserve provided when balance of capital reduction account is not sufficient. If balance of capital reduction account is sufficient to write off P&L account, no need to do anything. But if the balance of P&L account is not sufficient to write off P&L loss, then if existing free reserves and capital reserve is there, you can comfortably utilize those in order to write off P&L loss. Is the point clear, everybody? Is the point clear? So conclusion, don't utilize specific reserves. Utilize specific reserves only when a point is given in the question. But you can utilize free reserves provided when balance of capital reduction account is not sufficient to write off P&L loss. Is the point understood? Now coming to the next one, outside liability settlement. Liability account debtor. If you are paying cash, give cash. Check aite bank. If you are giving asset, aite asset. Finally, whatever unportioned unsettled portion is there, it's profit to you and you will be transferring it to capital reduction account. But in this course of action, you are having some special points like party-wise settlements. Me gurtunte. Like Mr. A is the liability holder for first debentures, second debentures, creditors also. In such a case, how to write the entries ante? First of all, write the due entry and then you do the remaining settlements. Cancel 2 lakhs holdings relating to Mr. A. Don't write simply like first debentures account debtor to capital reduction. First of all, you pass a due entry. First debentures account debtor, second debentures account debtor, creditors account debtor to Mr. A account. Then start settling to Mr. A account debtor to capital reduction account. Like that, first write a due entry and then settle. Respond everybody, clear? So that is party-wise settlement. And in this course of action, be careful, contingent liability and contingent asset. You are supposed to pay a contingent liability of 75,000 and 60,000 can be recovered from the insurance company. In one of the MTP problems, the institute will be writing the entries like this. Contingent liability account debtor to cash or bank account 75,000. In one of the institute materials, it will be writing like that. Contingent liability account debtor to reverse cheppesanu. Contingent liability is a liability, right? So first of all, institute MTP answers it given something like capital reduction account debtor to contingent liability account 75,000. And then it had given the next entry something like contingent liability account debtor 75,000. Hey, clear everybody? You are getting a cash of 60,000 and to capital reduction account, whatever the balance it is telling. Reverse cheppestunanamma, I'm sorry. You're paying kada. Sir, is this entry clear? Is this entry clear? Capital reduction account debtor to contingent liability account. Next, it is giving you an entry like writing off of contingent liability to the extent of 75,000. Is it clear? But to write off this 75,000, you are getting a recovery of 60,000. Am I correct or wrong? Out of 60,000, if 75,000, out of 75,000, if 60 is recovered, you are supposed to pay 15,000. Am I correct or wrong? And whatever the balance 60,000 is there, it is crediting again to capital reduction. Hey, respond everybody, clear? But frankly speaking, all this is nonsense. In MTP, he had given 3 to 4 journal entries or 2 to 3 journal entries, which are very complicated. But I'll tell you in a very simple way, if it is contingent liability being settled, then the entry is capital reduction account debtor to cash or bank account. Chalu. If it is contingent asset which is being realized, cash or bank account debtor to capital reduction account. Chalu. And if at all contingent liability which is waived off or cancelled, no entry. Contingent asset which is no more an asset, no entry. Hey, respond everybody, clear? In MTP, one of the problems, it was given something like CR account debtor to contingent liability account. But frankly speaking, that is not at all needed to write like that. In another MTP problem, he is giving like this: contingent liability account debtor to cash or bank account 75,000. Sir, ఏం చెప్పానో అర్థమైందా? In another MTP is giving like this: contingent liability account debtor 75,000 to cash or bank account 75,000 అన్నాడు. Is my point clear? And then this contingent liability is closed. You are getting recovery of rupees 60,000. Is it clear? Again difference 15,000 is transferred to capital reduction. Frankly speaking, all this is nonsense. అందుకే చెప్తున్నా. In different MTPs, sir, in 2012 syllabus MTP, he had given 2 set of entries which are different. In previous set of syllabus, in 22 set of syllabus, he had given entries in one style, and in study material he had given in another style. అసలు అవేమీ అవసరం లేకుండా సింప్లీ యూ కెన్ రైట్, ఇఫ్ కాంటింజెంట్ లయబిలిటీ సెటిల్డ్ సిఆర్ అకౌంట్ డెటార్ టు సెటిల్మెంట్ క్యాష్ ఆర్ బ్యాంక్. If contingent asset is realized, cash or bank account debtor to CR. If contingent liability is waived off, no entry. If contingent asset is no more an asset, no entry. Respond everybody clear? Hey, pakka? Fine, my dear children. This is about contingent asset and contingent liability. Gurtupettukondi, arrears of preference dividend is a contingent liability. So if any arrears of preference dividend is waived off, then no entry. For arrears of preference dividend, if at all settled, then you are supposed to write an entry like capital reduction account debtor if paid cash to cash, if issued equity shares to equity shares. Respond everybody clear? Pakka? Now, telling to one more important point, sometimes debenture holders shall be given a freehold property. Freehold property book value 200 is given at a price of 350. Freehold property book value 200 is given at a price of 350 to the debenture holders to whom we are supposed to pay 400. Is it clear? To debenture holders you are supposed to pay freehold property book value and you have given at price of 350. How we are supposed to write entries for this one? So simple, amma. First of all, revalue the freehold property. What is the journal entry for this revaluation, amma? Freehold property account debtor to capital reduction account to the extent of 150. So already freehold property is debited with a value of 200. Now revalue to the extent of 150. So 200 plus 150 which comes to 350. Now give the freehold property to the debenture holders. Debenture holders account debtor 400 to freehold property account debtor 350 and remaining 50 will be transferred to capital reduction. Respond everybody clear? Now in another problem it will be like this. To debenture holders you are supposed to pay only 300, but you are giving a freehold property book value 200 at a value of 350. In this case this entry is common. Now debenture holders you are supposed to pay 300 but you are giving 350, then 50 will be debited to capital reduction account. Respond pakka. In another problem it will be like this. Debenture holders took a freehold property valuing 200 at a price of 350 and to debenture holders we are due to the extent of 300 and the balance is adjusted after settling their dues. You will be having this terminology. Balance is adjusted after settling their dues. What is the meaning of this one, sir? Total debenture holders dues are only 300. But you are giving a freehold property of rupees 350. Still 50 rupees whatever is there, company is going to get cash. Sir, is the point understood? 350 value of freehold property is given to 300 liability. Pay how much? 300. Ante kadra. 350 market value of liability giving to a 300 value of liability, amma. Pay how much? 300. Balance how much is there? 50. Company will receive that 50 rupees cash. Respond everybody clear? So my dear children, be careful with the adjustment and you're supposed to write the journal entry. And coming to assets, it's quite common. Asset upward revaluation, asset downward revaluation. Something like asset account debtor to capital reduction account debtor to asset account. And if any asset is realized, cash or bank account debtor to asset account, profit or loss will be transferred to capital reduction account. If any liability is settled, liability account debtor to cash or bank account, profit or loss if any will be transferred to capital reduction account. Up to this respond everybody clear? Very important. After preparing capital reduction account, check out how much is the balance available. Never put balance in capital reduction account like that. In one of the MTP problems, P&L loss is 138,900. But capital reduction account balance is 128,900 only. ఇప్పుడు వాడు ఏం చేస్తాడంటే, since available amount to write off P&L loss is not there, he will not write off loss and entire amount will be transferred to capital reserve account. Is my point clear? But that's wrong. Since the balance available is 128,900, but to write off the loss you need 138,900, still 10,000 is shortage. You can't do anything. Write off to the extent of 128,900 and balance 10,000 will continue to be shown as loss in P&L account. Respond everybody clear? And after writing off of the loss, if any balance is there, that will be transferred to capital reserve account. Respond everybody pakka. And my dear children, very important, while preparing the balance sheet, at the end of your balance sheet, you are supposed to mention as reduced and reduced. For a minimum period of 5 years, you are supposed to disclose the same. Respond everybody pakka. So take care of my balance sheet as on so and so date. Very important, as reduced, unreduced, you are supposed to put. Why sir? What is the reason? So simple, users will be getting comparison. ఎలా అనిపిస్తుందంటే, till last year 10 lakhs loss is there. In the current year, entire 10 lakhs gone. How? Because of magic కాదు, internal reconstruction. And hence in the balance sheet, if you are supposed to mention something like as reduced or rent reduced, user will be understanding the same clearly. Hey, respond everybody pakka. Just wait for 3 to 4 more minutes. I'm going to leave you. Of course, AS 15 was still lagging behind, and even if at all time did not permit me, I'm not going to deal with AS 15 also. Because AS 15, as I already said, even if I tell, I'll tell you how to do the problems. Ante. Anyways, now I'm going to tell you one last and final important point, surrender of shares. Many students will be having confusion here. So, but remember one thing, my dear children, normally, listen very carefully, I'll tell you a technique for writing surrender of shares. Sir, normally, if at all, debenture holders, you are supposed to pay 1 lakh. And if at all you are issuing equity shares to the extent of 80,000, then what is the entry you are supposed to write? Debenture holders account debtor 1 lakh, to equity share capital account 80,000, to capital reduction account 20,000. Am I correct or wrong? Whereas under share surrendered mode, you are issuing these equity shares out of shares surrendered. You are issuing equity shares out of shares surrendered. So first pass an entry by assuming even this is also transferred to CR account. అంటే ఏమవుతుంది? Debenture holders account debtor 1 lakh, to CR account 80,000, to CR account 20,000. And the total CR will become 1 lakh. And then issue equity shares 80,000 out of shares surrendered. Respond everybody clear? Okay, now sir, first of all, what is the entry for shares surrendered? Who will surrender the shares? Equity shareholders. So equity share capital account debtor to shares surrendered account. Now company can issue equity shares out of the shares surrendered. So shares surrendered account debtor to equity share capital account at the time of issue. Company can also issue preference shares out of shares surrendered. అంటే అప్పుడు ఏం చేయాలి? ఫస్ట్ ఆఫ్ ఆల్ షేర్ సరెండర్డ్ హ్యాస్ టు బి కన్వర్టెడ్ టు ప్రిఫరెన్స్ షేర్ క్యాపిటల్. ఎట్ దట్ టైమ్ నో ఎంట్రీ, గుర్తుపెట్టుకోండి. ఇన్ యువర్ అడ్జస్ట్మెంట్స్ ఆల్సో వన్ పాయింట్ విల్ బి గివెన్. షేర్ surrendered were converted to preference shares. At the time of conversion, you will not write any entry. My dear children, you will be passing an entry whenever you are issuing to somebody kada. So at the time of conversion, no entry, remember. But once after conversion, you might issue to somebody else kada. At that time, you are supposed to write an entry. Share surrendered account debtor to preference share capital account. Respond everybody pakka. And at the end, if at all any balance of shares surrendered is there, share surrendered account debtor to capital reduction account. It will be closed and transferred to capital reduction account. Sir, all these things we know already. What is so special in this? Sorry. Listen very, very carefully. If at all a creditor of 1 lakh is settled by way of cash paid 20,000, next fixed asset given 25,000, next equity shares issued out of shares surrendered, which comes to 15,000, balance waived off. Now tell me the journal entry. Creditor account debtor to cash. How much? This is 20,000. To fixed asset 25,000. To, frankly speaking, normally writing you have to write equity share capital 15,000 and total creditor will become 1 lakh, and to capital reserve account how much? 40,000. This is what normal journal entry. Am I correct or wrong? But since you are issuing equity shares out of the shares surrendered, even this portion is also to be transferred to capital reduction. And hence this will not be there. To capital reduction will become 55,000. Then one more entry you will write. Share surrendered account debtor to equity share capital account, which comes to 15,000. I hope you might have understood what is the extended technique you have learned. So simple. Total settlement portion through equity shares is also to be transferred to capital reduction. Total settlement portion with respect to shares surrendered is also to be transferred to capital reduction. I hope the concept is comfortable for everybody. Why did I tell this one? Ante, in all our materials, such kind of blend is not there. Debenture holders to whom we are supposed to pay issue equity shares. అప్పుడు మనం ఏం రాస్తున్నాం? డిబెంచర్ హోల్డర్స్ అకౌంట్ డెటార్ టు ద ఎక్స్టెంట్ ఆఫ్ 75% టు సిఆర్ అకౌంట్ అంటాం. షేర్ సరెండర్డ్ అకౌంట్ డెటార్ టు ఈక్విటీ షేర్ క్యాపిటల్ అంటాం. Creditors of 72,000 reduced their claims to the extent of 50% and settle. Creditors account debtor to capital reduction account 72,000, share surrendered account debtor to equity share capital 36,000 antam. But what if a blend is given? You might confuse there, and hence I told you this one. If at all a blend is there, ante you are settling out of share surrendered, you are settling normally. Rule is only one simple rule. How much ever portion you are settling through share surrendered, even such portion is also to be transferred to capital reduction. Respond everybody, clear? And fine, my dear children, in this session we have actually completed AS 22, 26, 18 and internal reconstruction. I hope everything is very comfortable to you and you have learned some new things actually. And in this session we are going to cover AS 16 in total, AS 20 in total, but AS 15 limited tag. So I'll be covering only those things which are absolutely relating to the problematics, that too only limited, and the last and final question paper analysis. And let us start the first and foremost standard, which is accounting standard number 16. What is AS 16 number? Borrowing cost. The name itself is telling that this standard is applicable only to the borrowing cost, but it is not applicable to the owned cost. What do you mean by borrowing cost? Borrowing cost, my dear children, AS 16 had defined borrowing cost with an inclusive definition. It did not define the meaning definition. Please try to understand. Borrowing cost means in such a kind of thing AS 16 did not define. AS 16 defined borrowing cost as borrowing cost include the following costs. So definition itself is given as an inclusive definition. Definition itself is given as an exhaustive definition, but definition is not given like the meaning of that. Anyways, borrowing cost includes, as usual, everybody knows something called interest. And the next one, commitment charges. Hope you are aware of commitment charges. Say for example, a banker had sanctioned a loan of rupees 20 lakh for the purpose of construction of a building. In such a course of action, banker will not grant entire 20 lakhs into your hand immediately. Initially, he will be releasing only 6 lakhs. He will ask you to construct the first level slab. And then he will come, he will confirm, he will observe that you are using these funds for the purpose of construction of building, and he will release the remaining funds. As of now, how much is released, Amma? Please participate. How much is released, Amma? 6 lakhs. On this 6 lakhs, something will be charged which is called as interest. And how much banker will release in future, Amma? 14 lakhs. For this 14 lakhs, banker had given a commitment to you. What banker had given, Amma? That is nothing but a kind of promise. For the promise made by the banker, for the commitment given by the banker, he is collecting some charges called commitment charges. Conclusion. On released portion of loan, interest will be charged. On unreleased portion of loan, commitment charges will be charged. And the next one, all the direct expenses which are relating to the acquisition of borrowings but not relating to the settlement of borrowings. All the direct expenses which are relating to the acquisition of borrowings but not relating to the settlement of borrowings. Remember, settlement we don't consider. Say for example, we have taken 20 lakhs loan and we are promising that the banker that we will repay this over the period of 10 years. But fortunately, I am having enough money in the third year itself, and hence I have gone to the banker and telling that I will be paying entire 20 lakhs in the third year itself. Banker is expecting an interest on 20 lakhs over the period of 10 years, and the principal repayment will be done after 10 years. But you are breaking the agreement, kada? Yes or no? You are breaking the agreement and you are repaying just within an year of 3. And hence banker is asking some extra penalty to you, that is called as a prepayment penalty. What is that penalty, Amma? Prepayment penalty. He is asking some penalty to pay since you are paying earlier, which is nothing but prepayment penalty. Is this prepayment penalty relating to acquisition of borrowings or settlement of borrowings? And hence prepayment penalty will not be included in borrowing cost as per AS 16. Brokerage, commission, insurance, etc. at the time of granting loan you might incur, and it will be included in the borrowing cost. Is my point clear, everybody? And the next one, discount on issue of debentures, loss on issue of debentures. Loss on issue of debentures is also called as premium on redemption of debentures, if you have remembered. Hey, did you remember? What are the next two things, Amma? Loss on issue of debentures, discount on issue of debentures. Loss on issue of debentures is also called as premium on redemption of debentures. Did you remember AS 19? What are the two types of leases in AS 19? Finance lease and operating lease. In finance lease, again, each and every repayment has to be separated into principal plus finance charge. Am I correct or wrong? So finance charge as per finance lease as per AS 19 is also included in the borrowing cost. And the last and final one, some portion of forex difference as per accounting standard number 11 is also treated as borrowing cost as per AS 19. Respond, everybody, clear? Of course, you will be learning the last line in this marathon session too, and this is what the borrowing cost includes. Everybody please participate. Point number 1, what borrowing cost includes, Amma? Interest, commitment charges, direct expenses, discount on issue of debentures, loss on issue of debentures, which is otherwise called as premium on redemption of debentures, finance charge in finance lease, foreign exchange difference as per accounting standard number 11. Respond, everybody, clear? Quickly hold your calculators and tell me the answer. Find the borrowing cost in the following situation. Loan amount is 30 lakhs. 10 lakhs released on 1/7/2011. Year end 31/3/2012. Interest charge at the rate 12% per annum. Commitment charges 0.5%. And the next one, insurance, brokerage and commission paid rupees 1 lakh. Company had a policy to write off direct expenses at the time of acquisition of borrowings over the period of loan, that is 10 years. Answer. Take 2 minutes time and answer. Those people who are watching on YouTube, if you know the answer, please do comment the answer. What is the answer? 1,40,000. Any other answers by anyone? No calculators, huh? Okay. Exempted. 1 lakh. 1,40,000. Fine, let us start. 30 lakhs is the loan amount and 10 lakhs is interest. 10 lakhs is released on 1/7/2011. Interest charges is 12% per annum. So interest charges will be computed on released portion of loan, that is 10 lakhs into 12% into 9 by 12. How much? 90,000. Yes, it is included. Commitment charges 0.5%, which is on unreleased portion of loan. How much is unreleased portion of loan? There ends the matter. No number of months by 12, something like that. Is it clear? On commitment charges, we will be generally paying only once. So 20 lakhs into 0.5%. Yes, even it is also included. And the next one, total insurance brokerage commission paid is 1 lakh. And company is having a policy to write off the direct expenses over a period of 10 years. So 1 lakh divided by 10 years, 10,000. Why did you get 1,40,000? 9 by 12. Okay. And finally, what is your borrowing cost? 1 lakh. 10,000 is your borrowing cost. Is my point clear, everybody? Sir, say for example, if this statement is not there, what is the borrowing cost now? Simply you will be adding entire 1 lakh and hence total 2 lakhs will become borrowing cost. Respond everybody, clear. Anyways, my dear children, quickly answer me. Borrowing cost includes number 1, interest, commitment charges, direct expenses relating to acquisition of borrowings but not relating to settlement of borrowings, loss on issue of debentures, discount on issue of debentures, and loss is also called as premium on redemption of debentures. The next one, finance charges in finance lease as per AS 19. The next one, forex as per accounting standard number 11. Respond everybody, clear. And now moving on to the next thing, for all these things accounting standard number 16 is applicable, but for owned cost accounting standard number 16 is not applicable. Sir, what do you mean by owned cost? Cost on owner's equity. Cost on owner's equity, which can be either actual or which can be either implied. Actual borrowing, actual owned cost, example dividend. Implied owned cost, example interest on capital. Hey, did you remember? In sole proprietorship and partnership, you are having interest on capital, which is a kind of opportunity cost. Interest on capital AS 16 is not applicable. Even dividend AS 16 is not applicable. Very, very important. Sir, what about this so-called preference share capital, sir? Did you remember I have asked even a question in framework? Is preference share capital an equity or a liability? So now, even yes, as per framework it's a liability, but as per schedule 3 it is supposed to be shown under the head equity. So now it is up to the business concern. If they are treating preference share capital as owner's equity, cost on preference share capital, preference dividend is also called as owned cost, and AS 16 is not applicable. But if they are treating it as borrowings, then cost on preference share capital, preference dividend will be treated as borrowing cost, and AS 16 is absolutely applicable. Respond everybody, clear. Fine, my dear children, this is what with respect to the applicability. And now moving on to the important aspects of borrowing cost. Likewise, when to capitalize, when to start or commence capitalization, when to suspend capitalization, when to cessate capitalization. Starting, stopping, temporarily stopping. Listen very carefully, everybody. Start capitalizing the borrowing cost when there is an asset and that asset had satisfying the definition of qualifying asset. Sir, what do you mean by qualifying asset, sir? An asset which is taking substantial period of time is called as qualifying asset. What is substantial period of time? Ante generally 12 months is the substantial period of time. More than 12 months is obviously substantial period of time. Less than 12 months may or may not become substantial period of time depending on the question. If at all technological factors and commercial factors are involved, then even less than 12 months is also considered as substantial period as per the management decision. Otherwise, it is not called as a substantial period. Generally, for the purpose of examination, 8 months, 9 months, 6 months, even everything will be considered as substantial period of time unless and until specifically nothing is mentioned. Even 11 months, yes, you can generally continue it as a substantial period of time. But let me give you the conclusion. How will it be in the examination? Sir, it is 12 months. Yes, sir, it is qualifying asset, substantial period of time. Sir, more than 12 months. Yes, sir, it is substantial period of time and qualifying asset. Sir, less than 12 months. Check out the question. If question is mentioning it as a qualifying asset, yes, it is a qualifying asset. If question is not mentioning it as a qualifying asset, yes, it is not a qualifying asset. If question is giving a clue, like due to technological factors or due to commercial factors, the construction period is reduced and hence it is less than 12 months, yes, even then it is a qualifying asset. Respond everybody, clear? Sir, construction completed just within a period of 8 months. Nothing is mentioned. Now, not a qualifying asset. Construction is completed within a period of 8 months since we are using more labor where all the other industries are comparatively completing the construction within a period of more than 12 months. In such a case, it is a qualifying asset. So you need to observe the question carefully. Yes, 12 months, qualifying asset. Yes, more than 12 months, qualifying asset. Less than 12 months, nothing is mentioned, not a qualifying asset. Less than 12 months, but told that he himself is telling it's a qualifying asset. Yes, it is a qualifying asset. Less than 12 months, he is giving a clue. Due to technological factors, commercial factors, other considerations, if you consider it as a qualifying asset, it will become qualifying asset. Is my point clear, everybody? So now take care. When to start or commence capitalization? Point number 1, you should have an asset. Point number 2, you should have a qualifying asset. Next, you should have a borrowing. You should incur some borrowing cost. And qualifying asset activities must be work in progress. And you must have incurred some expenditure on the borrowing cost. Sorry, on the qualifying asset. There should be an asset. There should be a qualifying asset. There should be a borrowing. There should be a borrowing cost. And activities of qualifying asset must be work in progress. These activities may be either physical construction or it can be either administration or technical things also. Designing work is also comes under activities. Approval licenses, getting licenses is also coming under activities. Not only physical or active construction, even technical work, groundwork, administration work will also be called as activities of qualifying asset. And the next one, there must be an expenditure which is incurred on the qualifying asset. Only then borrowing cost will be capitalized to the qualifying asset. Respond everybody, clear? Next one. Yes, sir, you have started capitalizing. Then when to stop capitalizing? So simple. If qualifying asset is completed, ante, it should not be actual to use, it should be ready to use. Actual putting to use is not needed for us. It must be available for use or it must be ready to use. Till the point of ready to use and till the point of available for use, then automatically stop capitalizing. And from that moment you have to charge. Is it clear, everybody? There will be a question in your material, something like on 1/1/2012 itself, qualifying asset is absolutely completed. but its decoration work is not yet completed till 28/2/2012. So now you have to stop capitalizing from which date? 1 because qualifying asset is completed, decoration work is absolutely not needed for making the asset ready to use. But say for example, if decoration work is very much needed in order to make the asset ready to use or available for use, then you have to continue capitalization till 28/2, and from that point you need to charge. Respond everybody, clear? Now very important, if qualifying asset can be completed in parts, then completed part which is ready to use. Completed part which is ready to use. Yes, you can simply charge. Uncompleted or incompleted parts which are not yet ready to use, continue capitalizing proportionately. Respond everybody, clear? And last and final concept, that is all about suspension. When to suspend this capitalization? If at all the work is suspended, qualifying asset activities are suspended, then you also suspend capitalization. But check out why the work is suspended. Is the work is suspended, be careful everybody, is the work is suspended as a part of production? Is the work is suspended as a part of production, or suspension is very much needed for further construction? Suspension is very much needed for further construction. In these two cases, if the work is suspended, you have to continue capitalization. Other than these two cases, if the work is suspended, then you have to immediately charge. Provided if the suspension is for an extended period. Suspension is for an extended period. Let me give you an example. Suspension is a part of production. Say for example, manufacturing of wine. You have taken some grapes and you would like to ferment the grapes at least for 1 year in order to get prompt wine. So that 1 year you have to suspend the work and you should not do anything. Now tell me what to do. Capitalize, because that is a part of production. After the construction of slab, for at least a minimum period of 21 days or 15 days, you should not do any work. That is a part of manufacturing or construction, and hence continue capitalization or stop capitalization? Continue capitalization. Is point number 1 clear everybody? Now you are constructing a bridge on a river. In the course of construction of bridge on a river, suddenly due to heavy cyclone or suddenly due to heavy rain, you have to stop the work for a minimum period of 1 month. Now answer me. Continue capitalization or stop capitalization? Chapali. Continue capitalization, because their suspension is very much needed for further construction. If you did not care about that rainfall, and if you have constructed the bridge will fall down like anything. And hence suspension for further construction if it is needed. Sir, please don't learn in the name of normal and abnormal. Some people will be learning if the suspension is due to normal reason, capitalize. Suspension is due to abnormal reason, charge. Normal and abnormal is very confusion. Frankly speaking, rainfall is an abnormal reason. Ante kada. But even in this case also you have to capitalize. Reason is so simple that suspension is very much needed for further construction. Construction of road on hilly area. But due to heavy rains, the landslides, hill slides are falling down. And it is damaging the road. Stop the worker, continue the worker. Now during that period, continue capitalization, charge. Continue capitalization. I hope you're comfortable. Shall I proceed further? And now my dear children, say for example, work is suspended due to any other reasons like labor strike. Charge capitalizer. COVID-19. Answer. COVID-19. Charge. Because COVID-19 is not a part of production. COVID-19 is not COVID-19 during COVID-19 times, suspension is not needed for further construction. Even though a person is attacked with COVID, that COVID, whatever that virus is there, it will not attack the building. I hope you have understood. Even though workers who have got COVID have constructed the building will not fall down. So that suspension is not needed for further construction. That suspension is needed for public safety and social welfare. I hope you have understood. During COVID-19, if you have stopped the work, you have to charge. Respond everybody pakka. Now the last and final one, if the suspension is done due to labor strike for 1 day, continue capitalization because 1 day may be immaterial out of 365 days. Is it clear? Amma, if at all stopped for 1 day given in your MCQs, then obviously you are supposed to write something like, yes, since that 1 day is not at all in these two parts, it has to be continued capitalization. But if at all you are supposed to write the descriptive answer, then you are supposed to write the provision. If the suspension is for an extended period, 1 day is an extended period, an immaterial period, and hence you can continue capitalization. But if at all it is MCQs, then it is normally, because you have to find a better answer, kada? Find the better answer for MCQs. If at all in your options 1 day is not an extended period, then that's the perfect answer. If that option is not there, next best answer, charge, since that is not relating to these two parts. Respond everybody, clear? And my dear children, this is what your suspension, cessation and commencement of capitalization. And moving on to the next thing, be careful, amma. If you have incurred an expenditure on qualifying asset, like you are having a problem, kada? You will be having problem. You will be finding weighted average rate of borrowings. Did you remember how to find weighted average rate of borrowings, amma? Total borrowing cost divided by total average borrowings multiplied by 100. Is my point clear, everybody? Total borrowing cost divided by total average borrowings multiplied by 100. This is with respect to general borrowings. But for specific borrowings, not at all needed. Specifically, it will be given in the question. Hold your calculator and tell me the answer. On year is from 1/4 to 31/3. On 1/4, you are having a general borrowing of 1 lakh at the rate 10% per annum. On 1/7, 5 lakhs borrowed at the rate 12% per annum. And direct expenses incurred is equal to 10,000. On 31/12, 2 lakhs borrowed at 8% per annum. What is the weighted average rate of borrowings? Answer. What is the weighted average rate of borrowings? Answer. No clarity. 8.625. Next, any other answer? 8.625. Okay. 8.625. Okay, let us find the final answer. Borrowing cost 1 lakh into 10% plus 5 lakhs into 12% into 9/12 plus 10,000. Because even 10,000 is also borrowing cost, kada? Direct expense, I have told you what is borrowing cost at the first concept. Plus 2 lakhs into 8% into 3/12. What's the numerator now? 69,000 divided by 1 lakh plus 5 lakhs into 9/12 plus 2 lakhs into 3/12. Poinda? Potadi. Take care, number of months to weighted average rate of borrowings is equal to total borrowing cost divided by total average borrowings. Be careful. Multiplied by 100. Ippudu cheppandi. 13.143%, which is a perfect answer. 8.625 is not wrong. Ivi ettesuntaru meeru. Did you get the answer? Fine. Take care. Everybody, is the concept clear? Fine. So now, if at all on a particular qualifying asset, if you are incurring both specific borrowings and general borrowings, what to do, sir? On general borrowings, you have to apply weighted average rate of borrowings proportionately. On specific borrowings, you need to apply the specific rate right from the date of loan. A general borrowings ante, it can be used even for qualifying asset or even for any other asset also, and hence you have to apply proportionately. But coming to specific borrowings, use specific rate from the date of loan, because irrespective of usage, you have to pay the total interest on loan kada. Hey, respond, is my point clear? Say for example, 2 lakhs at the rate 12% per annum, general borrowings, and the next one 5 lakhs at the rate 8% per annum, specific borrowings 20 lakhs at the rate something like 9%. Now usage on 1/1, say for example 1/4, year is from 1/4 to 31/3. On 31/7, 31/8, 1/12 on chalu. So total should be 24 lakhs ankondi, 10 lakhs, 12 lakhs, 1 lakh, 1 lakh. I hope amount is okay. Fine. And so, how much borrowing cost you have to capitalize in this context? I hope you have understood what kind of problem is this one. Elanti problem ardhamainda antunna. So you will be having multiple problems of this kind kada. Let me show you this type of problem. Sir, ardhamainda? Now need the answer. How much borrowing cost? You just need to capitalize. So simple. 2 lakh. Sir, for the next 10 minutes, this is our discussion. Please participate and make the answers promptly. Two lakh. 16,572. Any other? And cross check. Obviously. Sir, frankly speaking, you just generally will be following FIFO method. Ante kada? And since specific are there, first use specific. And only then we'll touch general. So now 10 lakhs into 9%. How much? 90,000. And out of 20 lakhs, you have used 10 lakhs. And still you can use 10 lakhs into 9% once again. Because specific, no proportionate will be applicable. Logic sadgaddu, because you might have already done in your classroom. This is marathon session. And now take care, still 2 lakh is there. Still 1 lakh is there. Still 1 lakh is there. Multiplied by some weighted average rate of borrowing. What is the weighted average rate of borrowing, Amma? 9.14. That is 2 lakhs into 12% plus 5 lakhs into 8% divided by 2 lakh plus 5 lakhs into 100, which is 9.14%. Very important, huh? Multiplied by how many months balance, Amma? 8 by 12. 31/7 and 4 months completed kada. 8 by 12. 7 by 12. 4 by 12. This is your answer. So I don't concentrate on the final answer. I'm just telling you the computation. Hey, respond, is that concept clear? What is the final answer? If not computed, absolutely fine. Don't concentrate on the final answer. Computation is that one. Did you get the correct one or wrong? Wrong. Congratulations. Shall I proceed further to the next example? Sir, concentrate carefully. The next example. Say for example, everything same. But construction is completed on 31/12. And it is a qualifying asset. Construction completed on 31/12. And it is a qualifying asset. Now, start everybody. What is the computation? 10 lakhs into 9% into 9 by 12 you have to apply. Hey, reason is so simple. Here you are concentrating only on the borrowing cost which has to be capitalized. Stop capitalization when qualifying asset is ready to use. So by 31/12, since the construction is completed, qualifying asset is ready to use by that date. And hence only up to 9 months you have to capitalize. Is the point clear? Next 12 lakhs slow, make it into two parts. 10 lakhs into 9% into 9 by 12. Is it clear? Next 2 lakhs, 1 lakh, 1 lakh into 9.14%. Getting my point, everybody? Multiplied by how many months, Amma? Only up to 31/12 you need to consider. 5 by 12, 9, 10, 31, 7, 8, 9, 10, 11, 12, 5 months. Tarvata 4 by 12 and last and final 1 by 12. Hey, respond, is it clear? Sir, I'm trying to cover every model. In the same example, I'm trying to cover every model. If the construction is at the till the end of the year, first thing what I told you. If the construction stopped in the meantime, this type you have to do. Shall I proceed further to the next example, mostly the last and final one? Now, you have taken the specific borrowing on one six. And wait. There will be a flaw. Let me modify the numbers. Three lakhs, 2 lakhs, 9 lakhs, inka 12, 13, 14, 10. Ante. Year is up to 31/3 and construction is lasting till 31/3, till year ending. Now the answer, the last and final example. Shall I? Please cross check. 3 lakhs into. Sir, frankly speaking, on 1/4 I don't have specific borrowings at all. So I have to use general borrowings at rate of 9.14 multiplied by, of course, all the 12 months. Because right from 1/4 to 31/3. Now take care. Yes, I'm having specific borrowing on 1/6. And by this jet I can comfortably utilize specific borrowing. So 2 lakhs into 9% into how many months? Right from 1/6 I have to count. And 1/6 under 2 months gone. So into 10 by 12. Is my point clear? And the next one, out of 20 lakh, 2 lakhs gone. And still balance 18 lakhs is there. So 9 lakhs, use specific borrowings into 10 by 12. Is it clear? Out of 20, 11 lakhs gone. 11 hai na? Yes, balance 9 lakhs. So now, yes, make it into two parts. 9 lakhs into 9% into 10 by 12. 1 lakh into 9.14% into 4 by 12. I hope you're comfortable now. So with these things, I'm pretty sure you can solve any kind of problem what is there in your material. Only one small add-on. If at all any temporary income or temporary interest is there, please reduce the same only from the capitalization period, not for the entire period. Sir, Arthamainda, if you are having any temporary income from specific borrowings aithe, temporary income from specific borrowings ante only during the capitalization period you have to reduce the temporary income. Adi general borrowings ante you can reduce for the entire period, because general borrowings can be used for any purpose for entire period, but specific borrowings can be used only up to the purpose of construction kada. Sir, is it clear? So now temporary income, if any temporary income is there, it has to be reduced. It has to be reduced only from the construction period if the income is earned from specific borrowings. If the income is earned from general borrowings, it can be decreased for the entire period. Respond everybody clear? And my dear children, the last and final concept relating to accounting standard number 16. Sir, such portion of foreign exchange difference which has to be treated as per accounting standard number 16, not as per AS 11. Such portion of foreign exchange difference which has to be treated as borrowing cost as per AS 16 but not as per AS 11. What is that such portion, sir? This concept is applicable only when foreign exchange loss is there. This concept is applicable only when foreign exchange loss is there. This concept is applicable when borrowing cost in India is greater than borrowing cost from outside India. This concept is applicable when borrowing cost in India is greater than borrowing cost from outside India. Let me give you an example. Say for example, everybody, you have borrowed $1 lakh. As on the date of borrowings, it is rupees 50. Say on 1/4. Your year ending is absolute 31/3. And year at the rate 10% per annum. Year ending rate is equal to 52. And if you borrowed in India, then the what is it called? Rate would have been 14% per annum. Is my point clear, everybody? Now start computing borrowing cost in foreign currency borrowings. What is the borrowing cost in foreign currency borrowings ante? $1 lakh into, yes, 10%. You are supposed to pay the rate of interest. You have to pay the rate of interest at the end of the year kadamma, into 52. Hey, is it clear? $1 lakh into 10% into 52, which comes to rupees 5,20,000. Now borrowing cost in India, $1 lakh into 50 rupees at the time of taking the loan. If you have taken in India, it is like 14%, 7 lakhs. Since borrowing cost in India is greater than borrowing cost in foreign currency borrowings, this concept is applicable. Now let us find the foreign exchange loss. What is a foreign exchange loss, sir? Sir, $1 lakh is a loan amount, which is a monetary item. Year ending rate is 52. So 52 minus 52 into $1 lakh, which comes to 2 lakhs. So this into two parts. Part 1, difference between the borrowing cost of foreign currency borrowings and borrowing cost in India, which is like 7 lakhs minus 5,20,000, 1,80,000, and balancing figure which comes to 20,000. Whatever this portion is there, this is also treated as borrowing cost as per accounting standard number 16. And whatever the balancing figure is there, it is foreign exchange loss which has to be treated as per AS 11. Sir, now what is the total borrowing cost, sir? Total borrowing cost is actual borrowing cost plus notional borrowing cost. What is the actual borrowing cost, sir? If nothing is mentioned, the actual borrowing cost is borrowing cost in foreign currency, which is 5,20,000. Ante kada. And since you have borrowed from the foreign country, it is 5,20,000. If you are applying a rule, even 1,80,000 is also added. So now actual borrowing cost plus notional borrowing cost, 5,20,000 plus 1,80,000, altogether 7 lakhs is your borrowing cost now. So even though you have borrowed from outside India, your borrowing cost is almost equal to Indian borrowing cost itself. Hey, respond, is it clear? My dear children, say for example, if it is only 1 lakh, what to do? Amma. If foreign exchange loss is 1 lakh, what to do? Antunna. Treat only 1 lakh as borrowing cost. Is it clear? Then what is your total borrowing cost? Ante 5,20,000 plus 1 lakh, which comes to 6,20,000. If this is foreign exchange gain, this concept is not applicable, and hence your borrowing cost is limited only to 5,20,000. Respond everybody, clear? So let me solve the same in 3-step approach. Step number 1, step number 2, and step number 3. Step number 1, borrowing cost in foreign currency borrowings. Compute. Foreign currency borrowings multiplied by foreign rate multiplied by year-end rate. Next, borrowing cost in India. Foreign currency borrowings multiplied by spot rate. Rate on date of transaction multiplied by rate, Indian rate. And then conclude that if step number 2 is greater than step number 1, move forward to step number 3. Ante borrowing cost in India should be greater than borrowing cost in foreign currency borrowings. Then move to step number 3. Find foreign exchange loss. Hey, if foreign exchange gain is there, this concept is not applicable. So find foreign exchange loss and make this into 2 parts. Step 2 minus step 1. This will be treated as borrowing cost. And balancing figure. This will be treated as per accounting standard number 11. Conclusion. If foreign exchange loss is less than the difference between step 2 minus step 1, then limit only to the foreign exchange loss as borrowing cost. I hope you are comfortable. There is one advanced provision which is not needed for exam. Advanced provision entante, if in any other year, next year, if you have got foreign exchange gain, then this can be reversed entered. But that's not needed. Intavaraku chalu. Respond everybody, clear. Step number 1, what is step number 1? Amma? Borrowing cost in foreign currency borrowing. Step number 2, borrowing cost in India. Step number 3, find foreign exchange loss, and conclude that step number 2 should be greater than step number 1. Foreign exchange loss has to be done into 2 parts. Step 2 minus step 1 okati, balancing figure. Balancing figure will be treated as per AS 11. Step 2 minus step 1 will be called as borrowing cost, and that is treated as per AS 16. And if it is used for qualifying asset, capitalize. If it is not used for qualifying asset, charge. Respond everybody, clear. And my dear children, this is the end of accounting standard number 16, and get ready for accounting standard number 20. Fine, let us start with the next standard, that is accounting standard number 20. What is AS 20, Amma? EPS. What is EPS, Amma? Earnings per share. This is also very simple standard, and earnings per share is actually nothing but earnings available to equity shareholders divided by weighted average number of equity shares. And earnings available to equity shareholders is nothing but earnings after tax or profit after tax minus preference dividend. And coming to preference dividend, be careful, find whether is it cumulative or non-cumulative. If it is non-cumulative, deduct only when it is declared. Whereas coming to cumulative, deduct irrespective of declaration only for that year. Non-cumulative aithe deduct only when it is declared. Cumulative aithe deduct irrespective of declaration only for that year. And coming to earnings after tax, which is nothing but earnings before tax minus tax expense. Earnings before tax has to be computed as per AS 5. Profit or loss for the period, prior period, changes in accounting policies. And coming to tax expense, you just need to compute the same as per accounting standard number 22. And now coming to VANS, weighted average number of equity shares. Just find the equity shares multiplied by the holding period by the company divided by 12. And if at all the issues are increasing, simply add it. If at all the buyback are there, simply deduct that. Is my point clear, everybody? Likewise, opening equity shares multiplied by 12 by 12 plus new public issue equity shares multiplied by number of months by 12 plus new public issue equity shares multiplied by number of months by 12 minus if any buyback is there, such number of buyback shares multiplied by number of months by 12. Is the point clear, everybody? Right from that date till the end of the period, take that months and simply add if it is issue, deduct if it is buyback. Respond, everybody, clear? Huh? Now the real problem is not with these basic things. Number one, if at all, what is it called? Differences in face value is there. If differences in face value is there, automatically you just need to equalize the same. How to equalize the same, sir? Number of equity shares multiplied by lower face value divided by higher face value. If different paid up values are there, the same number of equity shares multiplied by lower paid up values divided by higher paid up values will be considered. Is it clear, everybody? Number of equity shares multiplied by lower face value divided by higher face value and lower paid up value divided by higher paid up value. In this way, you just need to compute the weighted average number of equity shares. Okay, respond, everybody, clear? Say, for example, on 1/4, if you are having 2 lakh equity shares, on 1/8, if you have issued 1 lakh more equity shares, on 1/12, if you have bought back 50,000 equity shares. How to find the weighted average number of equity shares? Here starting 2 lakh into 12 by 12 plus 1 lakh into 1/8 to 31/3, 8 by 12. This is buyback, amma. So minus 50,000 into 1, 2, 3, 4. I mean 12, 1, 2, 3. Totally 4 by 12. I hope it's clear, everybody. Now, moving on to the next example with a similar question. Say, for example, this is at the rate rupees 10. These are at the rate rupees 5. Now, how to find weighted average number of equity shares? 2 lakhs into 10 by 10 into 12 by 12. Is that point clear? Simply like 2 lakhs into 1 second. 2 lakhs into 10 by 10 into 12 by 12. Now take care, 1 lakh into, first of all, make them equalize the shares. So into 5 by 10 into 8 by 12. Yeah, I hope it is clear for everybody. Okay. Now, if at all any smaller paid up values or higher paid up values are there, then even that also will be considered in the same style. Ante, number of equity shares into smaller paid up value divided by higher paid up value multiplied by number of months by 12. Okay, respond, everybody, clear? Fine. And moving on to the next thing, my dear children, like the concept is all about some special issues which is like bonus shares. Not only bonus shares gani, share split gani, consolidation gani. What is this concept, sir? Fine, amma. The concept here is all about adjusted EPS. Hey, what is it, EPS, amma? Adjusted EPS or restated EPS or revised EPS. Adjusted or restated or revised EPS. Fine, coming to adjusted, restated or revised EPS, my dear children, be careful the issue period. Generally, if you have remembered, there will be one concept called effective date of issue. Hey, did you remember? Effective date of issue. So what is the meaning of effective date of issue? If at all the shares are issued for cash, if at all the shares are issued for cash, date on which money should be receivable. Not the actual receipt has to be considered. Date on which actually you are supposed to receive the money. From that date, you need to consider the weight into number of months by 12. No? Weight. If the shares are issued for cash, date on which the cash is receivable has to be considered. And if at all issued for what is it called, settlement of a liability, then date on which liability is settled, which is date of settlement. Shares are issued for purchase of an asset, date on which asset is recognized in the books of accounts. Is it clear? And issued for the purpose of repayment of loan, date on which interest ceases to accrue. Date on which interest ceases to accrue. Like that, there are some concepts. Even issued equity shares for amalgamation in the nature of merger, right from the beginning of the previous company's reporting period. Right from the beginning of the previous company's accounting period or reporting period. Is my point clear? Hey, pakka. Sir, if it is amalgamation in the nature of purchase, date of amalgamation. If at all you are issuing the shares for the purpose of amalgamation in the nature of merger, you need to consider the time weighing factor right from the beginning of the reporting period of the previous company, that is transferor company. Simply to tell you, transferor company's reporting period has to be considered for computing time weighted average factor for transferor company shares. Is it clear? Consider the time weighing factor of transferor company for computing transferee company weighted average number of shares, provided if it is amalgamation in the nature of merger. If it is amalgamation in the nature of purchase, you need to consider and compute the date of amalgamation. Respond everybody clear? Huh? Fine, my dear children. Now, like that, if it is bonus, if it is share split, if it is consolidation, then what date we have to consider, sir? So simple, date of beginning of the previous reporting period. Date of beginning of previous reporting period. But be careful, huh? Date of original shares you need to consider. If at all for the previous reporting period starting that shares are not there, you can't compute for that much period. Sir, is my point clear? Huh? What is the date of bonus shares, share split or consolidation? Amma? Date of beginning of previous reporting period. But if at all by the previous reporting period such shares are not there, consider the period of original shares. Is my point clear? Huh? Let me give you an example. Concentrate here, everybody. Say, for example, transferor company started on 1/7/2020 and date of amalgamation is 1/12/2020. Year ending of transferee company is 31/3/2021. And shares of transferor company is equal to 1 lakh. And swap ratio or exchange ratio, swap ratio antadu jagratta. Swap ratio, which is also called as exchange ratio, is 3:4. And for every 4 shares, they would like to give 3. Is it clear? Shares of transferee company is equal to 90,000. Find the weighted average number of equity shares by the year ending 31/3/2021. This is the question. Answer. Any answer? How much? 167,500. 146. 250. Before answering, I could have appreciated you, first of all, if you have asked me what is the nature of amalgamation. Before answering, if you have asked me what is the nature of amalgamation, I could have appreciated you. Anyways, let's find if it is amalgamation in the nature of merger. First of all, let's find what is the answer. In the question, absolutely he'll give what is the nature of amalgamation for sure. Otherwise, you write the assumption. Now, if it is amalgamation in the nature of merger, first of all, how many shares to the transferor company we have given? 1 lakh into 3 by 4. Entama? 75,000 were given. And totally in transferee company now there are 90,000 plus 75,000. 1 lakh 65,000. If nothing is mentioned, simply 1 lakh 65,000 into 12 by 12. Issue closed. But the real problem here is all about this 90,000 are there for entire 12 months. But this 75,000, you need to consider the reporting period of transferor company. Transferor company is established only on 1/7/2020 kada. So you need to consider only for 9 months. So 75,000 into 9 by 12. And the final answer is 146,250, provided if it is amalgamation in the nature of merger. And if it is amalgamation in the nature of purchase, that is very simple. 90,000 into 12 by 12 plus 75,000 into, you need to consider the date of amalgamation kada, into 4 by 12. Whatever is that. Respond everybody clear. Now, bonus issue related example, concentrate. On 1/4/2021, 1 lakh equity shares are there. On 31/8/2021, plus 50,000 equity shares are issued. Is it clear, everybody? Now, moving on to the next thing. 31/3/2021 is the year end. Next financial year, somewhere on 1/6/2021, bonus given in the ratio 1:5. Now you are supposed to find the weighted average number of equity shares for 31/3/2021, 31/3/2022. And 31/3/2021 and 31/3/2022. What is the weighted average number of equity shares? Answer? 31/3/2021. 149, 167, okay, which is nothing but 1 lakh into 12 by 12 plus 50,000 into 7 by 12. Is it clear, everybody? Next, on 31/3/2022, this is a task actually, be careful. 1 lakh. Okay, let's start. Sir, bonus ante first of all 1:5. And you are giving the bonus somewhere on 1/6/2021. Hey, am I correct or wrong? So, sir, be careful, huh? Actually, as at 31/3/2022, you will be having two things, Amma. Number one, for the year ending 21/22 and for also the last year, that is 2021. This is actually called as restated or revised or adjusted EPS. This is common only. This is also common, but the real is this one. Anyways, shall I start now? So be careful, my dear children. As on 21/1/2021-22, sir, right from the beginning of the year, you are having 1,50,000, Nana. Ante kada? Right from the beginning of the year, you are actually having 1,50,000. So 1,50,000 into 12 by 12. Please respond. Plus bonus shares. How many bonus shares ante? 1:5. So 1,50,000 into 1/5. How many bonus shares? Entama? 30,000 are the bonus shares. So now plus 30,000 into how many months by 12 you need to consider? 12 by 12. Because you are giving bonus on these shares kada. Since these shares are there for the entire period, you need to consider even this also for the entire period. Is it clear, everybody? Pakka. Next. Moving on to the next thing. Be careful. Restated EPS. Coming to restated EPS, be careful, Amma. Something like, yes, 1 lakh. Last year we are checking kada. So 1 lakh into 12 by 12 plus 50,000 into 7 by 12. Is it clear? Very, very important. Consider the bonus issue right from the beginning of the previous year reporting period. Am I correct or wrong? And hence plus on this 1 lakh. First of all, what is a bonus, Amma? 1:5. 1 lakh into 1 by 5. 20,000 into 12 by 12 plus on this 50,000 it comes to 10,000 into 7 by 12. I hope you are actually comfortable. Pakka. Bonus issue logic is very simple. Whatever the previous year reporting period part is there, simply consider the same initially. But if at all by the previous year reporting period starting, if the shares are not there, whatever the shares of original shares are there, consider the time weighing factor of original shares. Respond, is it clear? Sir, what is the time weighing factor of bonus shares? Time weighing factor of original shares. Time weighing factor of original shares and it is normal only. Time weighing factor of bonus shares. Sir, ardhamainda? What is the time weighing factor of bonus shares? Point number 1. Right from the beginning of the previous year reporting period. If beginning of the previous year reporting period such shares are not there, consider the time weighing factor of the original shares. Respond, everybody, clear? ఇప్పుడు నేనేమంటున్నానంటే since the bonus 30,000 whatever shares which are issued in the current year on 1,50,000, since 1,50,000 are there for the entire period, bonus shares is also for the entire period. Is it clear? But if you go to the last year, 20,000 shares or the bonus or 1 lakh which is there for the entire period. But unfortunately these 10,000 shares are not on the shares which are issued at the beginning of the year. These shares are issued exactly after 5 months and hence corresponding bonus shares is also should be considered the same time weighing factor. Still any doubts to anyone? Sir, conclusion chapra, bonus shares time weighing factor. Previous year reporting period. If previous year reporting period starting that shares are not there, then consider the time weighing factor of original shares. I hope you are comfortable now. Pakka? This is a bit advanced. Be careful. This is a bit advanced. Koncham. So consider the time weighing factor of original shares. Freeze that in your brain so that things will go good. And now coming to the next concept, that is all about right shares or rights issue. Coming to rights issue, it is very, very simple. First of all, you need to consider and compute something called theoretical X rights price. Theoretical X rights price is equal to Cheppali, theoretical X rights price is equal to original shares multiplied by cum rights price plus right shares into rights price divided by original shares plus right shares. Respond, everybody, clear? After this you are going to get a theoretical X rights price. Then you are supposed to find a bonus element, or it is also called as adjustment factor, or it is also called as the rights factor, or it is also called as bonus factor. How to find this bonus factor, sir? So simple, amma. Cum rights price divided by theoretical X rights price. Konnisarlu in a confusion you will be putting reverse. But remember, this bonus element should be always 1.0 something. It should not be 0 point. If you have got 0 point something, you have applied reverse ani ardham, immediately rectify that. Sir, ardhamainda? Sometimes in a hasty way, hurry way, you will put theoretical X rights price divided by cum rights price. then you will get 0 point something. But remember, that is wrong. Always bonus element should be something like 1.0 something. And now be careful, huh? In this 1.0 something, make this into two parts, amma. 1 okati, 0.0 something okati. Assume that 1 is for full consideration and the date of rights issue will be considered. But this 0.0 something undi kada, consider this as bonus shares multiplied by original shares. Automatically apply the time weighing factor of bonus shares. Just now we have learned time weighing factor of bonus shares is nothing but time weighing factor of original shares. If original shares are 12 by 12, bonus shares are 12 by 12. If original shares 7 by 12, bonus shares 7 by 12. If original shares 5 by 12, bonus shares also 5 by 12. This bond concept understood. Now let me tell you an example. Say for example, totally 1 lakh shares are there. Here. Totally 1 lakh equity shares are there at the rate rupees 10 face value. Right from 1/4/2021 and year is 21/22. Rights ratio is something like 1:4. Issued at rupees 80 when cum rights price is equal to 120. Is it clear, everybody? That's it. So now, how to find the rights answers for this, sir? Point number 1, compute theoretical exercise price. Amma. One more thing, rights issue is made somewhere on 1/7/2021. Let's start. Theoretical exercise price is very simple. Theoretical exercise price, original shares, how many are there, Amma? Multiplied by cum rights price plus right shares. How many are the right shares, Amma? Multiplied by rights price, that is 80, whole divided by original shares plus right shares, where theoretical exercise price comes to 112. And now let us find bonus element or adjustment factor is equal to cum rights price 120 divided by theoretical exercise price 112. Exactly. 1.07. Hey, now be careful, huh? 074 something. But stop immediately after 2 digits. 1.0 something. Stop there. And make this concept into 2 parts. Jagrata, everybody. Sir, 1 okati, 0.07 okati. 1 and 0.07. Shall I start now? How to crack this? Sir, totally how many shares you are having, Amma? 1 lakh multiplied by 1/4. So total right shares are 25,000. If you make this into 2 parts, be careful, everybody. 0.07 multiplied by original shares, that is 1 lakh. How many you will get? 7,000. These are called as bonus shares. And balancing figure, how much is there, Amma? 18,000. These 18,000 are simply considered as full consideration shares which are actually issued somewhere on 1/7/2012. On 1/7/2012. Since these are bonus shares, consider the time weighing factor of original shares. That is 1 lakh. For 1 lakh time weighing factor is 12 by 12 kada, and hence for 7,000 also time weighing factor will become 12 by 12. I hope now it is comfortable to you. And cracking right shares into 2 parts. One is full consideration shares, one is bonus shares. Then specifically how to deal right shares. No concept is needed. Comfortably you can follow this provision and you can solve the problem. Respond everybody clear, huh? This is the end of rights shares. And now moving on to the next one, dilutive EPS. Coming to dilutive EPS, consider potential equity shares for dilutive EPS with no flow of consideration. Consider potential equity shares with no flow of consideration. You will be computing it for dilutive EPS. Whereas adjusted EPS is considered for those increase or decrease in number of equity shares with no change in resources. So even this one and this one sound similar but different. This is potential equity shares and future equity shares. This is already issued equity shares like bonus, share split, consolidation, rights. Potential equity shares and future equity shares like convertible bonds, convertible debentures, convertible preference shares, or even options. How to compute dilutive EPS for options, sir? Sir, first of all, be careful. Dilutive EPS is equal to earnings available to equity shares plus earnings available to potential equity shares divided by weighted average number of equity shares plus weighted average number of potential equity shares. Is my point clear, everybody? So now for options, how to compute, sir? First of all, be careful, amma. If at all given in the question that 1 lakh options are issued at 15 rupees where the fair value is 20 rupees. You need to consider total options and total potential equity shares only with no consideration. For the computive of dilutive EPS, you need to compute such potential equity shares with no consideration. Is my point clear, everybody? 1 lakh are the options given now which will be converted into equity shares in future. Offer price is 15 where the fair value is 20. And the free how much is there? So consider only free part. And 1 lakh into 5 by 20. Where you will get 25,000. Is my point clear, everybody? So dilutive EPS for option is nothing but EAES plus. If options are converted into equity shares, will any earning is saved? Will any earning is saved or not? No. But divided by original weighted average number of equity shares plus weighted average number of potential equity shares. That is number of options multiplied by free portion divided by fair value. Free portion is nothing but fair value minus issue price. Respond, everybody, clear? This is for options. And now moving on to the next thing. After options, we need to compute for convertible debentures. Say for example, or convertible preference shares, that's of your choice. But convertible debentures. Normally earnings available to equity shares. Plus, if debentures are converted into equity shares, what will be saved, amma? But take care, after tax it will be saved. So interest into 1 minus tax rate. Whole divided by weighted average number of equity shares plus weighted average number of potential equity shares. That is like if debentures are converted into equity shares, that will be given in the question. Each debenture is converted into 10 equity shares antadu. So number of debentures multiplied by conversion ratio will be giving you the weighted average number of potential equity shares. Now be careful, convertible preference shares. Earnings available to equity shares plus preference dividend. Hey, nothing after tax has to be considered. Because preference dividend is always paid only after tax. So simply plus preference dividend whole divided by weighted average number of equity shares plus weighted average number of potential equity shares. This is what convertible preference shares. That's it. Now moving on to the last and final one. After computing this dilutive EPS, if at all your dilutive EPS is more than basic EPS, then that is called as anti-dilution, and you should not report anti-dilution. You have to report only dilutive EPS. Respond, everybody, clear? And my dear children, that is the end of accounting standard number 20, and I am not covering one concept. That is series of potential equity shares. If you are having, you should not consider everything together. You have to consider one after the other by allotting some rankings. And how to find ranking ante, you have to find incremental EPS. Incremental EPS is nothing but incremental earning divided by incremental weighted average number of potential equity shares. And after computing incremental EPS, give the rankings from lowest to highest. Then consider individual series of potential equity shares. Don't consider all the equity shares at once. Of course, I have explained you the concept. I can't tell the example because it will be very lengthy. And I hope everybody is comfortable with this concept. I respond everybody pakka. Take care, my dear children. If there are series of potential equity shares, everything cannot be considered at once. Everything has to be considered individually. But what is to be considered first? For that purpose, you need to compute ranking. To allot ranking, you need to compute incremental EPS. Incremental EPS is equal to incremental earnings divided by incremental weighted average number of potential equity shares. Respond everybody, clear. Always rank number 1 is to options only. Because incremental EPS is always 0, since numerator is 0. The fight will be between convertible debentures and convertible preference shares. Allot proper ranking and compute individual figures. And once again, one more thing, don't report anti-dilutive. You need to only report dilutive EPS. Respond everybody, clear. And my dear children, that is the end of AS 20, and get ready for AS 15. Just within 5 to 10 minutes, I'll tell AS 15 only those things which are needed for problematics. Fine, my dear children, coming to accounting standard number 15, which is employee benefits. Not telling more of this standard at any cost. Just there are 2 to 3 famous problems like institute problems, and highly recommended to everybody coming to AS 15. Rather than concentrating on the provisions first, concentrate on the problems that were given by the institute. Frankly speaking, your CRD and assignment, not more than that at all. Because even in institute examination question paper style is also the similar ones itself. Just number change. And if you observe this question, something like about DBO. Let me explain you the concept of DBO for 2 minutes. Likewise, present value of defined benefit obligation is a liability. Remember that. And my dear children, if any provision is created and if funds are there, we will invest somewhere. Am I correct or wrong? Yes or no? From that, automatically you will get some return. Am I correct or wrong? That's point number 1. You should remember. Accordingly, whatever this provision for defined benefit obligation is there, you will be investing somewhere. And that somewhere is nothing but fair value. I'm sorry, you will be investing somewhere called plan assets. You will be investing somewhere called plan assets. And whatever the plan assets you are having, those assets will be earning some income for you. That income is nothing but opening minus closing value of your plan assets. Opening fair value minus closing fair value of the plan assets is nothing but actual return of plan assets. Is my point clear, everybody? So fine, my dear children. So first one, whatever is you're having plan assets. So here you will be having something called plan assets. As I said, plan assets has to be recorded at dash value or fair value. Present value or provision for defined benefit obligation, which is a liability, and plan assets will be always at asset side, recording at fair value. And there is something called past service cost. Past service cost is nothing but a kind of expense. Am I correct or wrong? Sir, treat it as similar to preliminary expense. If amortized, it will be appearing in P&L account. If not amortized, it will be appearing in balance sheet. Is it clear? So, if any unamortized past service cost is there, it also will be appearing at asset side. Is the concept understood, everybody? Take care, my dear children. Coming to defined benefit obligation, how the same shall be recorded in the balance sheet. Number 1, provision for defined benefit obligation. Number 2, you will be investing somewhere which are generally called as plan assets, which will be recorded at dash value or fair value. And unamortized, remember it's not amortized portion, because amortized portion will be appearing in P&L account. Unamortized past service cost will be appearing here. 2 things at asset side, 1 thing at liability side. But standard emantundante, don't show anything at asset side. Set off. So concept is so simple, something like provision for defined benefit obligation, which is recorded at present value, minus plan assets, which is recorded at fair value, minus unamortized past service cost. And then whatever the net figure you are having, you consider this as a net liability. Is my point clear, everybody? Provided if it is a negative figure. Provided if it is a negative figure, obviously it shall be shown at asset side. But while showing it at asset side, you need to compare it with the fair value, and difference whatever is there, which is nothing but a kind of impairment of loss, which will be charged to P&L account. Is my point clear, everybody? So now if you observe the question here, yeah, one more thing. Fair value ante, I mean to tell something like recoverable amount. Recoverable amount. Difference between the book value and recoverable amount, whatever is there, it is called as impairment of loss. If any, you have to charge it to P&L account. Shall I continue? First, let me concentrate on this question. Present value of defined benefit obligation 36. Fair value of plan asset is 38.5. Past service cost not yet recognized. Not yet recognized is nothing but unamortized is nothing but 7.5. So check out how is it. At liability side you are having 36. At asset side you are having 38.5 okati, 7.5 okati. As per accounting standard, don't show like this kadamma. Set off. So 36 minus 38.5 minus 7.5 minus 10. And point number 1, is it asset or liability? So immediately show it at asset side at an amount of 10. But wait, here there is a point. Present value of available future refund from the plan is only 6. And even though as of now you are showing only 10 lakh rupees, your recoverable value of this 10 lakh is only 6 lakh. So record at 10 lakh or 6 lakhs. So automatically difference how much is there? Immediately charge this to P&L account. I hope you have well understood with the concept. Concept is so simple. I'm just concluding once again. Find provision for defined benefit obligation which has to be recorded at present value. And then to the opposite side you will be having plan assets which shall be recorded at fair value. And then unamortized past service cost or past service cost which is not yet recognized. As per standard, don't show like this, set off. If the set off figure is positive, continue to be shown at liability side. Ante kada. If the set off figure is negative, come to dash side. Now compare this asset with recoverable amount. As usual, your impairment of loss. If recoverable amount is more than book value, is there any problem? Seppalamma. But if the asset value is more than recoverable amount, bring down asset value to recoverable amount. That difference is nothing but a kind of impairment of loss which will be charged to P&L account. Respond everybody, clear? This is what? The concept of defined benefit obligation. Respond everybody, clear? And now moving on to the next kind of example, this one. This is also a famous example. If you observe, opening fair value is 1 lakh, Nana. And during the year, benefits paid were 19,000 and inward contributions are 49,000. At the end of the year, the plan assets are 1,50,000. And present value of defined benefit obligation is 147,920 and actuarial losses were 600. And some other data is given. This is nothing but the company made the following estimations. And the estimations were like this. You are going to get return after tax 9.2% and realized and unrealized gain is 2%. Administration cost -1. Expected rate of return is 10.25%. Now he is asking two things. Number 1, what is the expected rate of return? Number 2, what is the actual return on plan assets? Shall I start now? Actual return on plan asset is very, very simple. Because if you observe here, what is the opening fair value of the asset? 1 lakh. Am I correct or wrong? and during the year it had paid benefits of 19,000 and it got a benefits of 49,000. And what should be the closing value of the assets? 1,30,000 should be the closing value of the asset. But what is the closing fair value of the asset? Super happy. 1,30,000 should be the value, but it is 1,50,000. So how much is the actual return amount? 20,000 is the actual return. 20,000 is the actual return. Respond everybody clear, huh? Now let us find the expected return. Amma, frankly speaking, originally you are having 1 lakh. Am I correct or wrong? Your fund is giving 10.25% per annum. So 1 lakh into 10.25%. See here it was given. 1 lakh into 10.25%. This is something amount. Now very important. Sir, why to consider 10.25%? Antayam avasram ledu. He will be telling the question whether compounded annually or compounded half yearly. Here in this question especially he is assuming that compounded for every 6 months. But in the examination he will give very clearly if compounded for every 6 months, whether compounded annually, compounded quarterly. Then if you have remembered effective rate of interest, did you remember the concept? Effective rate of interest. 1 by 1 plus I whole power n minus 1. Did you remember? If you have computed, you are going to get effective rate of interest and then you can apply that effective rate of interest. But frankly speaking, my dear children, this effective rate of interest absolutely is not required because 99.9% he will be giving in the question. So now you can simply consider that the rate is 10.25%. So originally you are having 1 lakh at the opening, 1 lakh into 10.25%. During the year, 19,000 gone, 49,000 benefit. So 30,000 is the net benefit. Multiplied by, you can comfortably consider 10.25% into 10.25% into 6 by 12. Where you are going to get 1537.5. Is my point clear? No need to assume that compounded for every 6 months, 10.25% annually, 5% is compounding 6 months. That is not needed until now. You can comfortably consider 10.25%. If compounded half yearly is given, then it will be given in the question. Then you can consider that one. So now what is your expected rate of return? Ante 10,250 plus 1537.5, which is nothing but 11,787.5. That's it, my dear children. Hey, did you feel any difficulty? This is so simple. So take care. Let me extend the concept. Let me extend this question. How this entire question? So originally 1 lakh is there. During the year minus 19,000. During the year plus 49,000. So it should be 1,30,000. But fortunately you are having 1,50,000. So your actual rate of return actually comes to 20,000. What is your expected rate of return? Ante, my expected rate of return in percentage is 10.25%, sir. Super boss. 1 lakh, your original value of assets you are having, which will be earning 10.25%. Enjoy that return. During the year, 19,000 return gone. But no worries, 49,000 return you have earned. So net amount 30,000 multiplied by 10.25% multiplied by 6 by 12. This is called as expected rate of return. Sir, why this is called as expected rate of return? Ante 10.25% is given as expected rate of return. Idigo expected rate of return 10.25%. Respond up to this clear, everybody. Shall I proceed further? Now in this question I am adding one more thing, something like the present value of defined benefit obligation is 147,920. Ante present value of defined benefit obligation 147,920. Plan assets are being recorded at 1,50,000. Is my point clear? And unamortized past service cost, that concept is not there. You are having actuarial loss to the extent of 600. Whatever actuarial loss is there, immediately it has to be charged to P&L account. Actuarial loss, immediately it has to be charged to P&L account. Remember that. Is it clear? Actuarial losses or actuarial gains must be immediately charged to P&L account. Shall I proceed further? So after charging actuarial loss to P&L account, if at all it is 147,920, again compare. 147,920 minus 1,50,000, where you are getting a negative figure. Since it is a negative figure, you have to show it at dash side, asset side. Respond everybody, clear? There ends the matter. Now, how to compute this present value of defined benefit obligation? How to bring it at present value, sir? My dear children, take care. Find yearly contribution. You have to find dash, yearly contribution. Be careful. Say for example, you need to pool the entire amount at the end of year 5. You need to pool the entire amount at the end of year 5. Be careful. Say for example, you are contributing at the end of year 1. Contributing at the end of year 1. At the end of year 1 ante remaining years are only 4. Is it clear? So whatever the contribution is there, you have to bring it to the present value of 4 years. Not normal FM present values and not normal your AS 19 present values. This will be something like year reverse working. Year 2 ending, obviously 3 years. Year 3 ending, 2 years. Year 4 ending, 1 year. Year 5 to year 0, obviously 0 years. Respond everybody, clear? And if you observe this question, there is an employee who is getting an annual emoluments of 1490,210, and the policy of giving a lump sum payment of 25% of the last drawn annual salary for each completed years of service who have completed for a minimum of 5 years service, like gratuity ankondi, and salary is growing at 10% per annum. Hold your calculator and find 1490,210 plus 10% plus 10 plus 10 plus 10, like that 5 years. How much you have got? 20? 24 lakhs exactly. And what is a lump sum payment ante? 25% of the last drawn salary. So 24 lakhs into 25%, 6 lakhs for each completed of year of service antamma, ante multiplied by 5 years. And on a whole, you are supposed to gain 30 lakhs. Sir, you are supposed to gain 30 lakhs at the end of year 5. How many years you need to contribute? Ante obviously 5 years. So 30 lakhs divided by 5 years, where you are going to get 6 lakhs per annum. Ante at the end of year 5, year 1 contribution should be made 6 lakh. Year 2 contribution should be at 6 lakh. Year 3 contribution should be at 6 lakh. Year 4 contribution should be at 6 lakh. Year 5 contribution should be at 6 lakh. That is how it is going to earn 30 lakhs to you. Is my point clear, everybody? So now very, very important, which is all about bring this 6 lakhs contribution for year 1 ending for present value of year 1. Backward working. After year 5, you need to have an amount of 6 lakhs. And at the end of year 1, how much you have to deposit? Present value of 4 years. At the end of year 2, present value of 3 years. At the end of year 3, present value of 2 years. At the end of year 4, present value of 1 year. At the end of year 5, year 5 to year 5 is obviously 0. So entire 6 lakhs has to be deposited. No present value concept there. Respond, is it clear? That's it, my dear children. Frankly speaking, outright telling you one thing, that AS 15, I did not tell the concept at all. I have explained you how to solve the problems. Even I did not solve the problems, I have explained you how to solve the problems. That's it, and that is the end of AS 15. Also to everybody, it is a tip, something like, please don't concentrate on the provisions of accounting standard number 15. Just concentrate on the problems and their solving approach. That is highly enough. Is it clear, everybody? And fine, my dear children, let us start with the most awaited part of our marathon session, that is question paper analysis. Fine, my dear children. First of all, you will be having MCQs, and then you will be having something called descriptive questions. Fine. Coming to MCQs, totally you will be provided with 15 questions of 2 marks. Everybody knows that. Generally, the pattern will be like this. 2 case scenarios relating to accounting standards, generally multiplied by 4 questions multiplied by 2 marks. So totally here itself you will be getting something like 8 questions of 2 marks, 16 marks. Is it clear? And the next one, you will be having 1 case scenario from a chapter. And it's not case scenario, frankly speaking, it's a problem. 99% this problem will be from buyback. If that is missed, it will be from cash flow statement. Multiplied by 4 more questions into another 2 marks where it counted to 8 marks. And 8 plus 4, totally 12 questions completed for 24 marks. Now another 3 MCQs, generally individual MCQs, nowhere relating to case scenarios at all, out of which 2 from accounting standards, 1 from chapter. This is general style, but not exactly happening the same. It might change. And one more important thing, 99.9% these 2 case scenarios will be like a blend. And from different accounting standards, you will be getting a blend scenario question. But the luckiest part is that each and every paragraph will be divided and denoted for one particular standard. I guess you are seeing in your revision examinations. Likewise, if you are having, if at all he would like to frame a question by considering AS2, AS10, AS12. Then one paragraph will be denoted to AS2, another paragraph will be devoted to AS10, another paragraph will be devoted to AS12, another paragraph will be devoted to AS11. That is how he is giving the scenario. This is the luckiest part. And how to answer the case scenarios questions from the accounting standards. Sir, please don't read the entire scenario at the first instance. If you read the entire scenario initially, it will kill lots and lots of time. Observe the paragraph, to what standard it belongs to, put the number. Say first paragraph is belonging to AS2, just put it like that. AS10, AS12, AS11, mark. And then you check out the MCQs. And first MCQ is relating from AS11, then read that paragraph and write the answer. Read another paragraph, write the answer. Reason being, I have seen some of the scenarios wherein there will be about one, say for example, from AS5, one paragraph will be there. But in the questions, no AS5 related question is there. And in paragraph giving about 2, 10, 12, 11. And he will give a question from AS2. But this is not at all relating to this paragraph. A general provision based question will be asked. And hence, don't concentrate on the scenario first. Concentrate on your MCQs and paragraphs. Which paragraph is devoted to which standard? Mark it, MCQs, reverse working. And be careful, 99% every paragraph is separate. But don't expect like that. You might get interlinkage between different paragraphs also. At that time, be careful. And this is what all about accounting standards. And coming to chapters, as I already said, from one chapter, mostly buyback. If it is missed from cash flow statement, you are going to get one problem where he will be calling the problem as case scenario and going to ask 4 questions. And last and final tagline, 99% the scenarios from the accounting standard will be blend. But there are rare chances, like 1% chance, to give all the 4 questions only from a single scenario also. Single standard also. Happened like that. From A16, he has 4 questions in the recent examinations. So take more care, my dear children. 99% is blend. But 1% is only from one accounting standard also. Fine, that is all about MCQs. But most awaited part is all about descriptive. Remember, question number 1. You might get 4 marks, 4 marks, 5 marks, or you might get 7 marks, 7 marks. I'm sorry, 4, 5 and 5, 14 marks. Or you might also get 7 and 7. And you might get sub questions also. Nobody can predict this compulsory questions at all. From any accounting standard, randomly he is choosing and randomly he is giving. But the luckiest part is that from easy standard, typical question, from typical standard, easy question. Like AS2, people will tell that is easy. From that he'll ask a typical question. AS19, AS22, AS15, typical standards. He will ask a copy-paste style of question just with number change. Now, some standards like AS4, AS5, AS12, he is asking a comprehensive question. And 4 to 5 points in the same question itself. So that is very lengthy. Be careful while answering. This is how your question number 1 is all about. And coming to question number 2, no doubt at all, question number 2 is devoted to a chapter called Company Final Accounts or Preparation of Financial Statements for 14 marks. If this is missed, you are going to get a question from internal reconstruction to the extent of 14 marks. Question number 2, either from Company Final Accounts or internal reconstruction, 14 marks. And coming to question number 3, be careful. Coming to question number 3, one question you are going to get from cash flow statement. One question you are going to get from cash flow statement for 7 marks or buyback. And another question from any random accounting standard again. Copy paste, number change, small adjustments will be changed here. There is no such typical part at all. Question number 3. If at all in MCQs he is asking buyback, here cash flow statement. If at all in MCQs he is asking cash flow statement, here buyback. That is how it is framed. And the next one. Question number 4. Of course, question number 4 and 5 devoted to amalgamation and consolidation. Amalgamation straight away 14 marks. 99% it is from amalgamation in the nature of purchase. Consolidation 90% you'll get a 14 marks question directly, which is CBS or CPL. But sometimes it can also be splitted like 10 plus 4 marks. Dividend question, did you remember pre-acquisition profits, post-acquisition profits? If dividend is given, how will it be treated? A question gani, negative minority interest gani, compute cost of control gani. If you have remembered case A, case B, case C, case D, 4 cases will be there in consolidation. Asking you to compute minority interest and cost of control for every case. Such kind of questions will be asked if at all asked for 10 plus 4 marks. Even if consolidated balance sheet and consolidated P&L account is given in the examination, the adjustments will be comparatively lesser. And moving on to the last and final one, question number 5. Question number 6. In this question number 6, he is going to ask 3 questions, wherein the last question is obviously from dependent branches. If at all dependent branches is missed, he is going to ask a question from independent branches. That too I told you CRD 1, 2, 3 model. I mean to tell inter-branch transactions model, passing journal entries model or preparing ledger accounts model. Even if that is also missed, then he is going to ask from foreign branches. Take care, my dear children. Then he is going to ask from a foreign branches, which is for 6 marks in general, and it depends. Now the next one, 4 and 4. If at all question number 2 is preparation of financial statements for 14 marks, here internal reconstruction for 4 marks. If question number 2 is internal reconstruction for 14 marks, here preparation of financial statements for 4 marks. So preparation of financial statements for 4 marks questions are, sir, dividend question, and also he might ask you to prepare extract or some concept based questions, work in progress questions, schedule 3 based questions he might ask. Sometimes, rare chances, question number 2 is also from preparation of financial statements. Question number 6B is also from preparation of financial statements. Question number 2 is also from internal reconstruction. 6B also from internal reconstruction. And last and final question here you are going to get some internal choice. Frankly speaking, that internal choice is waste ani ardham. He might ask one question from framework or introduction, theory questions. Framework or introduction, or from any other standard. How will he eliminate the choice ante? One question he'll give a theory. ఎలా ఇస్తాడంటే write the disclosures relating to age 14. Amalgamation or disclosures. He may ask like that. Nobody can do anything. And he might ask a question something like write about the users of financial statements, write about carve-in, carve-outs, like that. So one theory question he'll give and one regularized question he'll give. And in all this course of action, remember, any magic can happen every time. There is investment accounts chapter which is having enough potential even to carry up to 14 marks question. Any magic can happen for this. There is a question called, there is a chapter called investment accounts. From this chapter, at any point of time, he might test you. There is a potential even to get a 40 marks question from this chapter. And my dear children, this is what your end for marathon session. And thank you for listening patiently. Thank you for waiting for all the extra times where we have done till all the previous days and previous sessions. And I hope you people are very comfortable and understood with every chapter. And I also hope the revision is absolutely done for you people. Okay, fine, my dear children. Thank you. Marathon session is completed. Hope all the positivity should be with you. May God bless you. And whatever you will be expecting at your Jan 2026 examination and even at your result also, the same should happen. And all the best. Right from the bottom of my heart, blessings to you everybody, and may God bless you for sure. Thank you. Marathon session completed. Bye ma.